Happy post-Christmas. I'm Brian Sazi. Alexis Christoforous has the day off. This is the first trade for Thursday, December 26th. Holiday highs. Retailers get a big gift as holiday sales soar. Why so many of us went online to shop this year. Plus, the big results from Amazon. And changes at the Fed. 2020 means fresh faces on the committee that sets interest rates. What that can mean for Jerome Powell and the president's demand that the Fed slash rates further. And banking on a big year, Microsoft looks to hit new highs as the tech industry sizzles. Why next year could be even bigger for the software beast. Let's get a quick check of the futures here. You're seeing some muted action here. Pretty much a big ghost town on Wall Street today. Dow futures up 25 points. Expect light trading. We'll get a full check of the market shortly, but first, today's big story. Retailers had a very green holiday shopping season. Retail sales were up 3.4% year over year, according to MasterCard Spending Pulse. Online sales soared nearly 19% from a year ago. And Amazon said today its holiday season was record-breaking. Heidi Chung joins us now to break down these numbers. Heidi, these numbers were pretty darn big.
Yeah, I mean, Brian, happy day after Christmas to you. I mean, what that means to us is that the holiday shopping season is finally in the rearview mirror, and we're getting this fresh data from places like MasterCard to tell us how exactly we fared during the holiday shopping season. And I think headed into the holiday shopping season, a lot of people were a little bit concerned because the holiday shopping season, I keep saying that, was shorter than the typical year, right? Thanksgiving fell a little bit later in November than usual, and so people were wondering, well, how will Black Friday and Cyber Monday and sales into Christmas really do? But I think the data that we got today kind of blew everyone out of the water.
Up almost 3.5%.
Right, almost 3.5% year over year, and online sales, as expected, surging, right, almost 19%, and actually hit a record in terms of how much share of the total sales it was, which was 14.6%. And you covered this morning, but Amazon also out with a press release kind of wrapping up their holiday season, and some of the findings were kind of interesting. Prime memberships.
5 million paid or free memberships. You know, I made a point, there's a new story out on Yahoo Finance that I wrote this morning. That's a lot of people now in the Amazon Prime ecosystem, potentially spending in a big way in early 2020.
And also Prime one-day shipping as well as same-day delivery, also records, right, surging as well. But you brought up a really good question. It's expensive to ship these things that quickly. So even though these volumes are up, does it necessarily mean that they're profitable? I think that's the main question. And when are they going to start to be able to turn a real profit in that?
Also really caught my attention is that overall, consumers were clearly out there spending, but this was an online shopping season.
Yeah.
We had some other data over the past 2 weeks saying that the traffic in retailers it still fell short. I think a lot of retailers are hoping that the next crowd comes in this weekend.
Yeah, this holiday shopping season, MasterCard pointed out that in-store sales rose a modest 1.2% versus the online sales growth of almost 19%. So that's just a trend that we have been seeing. Department stores and brick and mortar just continues to see a decline, and we're seeing more and more people head online to Amazon.com, to Walmart.com to place these orders. But one of the areas that I thought was interesting that Amazon pointed out was that toy sales, beauty sales, and apparel sales were actually really, really good this holiday season. And that begs to question, okay, what's going to happen to the Toys R Us that decided to open up in New Jersey?
Well, they might be doing pretty well, but obviously strong toy sales on Amazon, good for Hasbro, good for Mattel. But I'd be worried about the discounts. I think you look at the retail ETF, the RTH, that has underperformed, up about only 26% year to date. But during a market melt-up, you don't want to see the retail stock index underperforming.
Right. And also, I want to point out one more thing. Grocery that Amazon mentioned, they also surged 80% in terms of Prime members trying grocery delivery for the first time ever. Now, that's pretty big because they've been really spending a lot of money to make sure that their grocery kind of can match up to the Walmarts and the other rivals on the market.
What'd your family get you for the holidays?
Cash.
Cash?
And you know, cash is king right now. I know I should put that into the stock market.
I thought only old people like me.
highs.
Yeah, I thought only old people like me still do cash. All right, Heidi Chung. Go shopping. Get out of here. All right, let's get down to New York Stock Exchange now and check it with Scott Gam. Scott, anyone even down there trading? What's going on?
Oh, soon they will be. We got about 25 minutes until the opening bell. But before that, keeping an eye on some of the tickers in the pre-market. First up, Tiffany, which released sales growth for the holiday period, saying that sales rose between 1% and 3%, driven largely by a double-digit gain in sales out of China, which was important because we know there have been declines in Tiffany sales out of Hong Kong amid the ongoing protests in the region. Now, also, of course, back in November, Tiffany agreed to be acquired by LVMH. LVMH. And then also keeping an eye on shares of KKR. This is the large private equity firm which is acquiring Overdrive from Rakuten. This is a digital library platform. Now, the price was not disclosed, but Rakuten did acquire Overdrive for just over $400 million back in 2015. Now, when it comes to today's session, remember the market was closed yesterday. On Tuesday, the Dow Jones Industrial Average actually closed in the red, retreating from Monday's record high. So for today, in order for the Dow to close at a record high, we would need to recover from Tuesday's loss and build upon it. So the bar is a little bit higher for today, Brian.
See some bodies down there nonetheless. Scott Gamble, catch up with you soon. Coming up here on the first trade, expect changes at the Federal Reserve, how the central bank may look with new members joining a key committee. "2020 will be a year of changes at the Federal Reserve. 4 new members are joining the committee that sets rates, and that can make for a very different dynamic inside the Fed. Our Fed correspondent Brian Chung joins us now. Brian, saw rate hikes in 2020, right?
No, it's apparently no rate moves at all in 2020. So the dot plot projection that we got in the last Fed meeting only a few weeks ago said that there should be no upward or downward movement in rates through 2020. Of course, that's just a dot plot projection. Keep in mind, the dot plot projection at the end of 2018 thought that we would have interest rates between 2.75 and 3% right now, way from where we are.
Market would not have liked that.
Not like that at all, where we are. We're currently at 1.5 to 1.75%. So as a reminder, there are 4 Fed presidents that rotate on the FOMC. So we're going to have 4 new members because the calendar's flipping over to 2020. So we have Neel Kashkari, who's the head of the Minneapolis Fed. We also have Patrick Harker, who's the head of the Philadelphia Fed, Loretta Mester from Cleveland, and Robert Kaplan from Dallas that will be joining for 2020. There are 12 Fed presidents, but only 4 of them have votes. So why is this important? Well, because you have the Fed governors. So obviously Jerome Powell always has a vote. Rich Clarida, the other 3 current members of the FOMC board do have votes, but not everyone has a vote. The other 8 presidents that are on the sidelines still participate in the meetings, but they just kind of are the sounding board. It's ultimately those votes that determine whether or not rates go up or down.
Do these new additions tilt either way, hawkish, more dovish?
Well, it kind of depends on how you measure what we saw in 2019, right? So it was by all standards a dovish year because the Fed cut interest rates 3 times. James Bullard was a very major member of this year's FOMC. He's from the St. Louis Fed. But then on the other side, you had Eric Rosengren and Esther George from Boston and Kansas City, respectively, who were members of this year's FOMC that tilted more hawkish. They actually did not support the rate cuts that we saw through this year. So from that perspective, yes, you could argue that maybe next year's will be a little bit more dovish. It's generally perceived that, Neel Kashkari is one of the more dovish members of the Fed at large. He's been very strong advocate for saying we need to continue to have accommodative policy to let the labor market continue to tighten. But then on the other hand, you have Cleveland's Loretta Mester, who has actually argued for also holding rates steady through this year. When I interviewed her at Jackson Hole, when they were in the midst of this, cutting cycle, she was arguing, hey, well, I think we should kind of take the foot off the gas pedal a little bit and actually maybe see if we can keep rates steady. So there will be some disagreement if the outlook does indeed change.
I do think Kashkari is the wild card here.
Yeah, absolutely.
Very outspoken Fed member. Brian Chung, thank you.
Yep.
YouTube is taking aim at cryptocurrency. The Google-owned video platform has removed hundreds of Bitcoin and cryptocurrency videos from the site. Smaller channels took the majority of the hit, with bigger crypto news outlets escaping unscathed. Praz Subramanian joins us now from the newsroom to discuss. Praz, real crackdown here.
Yes, Oz. You think about crypto and online, you think about a lot of hucksterism. It's like the old west of these kind of sales guys, pitching like, I know what crypto is going to do. I know what Ethereum is going to do. So they're calling it the crypto purge. YouTube has taken out a lot of these smaller publishers because they wanted to kind of clean up the channel. Now, by targeting only smaller publishers and channels, a lot of these content creators are saying, hey, why are we being targeted? We're like kind of the first line of education for people that come to the site to learn about crypto, so don't take us out. We're just providing a service.
Praz, is this some form of an indictment on Bitcoin? Bitcoin, for all intents and purposes, has had a terrible year.
Yeah, even for price-wise, it's been bad. I mean, Bitcoin is kind of creeping back up lately. But I mean, YouTube's kind of had a fraught relationship with the crypto community because they fought them before, they brought them back on, now they're kind of going after them again. And it comes down to the fact that a lot of it is so much hucksterism. Remember the crypto genius, that guy? It's stuff like that they want to remove off the channel.
I do remember. I remember seeing those ads all over the place. But Praz, where do these hucksters go? Where's the next platform for them?
They're talking about, some of them are talking about making their own, channel. It's not that hard to do so. All you need to do is have kind of like the bandwidth to do it, and YouTube usually they do it for free. So if it's going to be their own kind of thing, it's not going to be cheap, but it's a possibility.
Isn't it good to see? YouTube has been under fire all year for the content on its site. Is it good to see them finally taking a stand? Obviously, the cryptocurrency would take the other side of this discussion, but still, it's good that they're more closely watching the site.
Yeah, it's good, but I'm a little, I think the concern is that they're allowing content from CoinDesk and CNBC to be on crypto-related content. I mean, it's like they're kind of saying, oh, you guys are okay because you're big media, but you small guys who actually many of them are, just making, just talking about the community and talking about the cryptocurrencies in general. They're not bad, but they're just being targeted because they have no scale.
It sounds as though this has just started. I've been following it over the past, let's say, week and a half, and this seems to be the first wave of them cracking down, and there's another potential one coming.
Yeah, I mean, there's hundreds of channels. I mean, they're just going through the beginnings of kind of pulling or culling these accounts right now.
All right, Praz Subramanian, thank you. Coming up here on The First Trade, more bad news for Notre Dame after that devastating fire. Your news bites are next. Let's get a look at today's news bites. Protesters are back on the streets of Hong Kong today after Christmas Day protests rocked the territory. Chief Executive Carrie Lam said the protests ruined Christmas for many travelers there. Police had to use tear gas and rubber bullets to disperse some of the demonstrators who are demanding more freedoms and accountability from Lam's government. And the U.S. and China may be closer to signing that Phase 1 trade deal. A spokesman for China's Commerce Ministry told reporters they are in close touch with the U.S. He added the two countries are going through all the necessary procedures prior to signing. President Trump on Tuesday said there would be a ceremony with China's President Xi to officially sign the deal. The rector of Notre Dame Cathedral says the Paris landmark is still so fragile that there's a 50% chance the structure might not be saved. That's due to scaffolding threatening the vaults of the Gothic monument. Fire early this year meant the cathedral failed to host Christmas services for the first time in more than 200 years. And organizers of Burning Man have sued the federal government, claiming that they were cheated out of millions. The nonprofit behind the annual celebration in the Nevada desert says the government has overcharged them in fees over the past 7 years. They want relief from the government's, quote, ongoing unlawful and prejudicial conduct. Government lawyers have not yet responded to the suit. And the Potter Park Zoo in Michigan had a memorable holiday. On Christmas Eve, a 12-year-old black rhino gave birth to a male calf in a rare birth for the endangered species. You can see the calf's first steps in video taken by the zoo's camera. This marks the first time a black rhino has been born at the zoo in 100 years. Pretty cool news indeed. Coming up here on the first tray, new year, same old tech stocks. We'll look into our crystal ball to see how some of the biggest names in tech are shaping up for 2020. Optimism over a partial trade deal between the U.S. and China extended oil gains today. Jared Blickery is at the Wi-Fi Interactive Board with today's commodities report. Jared?
Yeah, we have crude oil trading to a 3-month high here. Pretty bullish price action over the last few weeks. We can see overnight, basically kind of gap and go kind of day here. If we look at a 20-day chart, we can see the trend that's been in place here. And a couple of news items here. So we have the API reporting that there was a huge drawdown in crude oil stockpiles, and we're going to get the DOE numbers tomorrow. Usually those come out Wednesday. Of course, this is a holiday shortened week, so we'll get those tomorrow morning at 11 a.m. And also some news about OPEC Plus possibly extending gains into the 2020 era. And we have them cutting about 1.7 million barrels per day in production right now. That could be extended up to 2.2 million if certain estimates are correct.
Jared, can you pull up on a Aramco chart?
Sure thing.
Let's see how that one is doing.
All right. Well, it looks like it's trading back to the closing price that it settled on its IPO day. And we can see it traded up to 38. And so this is in reals. This is a Saudi Arabian currency, but basically giving up a lot of gain. So I would estimate it's probably valued at about $1.7 trillion here, which is what it was valued at when it came out.
And switching gears to gold, it surprises me a little bit, Jared. Nobody is talking, or not a lot of people are talking about this move in gold. And it's not just gold prices. You're seeing moves higher in the gold ETF and a lot of gold stocks, too.
Yeah, the commodities complex overall is getting a nice end-of-year bullish run here. And we can see this is spiking up here. This is gold over the last 20 days, and we can see it's solidly above 1,500. Let's go to a year-to-date and so we can get a longer-term look. And basically, we had this consolidation that occurred, that we had this breakout in June and July. That's after the Federal Reserve started lowering interest rates. And then we had this kind of drop-off here. But in hindsight, this looks like a perfect bull flag, and we've basically rallied above it, and so now we use prior resistance as support, and we could get a nice end-of-year run here for gold as well. I would say silver behaving similarly, and also platinum and palladium, two other commodities we've been tracking here.
Jared, isn't it a little bizarre to see hard assets rallying like this at the same time as equities?
Well, not necessarily. It depends on the interest rate backdrop. So we have the Fed in easing mode, even though it's probably on hold right now. But we know that it's been expanding its balance sheet. And so $365 billion since September, that's a substantial amount of money. And there's some other theories here at play, because there's been a de-dollarization effort on behalf of Russia, for instance, and China. They've been gearing out of the U.S. dollar in favor of hard currency like gold and some other assets. So not really surprising to see this right now, but it's nice that we got this at the end of the year, just in time for the Santa Claus rally in equities.
That's why I come to you with these questions, Jared, because I knew you would have the answers.
Thank you.
Jared Blickery, thank you. We'll dive into the markets next here on The First Trade, but first, here's a look at the action in overseas markets, and we'll be right back. Welcome back to the first trade. The opening bell is just moments away. Futures are somewhat in the green. Dow futures up 29 points. Going to be a quiet end to the week, no doubt about it, due to the Christmas Day holiday. Let's go around the bell now with Noah Hammond, CEO of Advisor Shares, along with Jared Blickery at the Wi-Fi Interactive Board. Good morning to you, gents. Happy post-Christmas. Noah, I'll start with you. Jared and I were just talking off camera a little bit about this everything rally. You're seeing the big move higher into your end, into equities. You're seeing rallies in gold. You're seeing rallies in copper, even palladium. Are we just witnessing a major bubble here?
I think so. It's going to carry on for a while, right? For as long as we seem to have an indication that we could have lower rates ahead, possibly, though maybe with a pause or certainly an increasing Fed balance sheet. I think in this environment, you're not fighting the Fed. It's providing liquidity. It's driving those prices up. Doesn't mean the economy is better. It's just driving prices up everywhere.
I don't want investors to get slaughtered out there, Noah. What should they be watching for in this type of market? Stock prices can't go up every single day.
Sure. I mean, earlier this year when I've been on with you, I was telling people to hedge and be concerned. And then once the Fed started to make the change in their policy, we're long. And so I think it's a challenge, right? I don't know that I would be calling for someone to hedge their portfolio. I do think you want to think about maybe things more tactically. It's hard for individual investors to do that. They get a little emotional when they see the big news and the tweets and the stock market prices. So you want to think about getting some managers who can be tactical for you. But I'd still be mostly long in this environment, continuing into next year as well.
No, is the setup here in January, let's say the Fed comes out here, any type of Fed member, and tries to just prick that bubble here in asset prices? We've seen them do it in the past.
Sure. Yeah. I mean, headline risk is there. I mean, ultimately, I would watch with what they're doing and watch with the increasing Fed balance sheet. Try to not react so much to the headlines, which is, again, why sometimes you want a little bit of component of tactical management or you want to outsource it to a manager. But yeah, you want to be mindful of that. It's going to cause some volatility ahead for sure.
In this type of environment, Noah, where pretty much every stock is going up in a straight line. I look at AMD, that thing's been on fire, one of the hottest trending tickers on Yahoo Finance for seemingly for weeks. What are you trading?
So we're trying to look for stocks that we can hold for a long, long, long time, right? So regardless of what that volatility is, some stocks that we're sort of picking as stocks for the next decade as we close out this one. And so it's companies like a Disney, it's companies like Verizon, JP Morgan in the financial sector, Microsoft as well on software and services. These are core holdings we actually have in our value portfolio. The ticker's DBLV. It's actually managed by DoubleLine. These are stocks that we think we can hold for the long term. So even if the bubble pops a little bit, these are the companies that are likely going to weather that storm for the long term.
Jared, over to you.
Yeah, well, we're looking at the Dow heat map. Now, these figures here kind of bifurcated. So the green is the closing price as of Tuesday, and red is correspondingly if it closed down. But we have these indications. For instance, Visa is up about 1/5% in the pre-market. Apple and Microsoft also up. JP Morgan, not a lot of stocks in the red, although we are seeing 3M about 2/3% down. And just by way of reference, 1 year ago today, on Boxing Day, we had the biggest rally in the Dow, at least point-wise ever. It was something like 5% over 1,000 points. And you're talking about the everything rally this year. I would say it was kind of characterized by two different phases. So we had the first phase, which kind of began about 1 year ago, and we had this liftoff as the Fed pivoted. And then later on in the year, when the Fed went into easing mode, we saw a different type of rally because we had interest rates falling before, and I'm talking about the longer term one. And since about September, we've seen the longer term interest rate rise, and we had this rally in value and cyclicals. So, you look at the end of the year, you can say this asset is up this percentage and this asset is up this percentage. But really, they came in stages here, and I think that's an important distinction to make.
I was reading our pretty stellar Morning Brief newsletter this morning, and on this date last year, it was just not a good day. What is the one or two investing lessons from you, or for you, in your opinion, that you can learn from that type of event? Obviously, stocks have gone up in a straight line since.
Right. And we were coming off of fourth quarter of 2018 where we were down close to 20%, as I recall. So definitely a tough time. Had the Fed not intervened and we had some policy changes, we would have still been continuing to hedge and be very cautious into the market in all of 2019. But probably the lesson learned is just to be careful of those things, right? Be careful of the headlines, be careful of the short-term movement, decide, how you're going to manage risk for different portfolios. If the money that you're saving is for retirement and that's still 20 years away, try not to to react too much, but be in good quality companies to some of that short-term news that you see out there. So you just want to be careful of the headline risk for sure.
And also, too, I suspect, don't fight the Fed. It's an adage we've heard on Wall Street for decades, but this is very much a Fed rally.
I think so. People are saying at some point maybe there's not as much sort of power in the action that they're taking, but haven't seen that yet. Maybe that'll come at some point, but maybe we start to look a little bit more like Japan's economy, right? Which I'd hate to think that we could get there, but you could see it sustained for a long, long time based on policy decisions. So absolutely, don't fight the Fed for now.
And there we have the opening bell on Wall Street. The Dow has opened up about 21 points, but as we've been saying all show long, expect a slow week on Wall Street as people celebrate the holiday. No, if this has been a Fed-driven rally, and I absolutely think it is, what's the risk for next year that they reverse this rally? It's hard for me to believe they sit on interest rates or at least don't signal a rate hike in 2021, let's say by mid-year.
Yeah, well, you'll start to see the market turn down a little bit, right? The market will react to it. Liquidity will dry up a little bit more. I want to see what they're doing with the balance sheet along with, let's say that's the messaging they're going with around rates. So you got to be careful. The market will react to it. But again, where I sit now, for as long as their view is they're going to do what they can to continue to support the marketplace, I'll still be long. I'll try not to get emotionally and react to some of the headline risks that maybe they're not going to make a change. I'll wait till I see a definitive policy change before I'll make serious adjustments in my portfolio allocation.
Aren't you concerned the Fed is sowing the seeds of the next crisis? Isn't that what they do? They lower rates, they send asset prices higher, and then crisis time.
Right, absolutely. So it could be a huge bubble, and we can see, huge declines, quite frankly, right? 50 and 60% declines that happen quickly before you have a chance to react to them. They could manage it more effectively, but think about what that means, right? If they actually manage it over a long period of time where they're reducing that liquidity and they're slowly increasing the cost of capital, well, then you could have a market that doesn't go anywhere for the next 2 to 5 or 7 years, right? So an even longer period of time where you've got to try to find returns in your portfolio. So regardless of how it happens, it could be difficult times ahead. At some point, and I don't think we're ready yet, you do want to sock away the earnings that you've made and try to protect those gains as much as possible.
Isn't the Fed in a big pickle? Obviously, next year is election season time. What do they do? Obviously, the Fed certainly says, they don't pay attention to the election season, but it's in a discussion.
I think they pay attention, and we've got the tweeter in chief, right? Our president, who has been very aggressive with sending messages to the Fed and how they should be managing their policy. And so it's not just the decisions that they have to make and the work that they have to do, which is incredibly difficult, but the outside pressure that's going to be coming during this election year, I think is going to make it, just that much more difficult. And so it's in part why I'm expecting probably a good year. I think that they're going to do the type of things that support the marketplace. And again, it makes me not want to be defensive, at least quite yet.
Mm-hmm. Jared, hit me with some AMD on the NASDAQ. I know you're looking at the Dow, but as I've said, I've become obsessed with watching AMD the past month.
All right, AMD is up 1.35%. That's another 1.35%. Let's take a look at the year to date, see if we can get that printing out. Here we go. Up
There's your bubble.
155.7%. The chip stocks have been really impressive this year, and I was talking about the kind of bifurcated rally, but really chip stocks have been on fire no matter just about what. They took a little bit of a hit in May and June off of the trade war, but that's it. And we can see AMD here just treading water during some of this period here and really taking off towards the end of the year. And just getting back to what the Fed and trying to handicap what the Fed is going to do in 2020, I think Powell has been pretty clear that he's not talking about an interest rate hike until inflation overshoots and stays there for some time. So, we're talking about 2.5% in the PCE core. That's probably not going to happen for some time. I think the next move is a cut, not necessarily yet next year, but I don't think we're going to see a rate hike until we get back down to the zero bound and we stay there for a couple years. That's a long time away.
I like that, Jared. You're now on the record with a potential rate cut. I like that. But I want to go back to some of your stock picks, Noah. Disney. Where's the next upside catalyst in Disney? You have Star Wars out of the way. A lot of big movie franchises, updates hit this year. Fox is being integrated. What do you see as catalysts?
I think two areas. One is the streaming subscriber growth, right? Watch that continue. Watch the revenue start to increase from the free trial periods expiring and people not wanting to give up access to those shows and content. And then I think, advertising and TV and entertainment, right? Watch that part of their business as well, especially going into an election year. I know there's a lot of talk about blocking ads or the types of ads different people will make available, but expect a lot of money to be spent on a lot of advertising on a lot of different entertainment channels and in a lot of different venues. Again, streaming as well being a location. So we like them for the long term for all of the multiple parts of their business line.
And it should be quickly noted the S&P 500 and NASDAQ have hit fresh record highs. Next up on JP Morgan, I'm surprised about JP Morgan. Noah, it's had a tremendous run, let's say the past 2 years, but the Fed is not going to be raising rates next year, which would be good for net interest margins.
It is, but I see them as this bank that's I've seen historically a bit more of an institutional bank that's been continuing to move into the retail space and competing with the likes of Citibank and Bank of America. So between their asset management growth, what they've been very aggressive with, and they're moving to the retail banking space, especially if we're going to see lower interest rates and they start to compete more aggressively with credit cards and home loans and lines of credit for homes. Watch for them to take some significant market shares from existing banks in the space already.
How do you think about headline risk should Jamie Dimon move to a chairman role next year?
With him around, I wouldn't be too worried. He's got a great team. So barring any big surprises or big changes, right, when we know something like that's probably likely going to happen, I feel like it's going to be managed well. It's a well-run company. So what I know at this point, I'm not worried about them at all, which is why we picked them as one of our stocks for the next decade.
And you also like Verizon, our parent company, for the next decade?
Yeah, absolutely. Just streaming the content. Everything's moving digitally and everything's moving online. 5G, a lot of great opportunity ahead for a company that has, a big subscriber network, a big streaming and internet network. Great opportunities for them ahead as well.
And last but not least, Microsoft. They have had a tremendous year. Where are the catalysts left in this stock?
Software and services, you saw them win the cloud bid with the government contract. Watch them to continue to be aggressive. Watch a lot of their software, whether it's the Office services or they're getting aggressive with Microsoft Teams and Slack, right? Watch what happens to that stock and has happened to that stock as Microsoft gets more aggressive with them, which is why we like software and services more than we like hardware. I know you mentioned AMD earlier. We're concerned about the chips and the hardware as it relates to tariffs in China just starting to buy from more of their own domestic companies. But software and services, still a strong growth opportunity with such a big brand and a well-run company.
All right, well, Noah Hammond bringing the fire as always. Happy holidays, and Jared Blickery, thank you.
Thanks, you too.
Coming up here on The First Trade, a shopping season for the ages. As people spend record numbers on items online, we'll see what it means for brick and mortar retailers. Scott Gamm is standing by at the New York Stock Exchange. Scott?
Well, Brian, keeping an eye on a couple of tickers with 10 minutes into the trading session. First up, Boeing. The stock is down about 0.6%. We're just keeping an eye on the stock for most of the trading session, just with all that's gone on this week, most notably with CEO Dennis Muilenburg resigning earlier this week amid the broader 737 MAX crisis. Still no word on the timeline for the plane's return. And then next up, moving to PayPal, the company, at least according to its CFO, who tells the Wall Street Journal that they will be continuing to look at takeover targets for 2020 with a pretty sizable transaction size. We're talking a range of $1 to $3 billion. And then when it comes to the broader markets, Brian, we know that the Dow is up about 37 points, but not at a record high. The S&P, by the way, is at a record high right now. And remember, on Tuesday, which was a shortened trading session, the Dow actually closed in the red, retreating from Monday's record highs. So in order for the Dow today to close at a record high, we would not only need to recover from Tuesday's loss, but build upon it. So we'll be watching those record levels today, Brian.
Calling it the everything rally, and I think it's very well put. We'll talk to you soon, Scott. Millions of Americans are flocking back to the stores today to return some of the gifts they got for the holidays. And they definitely bought a lot of stuff. Buying through Christmas Eve was up 3.4% from a year ago, according to MasterCard Spending Pulse. And online sales definitely led the way. Let's talk about it with Hilding Anderson, head of retail strategy at Publicis Sapient. He's in Austin, Texas this morning. Good to see you, Hilding. The online sales numbers look very, very strong, but what I think a lot of people on the street are concerned about is the weak foot traffic to some of these retailers.
Yeah, I mean, I think it's consistent with what we're seeing is this broader shift towards online shopping. And there was clearly some data around the foot traffic, particularly over the peak periods of, the Super Saturdays, which are down, around 10%. But what I think when you look at the overall numbers, you have to look at the e-commerce growth, which is in the double digits, 16+% for the entire holiday season. That's really the growth driver for many retailers. Particularly interesting if you double click on that kind of digital numbers, the buy online, pick up in store numbers are up almost just over 40%. One in 5 orders that are placed are actually being picked up in the store itself. And that really has huge implications for the role of the store and the broader business. How concerned are you, Hilding, about a fresh wave of store closures in the first half of 2020? I'm really locked into some of the department store spaces like a JCPenney or even a Macy's. Yeah, I mean, I think you have to think about the store locations as part of a total portfolio of channels. And I think to the extent that those stores are able to double click on the online and the digital channels and drive their growth, if they can hit that 20 to 30% trajectory of e-commerce growth, there'll be still be a role for that store, particularly as you think about the buying online and picking up in the store itself. Amazon out today touting a record-breaking holiday shopping season. No sales numbers, that's what Amazon does. But I think there was this thesis emerging on Wall Street that Walmart, Target are taking a lot of market share from Amazon, but this release suggests otherwise. Well, certainly Amazon's investment in the same-day shipping we've seen, an acceleration of their digital growth on the backs of that one-day delivery. And, as we think about the role, particularly of mobile ordering, we had some great research at Publicis Sapient that came out that showed that Q1 was the first year ever for mobile orders being the #1 channel in the digital area. And to the extent that they're able to maintain that number of mobile orders, that's going to be a big growth driver, not just for Amazon, but for any retailer that's able to move forward on that channel. Is Amazon still dominant? Very much so. Yeah, I think Amazon is the great whale that everyone has on their radar. But I think what you're seeing is increased sophistication among the other players in a couple different areas. One is the role of data. So you're seeing leaders like Walmart and Target and others really monetize the data that they have, use it to drive higher loyalty, higher customer value from a customer lifetime perspective, and even more importantly, drive more profitability efficiencies in their supply chain. So that's going to be a key thing to watch as these retailers, many of which are going to continue to thrive and survive in an era of a strong Amazon as the time goes on. Are we at that point, Hilding, where the online businesses for these retailers are profitable? We're not, in fact. That's one of the #1 issues for us today. Walmart announced a couple of quarters ago that they were expecting $1 billion loss in their online channel. But to us, some of that is an aspect of the growth and the growth trajectory that these businesses are on. When you're seeing a 20+% growth, some of these are seeing 30+% year-over-year growth. There's going to be some time until it becomes a profitable business. And the question is, what's that line and when does that happen? The other question is, and I think it's about using some of these new technologies like machine learning and AI to really change how you operate. Many retailers today still use spreadsheets and and gut feel about trying to do demand planning or fulfillment optimization. There are way better ways of driving efficiencies that will ultimately have a huge impact on that long-term profitability picture for the digital channel.
All right, Hilding Anderson, we'll leave it there. Go out and do some shopping.
Thank you. Enjoy it.
Let's check in on the markets now with Jared Blickery at the Wi-Fi Interactive Board. Jared?
Hi there. We're looking at the heat map of the NASDAQ 100 right now. We see Lululemon up 1%, but let's do something else here. Sort by quarter-to-date performance, and guess what? Tesla up 76.6%, number one, even beating out AMD, which we've been talking about. So let's talk about Tesla for a second. This is a year-to-date chart. Things got pretty dark about a year ago, and all of this kind of pivoted off of that funding secured tweet that Elon Musk sent out, and he was being investigated by the SEC, and really kind of calmed down, and the stock has taken off now. Ever since they got that cash injection earlier in the year, stock has more than doubled from 180 to right now 429.37, pretty far above that 420 call that he was referencing just about 1 year ago with that infamous tweet.
Jerry, you know what's amazing? Tesla's market cap now is, I believe, almost 2 times that of Ford. Now, Ford is a profitable company. Tesla has pretty much just shown up 1/4 of profits.
Yeah, I think this is all forward-looking, and EV is going to be a huge play, and Tesla probably has some room to run here. You know, we were going over this Morgan Stanley note the other day, and they still see the bearish case as being $10. Now, think about that. Stock's trading at $429 right now. They can see it going higher, maybe, but long-term, they see it maybe hitting $10. So valuations eventually have to come back to earth if it is just a car company, but this is an EV and tech and IP play, and I think that's what people are banking on right now. And we can also take a look at another stock that's done very well this year, which is Apple, up 30.5% this quarter alone. If you take a look at this chart, it was almost exactly 1 year ago. It was the second trading day of January when we got that guidance from them, and the stock I think sunk about 3-4%, but it's rallied ever since then. And we can see it's up 81% year to date, an incredible run for the most valuable company on earth, second to Aramco.
Jared, this is the AirPod Pro rally for Apple. These things are sold out to the end of January. You can't even get them until February.
It's incredible. I think their sales in iPods, or the ear things. What do you call it? AirPods. Yeah. Those have doubled just over the last few years. They're expecting $15 billion in sales in 2020. This is something that's going to carve out a nice revenue source for them on their balance sheet. And they have a few hits like this. Think about their expansion into services as well. So Apple's definitely a longer-term play here. I don't think anybody sees this stock going to $10.
I'll leave it here with this full disclosure. I have on my fourth pair of AirPods. I keep losing them. I can't take it. Jared Blickery, thank you. Coming up here on the first trade, it was also a good year for Sony's PlayStation gaming console, how the video game maker dominated next. But taking another quick check of the markets here, the Dow is up slightly on this holiday shortened week, up about 55 points. Over at the NASDAQ, also in the green, thank you AMD. And last but not least, the S&P 500, also in the green. We'll be right back. Now here's a look at the companies and stocks the Yahoo Finance team is watching for you today. A mixed holiday season at Tiffany & Co. as it gets ready to become part of LVMH. Worldwide sales were up 1.3% versus a year ago, including sales growth here in the Americas. Same-store sales rose in all regions except Japan, where they fell 11% to 13%. While Tiffany said it saw a positive momentum shift in the Americas, sales were still under pressure in Hong Kong due to the protests. The latest Star Wars movie soared in theaters on Christmas. Disney's Rise of Skywalker brought in $35 million, making it the second best performing film ever on Christmas at the domestic box office. That is second to another Star Wars movie, The Force Awakens. Little Women also scored big for the day, bringing in an estimated $7 million. Prosecutors say that lawyer Michael Avenatti was more than $15 million in debt when he tried to extort millions from sneaker giant Nike. Avenatti is accused of threatening to hold a news conference and reveal allegations of improper payments to college basketball recruits. That's if Nike did not pay him some $25 million. Avenatti has pleaded not guilty and has denied any wrongdoing. And the ongoing battle between Sony's and Microsoft's gaming consoles rolled into the holiday season, and a clear winner has been revealed. According to the UK-based business intelligence and research website VG Charts, Sony's PS4 is still as popular as ever. It dished out 154,000 more units than the Xbox One over the past month. And supermarket chain Kroger says ignore those promises of food giveaways popping up on Facebook. They're a hoax. Food giveaway contests promising a year of free groceries were promoted using a fake but believable Kroger account. That, of course, created a lot of buzz on social media. Kroger said it's working to address the matter and advises customers not to engage with the post. Of course, this happens on Facebook. And those are your companies to watch on Thursday, December 26th. Coming up here on The First Trade, changes to Medicare are coming, how the service may have a new look in 2020. New year could mean big changes for Medicare. It's ramping up its initiatives in areas like payments, benefits, and rules. Anjali Kamlani covers healthcare for us and is in our newsroom with the details. Anjali, potentially some big changes here.
Absolutely, yeah. We're looking at some really interesting changes, actually. You see Medicare really looking to expand the services that they are already offering, including stuff like cutting hospital payments and trying to push for more in-home care. That's one of the biggest things that really the entire nursing community is really looking at as a way to cut costs. And then you're looking at delays in upfront payments, partly in a way to sort of reduce fraud and abuse. So rather than getting paid upfront 60%, they're going to start being reimbursed 20%. And this is really important because it is really going to affect the economics of the entire industry, and it's really going to affect both small and large players in different ways. So smaller players will definitely be squeezed, while larger ones are looking to get actually less reimbursement. And then in addition, they're really looking to expand the private part of Medicare, which is Medicare Advantage. And so you're looking at really really encouraging supplemental benefits to be reimbursed over there, and that's things like putting in an AC unit, pest control, removing mold, modifications to homes for easier use for seniors.
Anjali, for the average Medicare recipient, will their costs get higher?
Well, so it depends on the plans, right? So when you're looking at the Medicare Advantage plans, it's likely, but cost overall is really where this argument is stemming from. Where in addition to the strain already on Medicare to even cover services, there seems to be more reliance on the private side, and that's where a lot of concerns are coming from. Is how, in fact, is Medicare going to be taking care of this? And this is in part to do with an executive order that Trump had passed in October, which is asking for even more things like this.
Anjali, isn't 2020 a potential peek into the future of Medicare, especially with the aging baby boomers? A lot more people, a lot more costs. They're going to have to cut costs somewhere.
They are going to have to cut costs somewhere, and that's kind of where some of this debate is coming from, where people, especially in 2020, we're looking at, on the political field, we're looking at conversations about Medicare for all and how that would work. And I think this is really sort of a hint at what it looks like to expand services, and almost a testing ground to see what could happen in that space.
Something to watch, that much is for sure. Anjali Khemlani, thank you. And that's it for the first trade for this morning. I'm Brian Sozzi. Enjoy your shopping today. Now let's get one more check of the markets with Scott Gamm over at the New York Stock Exchange. Scott?
Well, we're keeping an eye on shares of Amazon. The stock is up more than 1% right now, firmly above $1,800 a share. The company issuing a press release today saying that shoppers shopped at record levels on Amazon during the holiday season and purchased tens of millions of Amazon devices. We know that Amazon has underperformed the broader market this year, up about 20% year to date, while the broader market is up about 30% this year. Remember, it was just back in the summer when Amazon was trading just above $2,000 a share. And then staying with this holiday theme, Tiffany announcing some preliminary sales data for the holiday period, saying that sales rose between a range of 1% to 3% during that time, amid a double-digit gain in sales out of mainland China, which is important because, of course, there have been some declines in Tiffany sales out of Hong Kong amid the broader protests in the region. And then also watching oil stocks, Chevron and Exxon are up right now. We did get some data from the American Petroleum Institute saying that weekly crude inventories fell by 7.9 million barrels, so less supply tends to boost prices, and we've got West Texas Intermediate above $61 a barrel. And that'll do it for us on the first trade. Thanks very much for watching. Stay with us. Wi-Fi AM is coming up right after the break.
Good morning. Happy holidays. Welcome to Wi-Fi AM at Yahoo Finance. I'm Dan Roberts. We've got Brian Chung and Heidi Chung here on the couches. No relation.
No relation.
Now, let's check the markets on a slow day, the day after Christmas. Right now, all three major indices are higher just a bit. The Dow right now up 46 points. NASDAQ and S&P in the green as well. And those are record highs that we've seen today again. So markets have been going very well for the last few days or weeks, and the U.S. holiday shopping season also went very well. Retail sales rose 3.4% year over year. That is according to MasterCard Spending Pulse. And online sales rose nearly 19% year over year. So e-commerce really booming. And within that category, Amazon says that it had a record-breaking holiday season. Amazon says 5 million new customers started Prime free trials. And it also says the number of items delivered via Prime one-day shipping and free same-day delivery quadrupled since last holiday season. So a very good holiday shopping season. That's good for the health of the consumer, good for the economy. And of course, now return season starts. Time to now return the gifts that you got that you don't want.
And all the people that signed up for Amazon Prime, a lot of them are probably going to unsubscribe from that membership as well. So that could also be a reason for concern. But for now, things look nice and rosy. Brian and I formerly interviewed Steve Sadoff, who's the former Saks CEO, but also advisor to MasterCard. And we asked him, you know, the holiday shopping season is shorter than previous years. Do you think that's going to affect the sales this year? And he said, no, I think people are starting to shop sooner. And as long as these retailers focus on the omni-channel, things will be good. Online sales, pretty crazy.
Well, we probably need to redefine what the season is.
Right.
Because I remember talking about as early as October, Christmas and holiday shopping discounts going up online at sites like Walmart in October.
Yeah.
So it's like, come on, Black Friday, it's like Black 2 weeks.
Right. But as measured as the distance between Thanksgiving and Christmas, it was shorter by 6 days this season. But look, I don't know about you guys. Yes, obviously online sales have been increasing, but I live in New Jersey. You can't drive more than 10 miles without passing 3 malls. And it looked like, at least in the days leading up to Christmas, that it was still packed parking lots. There were still lines out the door for some stores.
I feel like that can be misleading,
Exactly.
though,
So-
that anecdata, because yeah, malls are going to have a full parking lot 2 days a year, but does that mean that the malls are doing well? I mean, probably one of those 3 malls should close.
But I mean, another interesting kind of anecdote that I experienced, so I had put an online order for pickup at Macy's, I think it was one of those big box stores. And actually the line for online pickup was just as long, if not longer, than the regular checkout lines for just people picking up things in store.
Is it actually a time saver? Is it
It's
more
like at Disney,
That's the
Fast
thing.
Pass is now so common.
Right,
It ain't
everybody's
that
got a Fast Pass.
Yeah.
Like TSA PreCheck, it's the same thing. But to be fair, I will say even though the 2 days, the Super Saturday, that the parking lots were essentially, you couldn't even get a parking spot, if they're able to sort of make a profit, because when you're thinking about same-day delivery or one-day delivery, these companies are spending a lot of money to ship those packages out. So to your point that people were going in to pick it up but the lines were long, that's more profitable for these companies at the end of the day. So.
Yeah, I mean, I think going forward, the best retail experiences are the combos, where you can do it all whichever way you choose. What I mean by that is, I got some gifts from Bonobos. I find Bonobos to be a good experience. You can go in person, choose what you want, then they send it to you. But I also got I bought gifts from Everlane, which I thought was online only. Now I see that there's an Everlane store. So one of the items needs to be returned. Now I see that I can actually go and return it in person if I wish.
Hey,
so that's great. You can choose omni-channel.
Remember we talked about this. The
Yes.
Everlane in Soho across the street from Prince Street Pizza has a line to get into the store all the
God.
time.
Yeah.
It's actually
Well,
pretty
maybe I
terrible.
won't.
It's roped
Maybe I
off.
won't
Yeah.
return
But I will say this, though.
person.
I think that the one competitive advantage for Amazon going forward is really going to be the one-day shipping. Because for me, I felt more comfortable kind of waiting a little bit longer towards the end of the season to put in an order because I knew that Amazon would be able to save my back because I could get something shipped to my
Protects the
apartment.
procrastinator.
Do you
Right.
really trust FedEx and UPS to be able to deliver it to you on time?
I mean, I haven't had, I don't know about you guys, so I have Amazon Prime, and I have not had an issue with anything being shipped on time. I've had issues with the wrong thing being delivered, or maybe the item was damaged slightly on the way there, but Amazon is pretty good, at least in my experience, with swapping it out. But in terms of the actual delivery, and your mileage will probably vary, I mean, I haven't had any problems, so.
Yep. Good holiday shopping season. I'll also be doing the bought it online and will return it in store with Sephora.
Yes.
An item from Sephora. Okay, let's talk oil. Oil this morning rose to its highest price in over 3 months to $67.51 a barrel. That was Brent, thanks in part to optimism over that phase 1 trade deal between the U.S. and China. Yahoo Finance's Jared Blickery can break it down for us. Jared, good news in oil prices.
Well, if
depends
higher
on
oil
your perspective.
prices mean higher prices at the pump, depends on how you look at it. But yeah, given that the U.S. is really a net exporter now, it is generally good to have higher oil prices for American companies. Shale oil is at an all-time peak right now. It's set to expand next year. And despite the supply, we've had a really bullish price action in crude oil. So you said $67.51 in Brent. WTI is almost at $62. Haven't seen these prices since Saudi Aramco was attacked. Remember those drone attacks? And really scuttled the facilities there, but haven't seen these prices since then. So a lot of it has to do, I think, with the expectation of growth next year. And so that's adding some liquidity, the Fed is adding liquidity to the markets as well with its balance sheet expansion. And so we're just seeing a lot of money go into asset prices right now, gold included. You take your pick of these commodities and we're seeing them rise right now.
So Jared, we're seeing some price targets on the S&P 500 by the end of 2020. I mean, there's a lot of factors that we can see in 2020. One of them being the election, any sort of other changes that can happen in terms of the political stability in the Middle East. But do we have any price targets on where we might see Brent and crude next year?
Yeah, I've seen some as low as $45 a barrel. And part of this has to do because we are getting a lot more supply next year, especially in the back half of the year from countries like Brazil, Norway, even Russia. I mean, Russia just discovered this huge field that they're going to develop in the Arctic, 2 million barrels a day. It's going to take a few years to come online, but we're not anywhere near peak oil right now. So really the rest of the world has to catch up in terms of growth. And then the big factor too is what is OPEC Plus going to do, because they just increased their production cuts. So they're up to 1.7 million barrels per day that they've cut, and they could have to go up to 2.2 million barrels per day if they want to keep the price of oil up. We'll have to see going into the next year, but a lot of people are kind of shocked by this bullish action in crude oil that we've seen over the last few weeks.
Jared, so the higher oil prices obviously could be a boost for energy stocks, but I recently did a roundup of the best and worst performing stocks of the past decade, and not surprisingly enough, a lot of the worst performers were energy names. So a lot of analysts saying, energy stocks have been a value trap for a really long time. Do you think that's going to continue into the next decade, even, as we see higher oil prices?
It's going to be tough. I think if you're going to play the energy sector, you have to be really careful about the companies you choose, because we are going through this secular rotation in terms of crude oil. We're no longer in the growth phase of shale, and we're seeing the majors like Exxon and Chevron really get into it. So these smaller companies just aren't making as much money as they used to. A lot of them are saddled with really high amounts of debt. And unless crude oil really rebounds here, at least maintains the gains that we've seen over the last few weeks and maybe builds on them, I don't really see the energy sector as a whole is outperforming. You really got to be careful about the companies you pick here.
What has happened with the Aramco stock, by the way? I know we were just talking about a week ago. It was up the first 2 days big as it could be.
Yeah, it's back down to the closing price on its IPO day. So effectively having gone nowhere, that would put its valuation at about, $1.7, $1.75 trillion, which is really where it came out at. So I think there was a lot of hype initially, and we were kind of skeptical of this big pop to $2 trillion valuation. Hasn't held on to those gains. It's a really small, illiquid market out there that we're talking about, the Tadawul exchange in Saudi Arabia. I don't see this stock ever surpassing $2 trillion again unless we get a huge pop in oil prices.
All right, you heard the call from our oil man, Jared. Thanks so much. Coming up here on Wi-Fi AM, YouTube purged a ton of cryptocurrency videos with no real official explanation yet. We will discuss. Welcome back to Wi-Fi AM. There he is. It's Scott Gahn, live on the floor of the New York Stock Exchange to tell us what is happening with stocks on the day after Christmas. Hi, Scott.
Hey, Dan, and not surprisingly, we're watching some of the consumer stocks amid the holiday season, most notably Tiffany shares, and the company released some preliminary data on just how much sales rose during the holiday period, and the growth rate was a range between 1% to 3%, at least according to this first run at the data, and that was largely driven by a double-digit gain in sales out of mainland China, which was important because it helped to offset some of the declines that Tiffany saw out of Hong Kong. And we know, of course, there's been a lot of disruption in Hong Kong with the protests, which have been going on for 6 months now. Not much reaction in Tiffany's stock, and that's not surprising just because back in November, Tiffany agreed to be acquired by LVMH for more than $16 billion. So there's sort of overhang on the stock until that deal closes, Dan.
All right, interesting stuff about Tiffany. Scott, we will check back in with you later in the show. Well, big changes are coming in 2020 for the Federal Reserve. 4 new members are joining the committee that sets rates, and that could make for a very different dynamic inside the Fed. Good thing we have Brian Cheung here to explain.
Wow, so
what's going to happen with the Fed in 2020?
Yeah, well, okay, so to back up, the way that the Fed works is that you have 12 Federal Reserve Bank presidents that are located and scattered across the country, but only 4 each year get to vote. So when we talk about the interest rate policies, those are all mutually agreed to by the members who have votes. Now, every Reserve Bank president is in the room, so they all participate in the discussion, but ultimately it's down to the Fed governors in Washington, D.C., so that's Jerome Powell, the chair, and then, Rich Clarida, Randy Quarles, Mickey Bowman, also Lael Brainerd, in addition to those 4 Reserve Bank presidents that then rotate in. So because the calendar is flipping to 2020, we're going to have 4 new members. So it's Dallas Fed President Kaplan, we also have Cleveland's Loretta Mester, Philadelphia's Patrick Harker, and Minneapolis's Neil Kashkari.
Whom you just interviewed at our All Market Summit.
Exactly. Now, you'll notice that Neil Kashkari took a pretty dovish tone when I talked to him. He was saying that we really need to have accommodative policy to let the labor market continue to tighten. This is going to square with what we've seen from other members of the FOMC. So, Loretta Mester, who's from Cleveland, I interviewed her at Jackson Hole. She is generally perceived to be one of the more hawkish members of the Federal Reserve. She has advocated actually for not cutting rates, as we saw this year. So that could lend itself to some division. But for right now, it seems like actually most of the members should be on the same page. When we saw the dot plot projections from the December FOMC meeting, which was only a few weeks ago, what we actually saw was that Jerome Powell was able to get everybody on the same page. Look at that neat line for 2019. Every single member, even those that dissented against the Fed rate cuts that we saw this year, appear to think that, at least for right now, it is appropriate to keep it at its current level. For 2020, only 4 of the 17 members of the FOMC saw the case for a rate increase, but for the time being, it seems like the median dot would still be in where we are right now, which is between 1.5.
Look at 2022. Oh, golly.
Oh, that's a mess. That's an absolute
Good golly, Miss Molly. That is really distributed. That'll be interesting.
Yeah, the median dot for 2022 would imply 2 rate cuts between now and then. So assuming that we get no rate changes in 2020, that would mean 1 rate cut in 2021, one rate hike in 2021, and then another in 2022. The problem, though, is that the dot plots have been a really bad indicator. So if you look at the dot plot projection,
fun.
They're so fun. Yeah, who loves dots, right? But the thing is, for 2018 rather, the dot plot median was actually supposed to be in the range of 2.75 to 3% for this year. And we're way below that, 1.5 to 1.75. So it's not a very good indicator. The Fed did not see the trade headwinds and also the global growth slowing as much as they did this year, which is why they ultimately had to cut.
Much like other surveys and polls, not always the most reliable.
Yeah.
Survey what you think should or will happen.
Right.
Or what you
Which is why
intend
the
to
Fed
do.
has even considered maybe getting rid of the dot plots. Because
No!
it's the only funding that you have. Yeah. But at the end of the day, they worry that maybe it's just confusing markets too much, right? I mean, you had the dot plots, you were in this lower for longer environment where it was like, here's what we're going to signal in terms of when we're going to get away from 0% interest rates. But now it's kind of like it could go anywhere we want. Yeah. So why should we try to promise or commit to anything in the future?
Well, 2019 was certainly an interesting year for your beat.
Yeah, for sure.
Some action.
It's going to stay interesting, I think.
Yep. All right, and we'll have Brian to tell us more about it. Well, call it a holiday crypto purge. Merry Christmas. YouTube removed hundreds of videos about Bitcoin and other cryptocurrencies, mostly videos posted by smaller publishers and individuals and crypto influencers. Now, in notices that were sent to those video publishers, YouTube tells them that their videos had harmful or dangerous content, but Google, which owns YouTube, has not yet given any further official explanation about the reason for this purge. And this purge comes after Google had banned Bitcoin and crypto ads from Google and YouTube for 3 months last year. Then it allowed them back on the site after a time. So sorry to Crypto Heidi or Brian Binance Coin.
Blockchain Brian.
Blockchain Brian. That's nice.
Sure.
But you follow crypto very, very closely. Why do you think they did this?
Well, look, after it began, I saw a lot of people saying, well, were any of the videos about Bitcoin? Because mostly it was shitcoins, as the phrase goes. That is a common phrase in the I said shit, but altcoins, you could call them. Most of the videos, it seemed like were, so if someone is, if Blockchain Brian mostly posts videos about Dogecoin and about how great Dogecoin is, and he's pumping, shill. That's, a lot of that content is trash, garbage content. And
Right.
so some of that is what was purged. But no, it was also, in many cases, videos about Bitcoin. So I'm not sure that the explanation is just, it was stuff kind of viewed as trashy,
Right.
kind of crappy content that is biased, that is posted by people who hold the coin and just want to shill and pump it. I think in general that the most draconian conclusion might be correct, which is Google doesn't like cryptocurrency, guys.
Well,
Bottom
here's the
line.
weird part, though, is that we knew that Google and YouTube had a beef because they've been kind of battling with the advertising on the platform regarding cryptocurrency. But it's weird to see them actually take the content, the underlying content,
Right.
down now.
And this is posted by human beings.
Right,
I mean,
and I
it's
think
original
it was
content.
Forbes that was reporting that it was because it was supposedly harmful content, but
Right.
didn't have any sort of further explanation on that. I mean, I'm
Right.
sure there's many political related videos
Right.
that are probably just as kind of draconian or
Yes.
in the weeds there.
Well,
But-
I suspect one answer, at least to that part of it, the harmful content, is that they're defining harmful as misleading people financially.
Right.
Like people are going to see a video posted by some, person, and it says that he has 30,000 YouTube fans. So it's like, oh, well, he knows.
legit,
And
right.
it says buy Ether, buy Ether, buy Ether. Well, of course he wants you to buy Ether because the price will go up, and then people who don't know any better might buy a lot of it, and God forbid put some of their savings into it, and then the price keeps going down and they're losing their shirts. So the argument would be protecting people financially, but that can't be the only reason. And you're right that separate from the notices people receive, there's been no official Google response of here's why we did this now en masse.
Well, I think to your earlier point, this applies more to the altcoins, the smaller coins that a lot of people don't really know about. So when you're pumping that, you're going to see price action really swing in either direction. But when we're looking at Bitcoin's price today, it didn't really move on this at all. So I feel like for the larger coins, this doesn't really matter all too much at the end of the day.
a lot of crypto people are on Twitter.
Unless you want, obviously, new investors, new people to enter
Well,
the
and
space.
on crypto Twitter, there's even more trash.
There's a whole other
Yeah.
tweets that you need to avoid. It is interesting, by the way, because I saw a tweet reacting to this purge where someone was saying, like throwing in the towel, saying, I've had it with the crypto space. I think it's just too much. There's too much bad stuff. He's like, Google clearly against it. Some more hacks and scandals and things. There was a big exchange that was compromised recently. There was a pyramid scheme at a Chinese-based website that caused the price to crash of a number of coins a week ago. And this person was saying, I think I'm out. But
Maybe crypto needs some PR.
the big believers will stick around, sure. And we will stick around. We'll be right back here at Wi-Fi AM, so stay with us.
Time for today's trending tickers. The first one is Boeing. Bloomberg reporting that new messages between Boeing employees on the 737 MAX show a, quote, very disturbing picture of the plane's development. The report did not disclose the specific details of those messages, but at least some of them were written by the same high-ranking Boeing pilot who flagged problems with the software believed to be at fault for 2 deadly crashes. Boeing tells Yahoo Finance in a statement, quote, Boeing proactively brought these communications to the FAA and Congress as part of our commitment to transparency with our regulators and the oversight committees. As with prior documents referenced by the committee, the tone and content of some of these communications does not reflect the company we are and need to be. We have made significant changes as a company in the past 9 months to enhance our safety processes, organizations, and culture, end quote. The messages were given to a House committee and reportedly have been passed on to the FAA. And guys, this comes days after the exit of former CEO Dennis Muilenburg. So part of the changes, I guess, Boeing was referring to in its statement, saying we've taken measures to take care of this. But look, the 737 MAX is still not in the skies yet.
Well, and there are reports that maybe they will not be producing any new ones.
No, that has been confirmed, right? Starting in
Well,
January,
yeah,
they will not be producing any more of those.
Right.
And I think
So,
I wasn't in the office
out
when
there.
this news broke, and unfortunately, I was so shocked, even despite the fact that we had been saying Muilenburg has been on borrowed time.
Right.
He's going to exit imminently.
wait until Christmas?
Right, the day before Christmas. And it was pretty shocking.
Okay, Merry Christmas, Iran.
Exactly, and you know how there have been reports that he was not seeing eye to eye with the current CEO or the CEO that will be taking over Muilenburg's spot, David Calhoun, because Calhoun wanted to end production of the 737 or halt it until the FAA approved the new updates, but Muilenburg was the one who was like, no, let's keep producing it. It looks bad optically if we stop producing it, because that just shows people that we're not ready to put the software update out anytime soon. And as we know, the software update takes time. The FAA has to approve it. Then it has to be installed manually into each plane. So not only do we need the FAA approval, we need regulators around the world to also approve it. So the process is just so long. To even think that it was going to happen this year was insane.
When we discussed Charlie Scharf, formerly of Visa, going to Wells, you and I said, is there any new job, any CEO job less desirable than going to run Wells right now? Maybe GE? And the answer was Boeing. I mean, good luck to him.
So, but here's the problem, though, and I think that there needs to be some culpability or scrutiny, at least on the board, because it seems like, based on the timing of this, 2020 hindsight, obviously, that Muilenburg was squeezed out because he was unable to get the plane back on time.
Right.
Not because of the aviation disasters themselves, right? He had promised for a long time that he was going to get the 737 MAX back up before the end of this year, and because he failed to do that, he got canned. But then why didn't the board try to work earlier in the process to actually work with him to figure out why the planes had this problem in the first place, not necessarily just to get the plane back in the sky?
Yeah.
So anyway.
Disturbing, by the way, to say the least.
Yeah, absolutely.
Goodness.
Yeah.
There are better words for it.
But anyway, moving on to our second trending ticker of the day is private equity firm KKR. Shares are up over 1% after it announced Tuesday night that it will be buying digital library Overdrive from Rakuten. Overdrive works with about 43,000 libraries and schools across the globe to offer ebooks, audiobooks, and other digital media. The terms of the deal were not disclosed, but as a benchmark, Rakuten purchased Overdrive for $410 million in 2015, so probably not a cheap buy there. But guys, for anyone that even uses the New York Public Library system, you've probably had to use Overdrive to access.
I love Overdrive.
Yeah.
Overdrive, Libby, I love all the library apps. They're very effective.
Right. Now, at $410 million, though? I mean, well, they probably paid a premium for that, so even more than that. I mean, that's a pretty hefty price tag.
Rakuten, we got 2 NBA fans sitting right here. You're used to seeing
That
Rakuten
logo.
on the jerseys of?
Right. That is the Warriors, right? No.
Is it? No, it's not.
Yes.
It's Warriors.
Yes.
Okay. Because Wish is the
Wish
Lakers.
is
Shout out.
Lakers.
Wish is the
Yes,
Lakers.
Wish is the Lakers.
Clippers?
Bumble is the Clippers.
Bumble.
That's still
Right.
funny.
Yeah.
Right. Celtics?
But also, can we just really
GE,
quickly
guys.
highlight the
GE.
fact that the Warriors beat the Rockets
Oh,
yesterday?
my
I'm sorry, I had to bring that up.
Heidi and Brian, some holiday trivia for you. Can you tell us the names that KKR stands for?
Oh, man. I got the Rakuten thing already.
I'll give you a
I have
hint.
nothing else left
You're
to
like, I don't need
Hint.
any more wins.
One of them. Hello.
K? The
Roberts.
K or the R? Oh.
Holberg, Kravis, and Roberts.
Whatever. No, they
Holberg, Kravis, and Roberts. Okay, coming up here on Wi-Fi AM, we will discuss our Yahoo Finance Company of the Decade and our CEO of the Decade. Welcome back to Wi-Fi AN. Last week, we revealed our 2019 Company of the Year. It was Target. But as the 2010s come to a close, the Yahoo Finance editors also chose a Company of the Decade, and our pick was the Walt Disney Company. Disney, since 2010, has done the following: acquired Lucasfilm, acquired Fox, put out 24 films that topped $1 billion at the global box office. And by the way, that's more than half the number of all the billion-dollar films there have ever been. It also entered the streaming wars with an exclamation point with Disney Plus this month, one of 3 OTT platforms that Disney now owns, along with ESPN Plus and Hulu. And that was all on the media side. Disney also opened Disneyland Shanghai in the last decade. It is 11 times the physical size of Disneyland in California, and Disney Parks revenue has doubled in the decade. So what do you guys think?
If you invested in Disney 10 years ago, you would have been super, super rich.
Although,
50%.
that said,
300%.
and as you know, you did the top stocks of the decade. Disney not in the top 10.
Didn't
not even in the
make
top
it.
20 of the top stocks. But man, what the company has accomplished, wild. And certainly the stock has done very, very, very well.
No, and when you
last
look at the chart, it's a nice uptrend. There's no break below levels. It's great. So as an investor, it looks good. But like you mentioned, so many accomplishments. I started to read the Bob Iger autobiography after we talked about it on the show several weeks ago on the plane yesterday, and I was so taken aback by just how much Bob Iger has been able to accomplish at the helm.
It's also very candid.
Yeah.
And certainly I'm not one. I'm not one to pump CEO memoirs. I think
Right.
usually they're trashy and kind of self-serving, and it's just mostly fake, and it's written by someone else. But the Iger book is very interesting, very open.
Well, he's being pretty well compensated by Disney for his job there as
Absolutely.
well. It's not
Controversial,
He's
his
not
pay.
being paid for right. Exactly.
$65 million in 2018.
Yeah, the CEO pay ratio is ridiculous for Disney. But I think that the question going forward is going to be, can they continue to churn out content and titles that can keep the growth trajectory going, right? I mean, there have been a lot of questions, not just in 2019, in 2015, in 2011, about whether or not they were just recycling the same old titles. I mean, we find ourselves
Those questions
talking
are
about
still
it with
there.
Frozen 2. Oh, well, okay, yeah, Frozen was a smash hit, but how much can you continue to milk the same titles over and over again? In a way, Disney Plus is just rehashing nostalgia
Yes.
by recycling those old titles.
But you
Is
can
that
get a
good
long
approach?
way just on that. I mean, look at the
So,
numbers. But I agree with you. That's the question moving forward. Even all the new stuff, in a sense, is old.
Right.
Yeah, Star Wars.
Because it's all part of a franchise that everyone knows and loves, right? I had this debate with my friends, as we were talking about earlier, when I was back at home in California over the past week, and I am just fatigued. I am Disneyed out. I'm Marveled out. I'm Star Wars out. I have no interest in getting as excited as I used to for a new Avengers film. Now, it's over, but the new Marvel movie. Like, there's an origin story, there's a sequel, there's an Avengers film all in one year, and you just don't have that same amount of excitement to go to the theater.
Well, and who has
to
the
watch
time
it.
to watch all this stuff? I mean, there's a Loki show coming. There's Falcon and the Winter Soldier show coming. There's a Black Widow origin story, and without spoiling, but it's been long enough. If you see an Endgame, you're like, I'm going to watch a movie about that character now.
And that's a whole studio house that they had to buy. They didn't come up with that themselves. They had to buy Marvel at a really high premium. That's paid off.
2009.
But they still had to buy it. So it's, is M&A the game going forward? Maybe that's the answer.
Yeah,
buying
I
stuff.
think nostalgia will get you only so far, and then we'll see what happens. But I will say Disney Plus has had a lot of good stuff over the holidays to watch. But you're right. Well, the nostalgia lasts long enough against Netflix. Now, Disney was our company of the decade, but we also looked at the most impressive business leadership of the decade, and Yahoo Finance landed on Netflix's Reed Hastings as our CEO of the decade. For starters, there's the stock. Netflix shares rose 3,700%. That's 3,700%. In the decade, it was the #1 best performing stock of the decade. And Hastings himself pulled off 2 distinct major reinventions in the 2010s. First, bringing Netflix from a sender of DVDs in the mail to a streaming company. Then, going from a place where all the content was licensed content, that is, stuff made by others, to original content. And consider this fact. This is very telling. Netflix this year got 34 Golden Globe nominations. The big 3 networks, ABC, CBS, NBC, got 0.
But Dan, aren't you one who makes this argument, like, do these awards even matter at
No.
the end of the day,
They
right?
don't, yeah.
No.
It's just for
There's prestige.
for bragging rights.
But no.
Yeah.
But I think it illustrates just how much original content Netflix is putting out. There's also a chart that our colleague Melody Hom wrote up that shows that in 2019, Netflix produced more original things, either I believe it's shows plus movies, than all other content from someone other than Netflix, like in some year recently. like 2012 or something, some recent year.
Well, look, the stock is up.
It's crazy.
4,000% over the last 10 years. I've never seen a comma on this full screen
I
before.
know.
I mean, that's insane.
Yeah.
I think the story with Netflix, again, kind of talking about the trajectory going forward, is really going to be about whether or not their current level of spending is going to be sustainable in the future. They are throwing a lot of money into the hole to make this content. When you talk about The Irishman, single-handedly, that one movie was a huge chunk of money to make with all those stars.
Well, and I thought they could have had it in theaters longer
Right,
before bringing it
but
on
I
to
think
Netflix.
the most interesting corporate debt stories for the next 10 years, I think, is going to be Netflix and Tesla. Because what we see right now is that the appetite is there for buyers of their corporate debt. It's fine because they say, okay, well, it's great that Netflix is able to continue to grow. If they continue to just feed the beast, maybe they can take over the streaming space. The same with Tesla when it comes to electric vehicles. But will that be the story? Will there still be the same competitors, or will there be new competitors in the space 5 to 10 years from now? That's going to be the
But
question.
even with Netflix and Tesla, Brian, do you think that there has to be one winner? There doesn't. They just have to find a way
Yeah,
to
so it's not zero-sum
sustainably
game.
survive in an environment where it's highly competitive. As we know, the streaming wars are not going away, right?
Right.
We have big players in the space. There are going to be new entrants into the space as well. And a lot of people are divided, right? Is Netflix going to survive against Disney, against Apple, against Amazon? At the end of the day, it's going to be fine. It may not just surge 4,000% in 10 years, but it's not going anywhere anytime soon.
I do think some of the others might go away.
Like
Some of the new entrants that haven't launched yet.
Oh, they have
some of
to
the
do-
existing ones. We've already seen one. Sony shut down View.
Oh, right.
There has to be
View.
consolidation. There's too many apps for people to download.
It's
There's
kind of
just
like
too
the
many.
food delivery space, right? Too many competitors in the space. You have to consolidate.
Absolutely.
Or to get very meta, you were just saying there's too much of the new Disney content to even watch, the Marvel and Star Wars stuff. So similarly, you can't pay for all these streaming apps. Now the retort to that, because we were just discussing that last week with a Netflix analyst, I said, soon people are going to decide I can't pay for so many of these things.
Well,
he said, well, the advantage each has is if there's a show that you want to watch, you have to pay for the app that has it. Like there isn't yet an app of the apps that allows you
Apple
to...
TV is trying to be that, but the pay structure
They're
is
going to bundle...
Wait, guys, when are they going to start cracking down on people using other people's accounts? Because
Ah,
that
they've
might be a
begun
game
doing
changer,
that a
right?
little bit.
I know you're guilty.
I'm guilty.
We
of
all are.
this.
That's called cord cheating.
We're cheating.
Love cord cheating. All right, let's talk about Uber. The founder and former CEO of Uber has severed his final ties with the company. Travis Kalanick has stepped down from Uber's board of directors. He said in a statement that he plans to shift his focus to his current business. Kalanick was forced to step down as CEO back in 2017, and I believe he has sold the last of his stock, right?
Yeah, today, supposedly.
His
Completely
final
exited.
financial ties to the company. Now, by the way, Kalanick's recent activities suggest that he'll be focusing on his startup Cloud Kitchens. It rents out kitchen space for restaurants that only deliver.
Very, very interesting to me. Because
it?
that is a huge, huge bet on the food delivery space.
Yeah.
Saying that that's where all the money's going to be in the future. That's where I'm going to put my bet. But if you think about it, right, a lot of these delivery-only companies, they get to save a lot of money. So if you think about the potential for cloud kitchens, as long as people continue to order food delivery, it could be pretty lucrative.
I think it's a smart way to
Or it
hedge
could
against the risk.
wildly
exactly,
fail.
or it could be a huge failure.
But it's a good way to hedge against a bet on the delivery space, because what we've seen is that the margins on actually delivering food are not so great from Seamless and Uber Eats and whatnot. But actually trying to invest in the kitchens that will make the food for delivery is maybe a good, interesting way to invest in it without the direct risk of just the terrible margins.
But
that
you
exist
still have
in
the
it.
risk, because if these are restaurants that only deliver, they don't have seating in the restaurant, and the delivery
trying to
apps
capitalize.
don't work out, then how are they going to deliver?
But at the end of the day, there's still what we've seen though is that there's still immense demand to not go out to eat. Right? People still put in the orders. The problem is that the economics of actually delivering it have not worked out yet. So I think that's what they're trying to maybe get around. Maybe there's some future vision that Travis Kalanick has for cloud kitchens where they can make better margins on the delivery part of it too, but it's not a direct investment in that. Interesting to see though that the Uber stock is down on a positive day, not by a lot, but it shows that maybe it's already baked into the price. It had a pretty precipitous fall when the lockup released earlier this year. But I think Travis Kalanick had already unloaded, 90% of his shares before today. So we've probably already seen that priced in. But to see the original founder of the company dip out, I think is an interesting narrative.
So we'll launch our Chung's Kitchen restaurant on Cloud Kitchens in
a lot of
2020.
food
What are we gonna make?
content
Chungberts,
coming.
what will we serve?
I don't know. Who knows what 2020 has to offer?
All right, we'll talk off camera. Maybe chicken sandwich. We'll enter the chicken
Oh,
sandwich.
I want to leave
Done
that in
already.
2019.
Done already.
Oh, okay. All right, coming up here on Wi-Fi AM, how China is struggling to keep up with the EV boom. We will discuss.
All right, welcome back to Wi-Fi AM. I'm Scott Gamm on the floor of the New York Stock Exchange, joined now by Matthew Cheslock with Virtu Financial. Okay, so light volume, holiday week, stocks at record highs. Is there anything in the near term that could disrupt the gains we've seen over the past month or so?
Yeah, I mean, there's always stuff that's out there, but historically, the 5 days that follow Christmas are historically pretty good, you know, and we average about 1%, 1.3% gains on it. And if we hit those, then we're going to be up almost 30% for the year, and that's going to be a strong year. So is there anything to upset the apple cart over the next 4 or 5 days? Probably not. But in the horizon, there's potentially a lot out there, whether it's North Korea, which is now raising its head again, whether we're going to get the Senate and what they're going to do with Trump. And we have the election to look forward to at the end of the year. So there's a lot in 2020 to keep an eye on.
So in terms of positioning, I guess how should people do that heading into the new year?
Well, it's hard to get away from what's worked for so long. I mean, technology's been the strongest and the most profitable for so many years. Why would you get out of that right now? There's no signs that technology is going to change. You know, some of the other names that, you know, banks have been strong recently. Energy's picking up its head here. Oil above 60 pretty solidly now. So there may be some chances to move your money out of some sector that maybe hasn't worked as well into those more safe sectors as far as returns go. You know, one stock that's really suffered in 2019 was Boeing for obvious reasons. That was a big gainer in 2017 and 18. So there is going to be a stock like that in 2020. I just don't know what it's going to be.
Well, I'm glad you brought up Boeing, because that, and you could even argue Amazon, right? Amazon is at $1,800 a share. Earlier, it was at $2,000. So if those two stocks could get any kind of a bid, I mean, imagine what that would do to the broader market.
Yeah, I mean, the broader market was affected so greatly by Boeing's historic run for so long, and that really hasn't participated. So as you mentioned, if Amazon has record numbers with the numbers that they posted for this holiday season, and that actually provides some traction for the stock to break above 2,000 on a sustainable basis, you know, that is, again, a technology stock for the most part that will take this market higher.
And if you look back at the past couple of times that the broader market was at record highs, one of the key ingredients was Amazon above $2,000 a share. And we've been able to get to records without that over the past couple of months.
Yeah, you know, we've seen, of course, Microsoft, Apple. I mean, some of these big names, Tesla, some of these big names that people are so enamored with are now at record highs every single day, and that's without Amazon. So if you start adding another FANG name involved in there, why not see the market go higher?
Got about 20 seconds left. I think one of the big surprises in 2019 was the fact that fixed income worked so well. Do you see that trend unraveling in 2020?
No, I mean, the Fed is going to be, the Fed threw us a pivot, you know, midway through the year when instead of raising rates, they started cutting rates. So it was attractive. They provided some volatility in the fixed income that we probably haven't seen before. That always provides for profitable trades.
All right, Matt Cheslock, thank you so much. Stay with us, Wi-Fi AM. We'll be right back after this.
Welcome back to Wi-Fi AM. VCs are pouring billions of dollars into the emerging electric vehicle industry in China. But despite the backing of the Chinese government, the electric car makers there are struggling as the nation's economic growth slows and subsidies are being phased out, as CNBC reports today. For one example, shares of NIO, China's closest competitor to Tesla, are down 50% this year. Woo! So China wants in on that EV boom, and obviously Tesla, as we know, doing very well in China. But I don't know that Chinese EV names are doing well. They're not
They are
keeping up.
They are not. Look at that chart. It's not a good-looking chart. But that being said, Tesla, remember, is planning to open up that Shanghai Gigafactory very, very soon. And if they do that, that cuts the cost for them in terms of importing or exporting their vehicles to China. That might be even worse for companies like
Yeah, I was going to say it's done already.
Yeah,
Their plan
they
is
opened
done.
it already. Their
They've
plan is to open
already
the European
Yeah,
one.
well, they haven't actually started the line yet because they still need to get some approval from the Chinese government. But I mean, it's done already. So I was going to say, like, basically, it's too late for any other game in China. The factory's already done. I think one thing though to watch is these large automakers that are partnering up with one another to develop autonomous and also electric vehicle technology. One example being Ford and Volkswagen, right? So not necessarily in China, but when you consider that China is one of the biggest markets for Volkswagen, Ford and Volkswagen teaming up to try to build an electric vehicle is pretty big for the Chinese market. So it's not necessarily the Chinese vehicle makers that might be then worth watching in China. It's going to be all those global manufacturers really trying to invest into that huge automotive market.
And of course, the EV company is just one example of the very interesting story that will continue in 2020, which is U.S. companies doing business in China, ignoring what is going on. Now, of course, we have that phase one deal. But a lot of those brands that people said, oh, watch out, they are going to see dips in China, didn't really. Nike, Apple,
Right, well,
Starbucks.
And that really came into focus too during the Hong Kong protests when we saw some companies not necessarily take a stand in some cases, but just by sheer virtue of listing on the back of a T-shirt that it's Hong Kong instead of Hong Kong, China, that they would get dragged
Versace,
into.
right?
Right, and they would get dragged into the spotlight here in the United States, in the Western world, over what the business ties were to China. And I think that was a really constructive exercise. What we've seen, though, I think, is that kind of fizzled out. People don't really care. I think that there was some activism in terms of maybe trying to boycott some of these companies that wouldn't stand up in terms of human rights problems in China, but it just hasn't been the case.
Oh, look at the NBA. There's a little bit of an overhang there, but yeah.
But they're still airing games, right? Remember, they stopped airing the preseason games?
CCTV has not started airing games again. Tencent.
Right.
It's still blacked out, yeah.
Right, but to your point, companies are still mentioning the fact that the Hong Kong protests are affecting their business. Remember, we ran through that really long list of companies
Canada
that
Goose.
mentioned it on. Exactly. So at the end of the day, it does matter, and China will always matter to U.S. listed companies.
Right. All right. It will continue to be a story. Coming up here on Wi-Fi AM, Burning Man sues the U.S. government. Sick burn, man. We'll discuss.
What's the story?
Welcome back to Wi-Fi AM. Well, the new year will mean big changes for Medicare, and Yahoo Finance's Anjali Kemlani can tell us more. What will change with Medicare?
Lots of really fun things. Actually, this is stuff that the industry has been really excited about for some time. So it includes things like paying for supplemental benefits. And so they're trying to force sort of the private insurance plans to carry forward things like paying for air conditioning or mold removal or modifying homes for seniors to be more comfortable. So that's a really big deal. And it's something that focuses on social determinants of health, which is like an industry buzzword right now that is really ramping up. So, it's going to be really interesting. And then there's also stuff about just trying to pay for healthcare better. So rather than just constantly sending people, into the hospital, they're trying to keep more seniors at home.
Telemedicine
comes into play. And this is actually part of Trump's executive order back in October, where he's really pushing for more coverage of Medicare. Now, it all sounds great, but on the flip side, this sort of becomes like the testing ground for Medicare for All. Can, in fact, the government cover all these services?
Right. Now, in terms of the implementation of this, help us understand exactly where this is coming from. Is this CMS or HHS that's putting these changes into place? You mentioned
CMS.
The president. Okay.
Mm-hmm. Yeah, so CMS is starting with some of these directives for 2020, and then the executive order is actually going to push ahead for the next year to start trying to plan out some things, especially like more telehealth, trying to increase the market rates, more plan choices, eliminate waste and fraud, and just remove burdensome regulations.
Right, so those changes aren't immediate.
Not a lot of them, yeah, but some of them are going to be coming in 2020 for sure.
Remaking Medicare.
Yes.
Wait, so when does this all go into effect exactly?
In 2020.
Just sometime in 2020 or at the start of 2020?
Start of 2020.
Okay.
What's the biggest driver of costs when we talk about Medicare?
So that's a really good one. Kidney care. So seniors who are on dialysis is a really big one. So right now, Medicare is spending $114 billion annually, or about $90,000 per person for those using dialysis. And so that is another thing that the executive order is actually pushing for, is to try and reduce the incentive for dialysis and really push for in-home care and kidney transplants. And this is really good news for companies like Fresenius and DaVita. Obviously, their stocks boosted the day that this was announced, and they're looking at really trying to make the whole system more efficient.
All right. Well, this was a Trump plan that is coming to fruition in some ways.
Absolutely. Yep.
I mean, this is can he put this on the list of things I accomplished?
I would say safely yes.
All right. Going to be very interesting when it comes to the presidential campaign, too. I'm sure Medicare will get mentioned. Anjali, thanks so much.
Of course.
Thanks for coming on. Happy holidays.
Happy holidays.
All right. Organizers of Burning Man have sued the U.S. Bureau of Land Management, claiming that they were cheated out of millions. Heidi, the nonprofit behind Burning Man, which of course happens every year out in the Nevada desert, says that the U.S. government overcharged them in land use fees for the last 7 years. And now they want relief from the government's, quote, ongoing unlawful prejudicial conduct. They would like to recoup some of that money. And lawyers for the government have not yet responded to the suit. So it's Burning Man versus Land Management Bureau.
So aside from the ticket price, which I know is quite pricey, I wonder how they make money over at Burning Man, because a lot of the stuff is bartered.
Merch?
Well,
right?
I guess so, but
merch?
a lot of the stuff that you're purchasing, like
look,
toilet
from
paper
Spirited Away.
or all the necessities that you need while you're out in the desert for however many days, you're bartering with other folks that are there. So in terms of what they're actually making a profit on is questionable to me, and so it makes sense. They're like, hey, we're overpaying.
And
for
they've
all
got to
this
pay the
land.
artists.
Exactly.
I just love the irony of something that's anti-establishment but still neoliberal, using bureaucracy to try to, figure out a resolution to this, to land use especially. I mean,
love it.
It's hilarious to me.
There's so many ironies. It's also a nonprofit behind Burning Man, which you may not have known. I didn't know that.
I had no idea.
I didn't realize it's all bartering.
It's
So
it's
is
all
it like
bartering.
is it cashless?
So you have to bring something that you can offer other people.
Drugs.
Well, drugs, and you can. Well, some folks do like
water,
I'll give you a massage in exchange for toilet paper or wet wipes or whatever it may be. Any necessity you need, because you're not showering or anything for a really long time.
I wonder if in 2019 Burning Man is maybe not as relevant.
Hey, Ray Dalio goes to Burning Man.
A
Okay,
lot of these billionaires are going.
that's like their
Does
new
it
thing.
fit with where things are going in this country?
Maybe you could say that it fits perfectly with where things are going in this country.
The Burning Man I prefer,
Which is?
the country song by
I don't.
Dierks Bentley. Come on, man.
Country? Do we look like we listen to country?
We're not really big on country.
All right, Dierks Bentley's newest album is called Burning Man. Good album, good song.
Gotta give it a listen, I guess.
All right, we'll move on from there. But interesting, we will keep tracking that lawsuit, the Burning Man lawsuit. Maybe soon we'll get a dueling Hulu and Netflix documentaries
Oh, that would be so good.
That would be
about
good.
the Burning Man.
Yeah.
What would the
Burning
title?
Mans.
Burning suit. Burning case. Burning.
We'll workshop
Suits on
it.
fire.
How about suing man?
Oh my gosh.
It needs some work.
All right. We'll be right back here at Wi-Fi AM after a quick break. Don't leave us. Welcome back to Wi-Fi AM. Well, Star Wars: The Rise of Skywalker did very well in theaters on Christmas after a maybe disappointing start initially when it first came out. Rise of Skywalker brought in $35 million over Christmas. It made it the second best performing film ever on Christmas at the US box office, second to another Star Wars movie, The Force Awakens, which of course topped, I believe, yes, $2 billion at the global box office. I do not think Rise of Skywalker is headed for that level, but it will likely make it to $1 billion. I saw Rise of Skywalker. I thought it was good. I thought it was fine.
Horrible movie.
Oh, all the bad reviews.
It moved
I mostly
way too
think
quickly.
there are these fanboys who go and they're watching, that doesn't make sense, that's a problem. It's like, if you've watched the first two, or are you really sitting there for 2 hours, 20 minutes not enjoying it? Like all the people who had problems with it, did they really not enjoy it for 2.5 hours? Did they sit there going, this sucks?
No,
it was fine. It was fun.
It was entertaining, but let's
Yeah.
not pretend like it was a good movie. The plot line moved way too fast.
It
But there
was
were
fun.
moments.
What did you want
there were
to see
moments,
happen?
I saw it in a full theater, and there were moments, multiple moments, during
Yeah,
the, where the entire theater
kiss.
just gasped.
The
They were
kiss.
like, they were saying, yeah. Well, there was one
Spoil-
romantic scene. There
I'll
was
just
another
say the
plot
kiss.
twist. And in both of those moments,
people laughed out loud at
everyone
the kiss.
laughed out loud.
That
That
was
is
a
not-
problem.
that's not a-
Otherwise, I thought it was fine.
sorry,
Now,
Heidi didn't see it.
Were there lightsabers?
There were a few.
in the movie?
Yeah, were there?
Oh, they
okay, then I'm
played
sure Star
prominently.
Wars fans were excited and thrilled to watch the film.
I had a
think,
fine
to
time.
Dan's point, if you're a Star Wars fan, you're gonna go watch it. You're gonna enjoy it for all the Star Wars.
There were some great emotional moments, like with Chewbacca.
Well, as a Star Wars fanboy, I was
R2-D2
extremely
and-
disappointed. It was.
All right. Now we have to leave time to talk about Little Women. It also did very well at the box office. It brought in $7 million. Not Star Wars numbers, but for fair to call it an indie? Or no? Is that an indie picture?
Is
Maybe
it?
not.
I don't think so.
Greta Gerwig written. It's a Sony picture, not indie, but $7 million, very good for Christmas. And I am among that $7 million. I saw it on Christmas Day.
Wait, how many films did you watch this past week?
Yeah, I was gonna say you watched a lot of
You watched
movies.
everything.
What was the best one that you
We
saw? Was
saw-
Little Women the top?
Is that Emma
Of
Watson?
the year? No, Parasite was the movie of the year.
Oh no, I mean of the past few days. I mean,
Wait,
this-
guys.
Well, Muppet Christmas Carol was great.
So Parasite was your favorite movie of 2019, but as we wrap up the decade, what was the standout film for you?
The best film.
Avengers Infinity War and then Avengers Endgame.
Mine was Inception.
Marvel defined the decade
Interstellar.
at the box office.
Interstellar over Inception?
What?
Yes, so
Interstellar?
great. Oh my gosh,
we
Matthew
gotta wrap the
McConaughey
show.
was So good.
That's a hot take.
Get it.
That's a Inception
You guys just
was
couldn't understand it.
superior.
You guys just couldn't understand it. It's all right.
You're
I
like
understand. I get-
dimensions. I love it.
Oh, space.
guys.
The final frontier. Okay.
Oh no, Interstellar, the movie of the decade.
I did cry
Murph,
though. I
Murph.
did cry. Okay.
Heidi?
Inception.
Oh, so big Christopher Nolan.
Yeah,
props here.
huge fan.
Have you guys seen the trailer
Tenet.
for his next movie, Tenet?
Did you
Oh,
hear?
am I excited?
A theater in Los Angeles accidentally played 6 minutes of the new film
Wait, what?
ahead of Star Wars.
Yeah, I was gonna say it's done already.
It's
Really?
crazy. Yeah, there was. Yeah, I read an
I
article.
saw a great tweet. They showed Catherine Debicki, or Elizabeth Debicki is her name. She's been in a bunch of other stuff. You'd recognize her. But she's in the trailer and she's looking forlornly on a boat. And someone tweeted it and goes, her character's definitely already dead in the movie. There's no way.
It's Christopher Nolan.
That's so
Yeah,
Christopher
probably.
Nolan.
Yeah, it is.
All right. Well, thank you guys and happy day after Christmas. That is Wi-Fi AM for today. Thanks for watching. We will be back here tomorrow at 10 a.m. So don't miss that. But On the Move is next at 11. So stay right here on YahooFinance.com to watch On the Move.
Happy day after Christmas, 11 o'clock here in New York City, 90 minutes into the trading day. Stocks are trading higher right now. We're going to jump into that. Holiday shopping boom. Early data shows online sales hit record highs over the holiday season. Plus, what's next for Boeing? How that company's new CEO plans to make nice with the FAA. And moving forward, how a new crop of voting members could reshape Federal Reserve policy in 2020. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for joining us. Well, so much for all those warnings about a shortened holiday shopping season. The strong U.S. consumer spent big in the run-up to Christmas. Overall holiday retail sales between November 1st and December 24th rose more than 3%. That's according to data from MasterCard's Spending Pulse report. Online sales soared. They were a big part of all of this, up 18.8% from the 2018 holiday shopping season, or 14.6% of total retail sales over that period. We should mention that excludes autos. Yahoo Finance's Jared Blickery and Dan Roberts are here with us for the hour, and Brian Sozzi joins us now with the biggest winners and losers of the retail shopping season.
Yeah.
So maybe not a big surprise that we saw that 3.4% pop, right?
No, well, the holiday season started off in a very strong note. Black Friday, Thanksgiving, Cyber Monday, they were all big days. So you read the tea leaves, you knew it was going to turn out pretty well. Where I think a lot of people, we were just talking about this last week, will be surprised by the margins for some of these companies. I think to get these sales, there was a lot of aggressive discounting out there, mainly because the weather was warm for the most part throughout the country. Also 6 fewer days in the shopping season.
Okay, so we'll see the earnings reports. Yep. But you just brought up the other issue, because we're all making a big deal out of online, and clearly online is where the future. It's not the future. It's just everything's going to go there. Still, it was barely 15% of total retail sales, and the fact that we were 6 days shorter, a lot of people actually had to go online to get the stuff in time.
Yeah, and that's why I think you're going to come out and you're going to see these earnings reports start to hit late February, early March, and you will hear a lot more store closures. They're coming, people, and they're probably coming in a big way, mainly from the department stores. Looking at JCPenney, looking at Macy's.
I do wonder, though, if the takeaway from that 14.6%, I know it's going to rise, but I did think that sounded small to me.
Yeah.
And so I took that to mean that, as we often discuss, the death of brick and mortar has been a little bit exaggerated. I mean, a lot of stores are still out there and needed.
But a caveat with that number, it's my understanding that that number does not include online sales from the brick and mortar retailers.
Also, you're
right?
also coming
am I right?
So that's online only businesses?
So that doesn't include Target and Walmart?
That's just online only. That is just online only.
So DTC businesses.
Yes, so that does not capture the online sales from Walmart and Target.
And it's a useless figure.
All of the rest.
But you're also got to keep in mind, you're coming off some big numbers over the past 3 or 4 or 5 years. If you dig into some of the numbers that I suspect a lot of retailers will provide on mobile shopping, I think those growth rates will really surprise people to the positive when you get on these earnings calls.
We're also, by the way, I just point out, you've probably seen your inboxes. We're all getting inundated right now with, okay, let's clear the inventory, sale, sale, sale. That's all going to be online because it's in your inbox. Who's going to actually go to a Macy's when you can just do it online?
Yeah, that makes a lot of sense. And you look at the winners and losers in retail this year, it's been, there's a different picture depending on where you start exactly from what time, but looking from September through the end of the year, I was just talking with Brian about Bed Bath & Beyond, for instance, the other day. This company, which was in the sewer, has really turned it around here. There was reports that they were going to get a new CFO. I don't think that's correct, but completely new management team from Target. Is that right?
Yeah, that's just a complete operational overhaul. But the winners and losers has been, you're seeing power consolidated in the hands of Amazon, which had a really strong release today. We don't know the actual sales numbers, but to see 5 million free and paid Prime members really stood out to me as very important. Walmart, Amazon, Target, and power retailers, Macy's, JCPenney, and Abercrombie & Fitch, American Eagle, those names have struggled.
Gap.
And Gap
was one of the worst performers in the S&P this year, so down something like 30%.
But JCPenney up 26.5% this quarter.
Yes, but from what level?
Well, you got to start somewhere.
Now it's a pennies stock instead of a penny stock.
Even the apparel retailers doing well, like at Abercrombie & Fitch, their business has turned. The market doesn't want to warm up to these names. It's still it's challenging out there.
I did. You guys have the experience just quickly over the holidays of the most positive experience with receiving and giving gifts was from businesses that are omni-channel. So places where you may have bought something online, well, you need to return something, well, there's a store near you and you can return in store. All these companies that offer both need to offer both in every possible way. Whether it's you buy it in store, then you ship it back, you return it in store. You buy online, you get credit, whatever. It needs to be easy and simple.
All right, well, talking about easy and simple, how about expensive? Jewelry, Tiffany's. We're going to stick with retail because Tiffany & Company got a big boost in holiday sales from customers in China. Scott Gamm is on the floor of the New York Stock Exchange with more on this. And actually, the numbers that we're talking about actually surprised quite a few people regarding Tiffany, right?
Well, that's right, Adam. And just more broadly for Tiffany, according to their preliminary data, they say that sales overall for Tiffany rose between 1 and 3%.
Yes, I know.
During the holiday period. Now, when you mentioned China, they did see a double-digit gain in sales out of mainland China, which is important because it helped to offset some of the declines they saw out of Hong Kong. And we know there have been protests in Hong Kong over the past several months. Now, Tiffany's stock not really doing much on this news, and the stock hasn't really done much over the past month, ever since it agreed to be acquired by LVMH for $16 billion. And staying with this holiday theme, we're also keeping an eye on shares of Amazon. That stock up 2% right now, crossing $1,800 a share. The company says that tens of millions of Amazon devices were sold during the holiday season. They also say that shoppers shopped at record levels during the holiday season as well. And then outside of that, we're also watching Boeing shares. The stock is down right now. Obviously, a lot going on with Boeing this week, with CEO Dennis Muilenburg resigning earlier on Monday amid the broader 737 MAX crisis. It's interesting, though, Boeing's stock for 2019 is up 2.5%. As long as the stock stays above $322 a share, it'll remain in the green for 2019. Right now, Boeing is just over $331, guys.
Thanks, Scott. And speaking of Boeing, incoming Boeing CEO David Calhoun faces a number of challenges, of course, when he formally takes his post next month. They include the continued crisis caused by those 2 fatal crashes of Boeing's 737 MAX jetliner, as well as friction with regulators over returning the grounded planes to the skies. New documents reviewed by congressional panel show some, quote, very disturbing revelations regarding the 737 MAX jet, although we don't have the details of them. One of Calhoun's first priorities is mending Boeing's relationship with the FAA. So let's talk a little bit more about that. I mean, it's interesting that he is trying to mend his relationship with the FAA because there's been criticism of the FAA itself. So
yes.
How does Boeing sort of go forward here?
This is going to be difficult. There are questions surrounding the timing of Muilenburg's resignation earlier this week, and I think it has to do with these new revelations that are only coming about now. And this is going to take a lot of work to repair this relationship, and also the relationship with the public. These statements that are going to come out, and again, yeah, we don't know the details, but I think these are very damning statements about not only the company, but its relationship with the FAA.
But Calhoun will be able to say that was then,
right.
This is now going forward. It's going to be, when we learn what's in those emails, you're talking about the emails from the chief test pilot at Boeing. They turned over more to not only to the federal investigators, but now the FAA. The FAA not happy that it took so long to get them. At the end of the day, we're expecting the 737 MAX to be back in the air. United is saying maybe June, but we know they're going at it on a month-by-month basis. But Boeing has been in touch with the airlines, preparing for them for the return of the aircraft. It's just the FAA that they're waiting for.
Yeah, it's just a matter of when. But let's make sure we give the caveat. The 737 MAXs that are ready and finished and existed already will eventually go back in the air. But reports that they won't produce any new ones. That production will, for a while it was, production will be halted. Now it sounds like production will be stopped. I mean, this is not going to be an easy CEO job at all. I mean, I remember when Wells took about a year to find a new CEO, and then finally the former CEO of Visa, Charlie Scharf, went over to Wells Fargo, and we were all joking like, that is not a very desirable post right now. Well, Boeing probably less desirable. Now, all that being said, Boeing is not going anywhere. And I think that when we discuss all the problems, and they're extremely important, and the problems are major, and disturbing is the word being used for these messages that are now being reviewed, all that being said, we forget that there are a ton of other Boeing planes that are used all over the world, that Boeing is in many ways too big to fail. I mean, its closest competitor, Airbus, is nowhere close in terms of the number of planes that are in use for commercial flights. I just think that, yes, it's going to be a hard path for this new CEO, but look at Boeing stock. I mean, a lot of people thought that it should be down much more than it is. I know it is, it underperformed the S&P by a big margin this year, but man, people thought it would have taken a much bigger hit in 2019. Look at that chart.
I think it is possible, though. It's at least possible that things could still get worse before they get better.
I think so.
Once we get Adam, when you say, well, the new CEO is going to be able to say, well, that was then, this is now, I think that's going to be a hard narrative for him to put forth if they get these emails out, because then that shows where there's systemic issues at Boeing in terms of quality control. Have they really addressed those does changing the CEO really help all down the line that they've already made.
Well,
those
he'll get called before Congress again.
Yeah,
we know
I
that's
mean,
going to
at
happen.
least it's
And he will
someone outside.
say, and then he will, and yeah, Calhoun will say, here's what we
Leaving
took in
Blackstone.
place when they talk about those emails.
Wait for some
this is what
criminal
we've done.
culpability as well. I don't think we've seen anything close to the end of this, especially with these latest allegations. I think this company was designed like a bureaucracy so that these messages and this information couldn't rise to the top. And that's why I think there's criminal culpability here. Muhlenberg's probably going to get clawed back. He got away with something like a $30 million golden parachute. That's going to get clawed back. He'll be lucky if he doesn't go to jail.
Wow.
That's an interesting prediction. We're going to keep you on that one. But right now, 4 regional Fed chiefs are set to join the Federal Reserve's rate-setting panel in January. Voting slots at the Fed rotate each year, but will a new group bring more or less consensus over rate decisions in 2020? Yahoo Finance's Fed head Brian Chung joins us now. We're talking about the Doves and the Hawks.
That's right. So as a reminder, we have the Fed board members, right? Jerome Powell, Rich Clarida, Lael Brainerd, 2 other members. They're in D.C. They have permanent voting, votes in the FOMC. Excuse me, but there are 12 Federal Reserve Bank presidents that are scattered across the country. They represent different regions of the country, but only 4 of them each year actually have votes. Now, all 12 of them participate in the meetings that we have every 6 weeks. They talk, they have a robust discussion, but only 4 of those presidents ultimately end up voting. With the calendar year now flipping to 2020, we're going to have 4 new characters on the board. So they are Loretta Mester from Cleveland. There's also Robert Kaplan from Dallas. There's also Minneapolis Fed President Neel Kashkari, and then Philadelphia Fed President Patrick Harker. In terms of where their ideologies lie, Neel Kashkari, no surprise to anyone, is perceived to be a dove. He has argued for even more aggressive rate cutting to let the labor market tighten. But then on the other hand, you have Loretta Mester, who I had the chance to speak with in Jackson Hole, who has actually argued against some of the rate cuts that we saw this year, saying she would prefer to see what the actual impact of the trade negotiations are on the economy in terms of a possible negative impact. So this is going to be interesting. What we do know is that from the dot plot projection that we got from the Fed meeting a few weeks ago, all the members seem to be on the same page that for right now it seems appropriate to at least hold at the current level of 1.5 to 1.75 at least through 2020.
I mean, it's interesting. Somebody like Kashkari has talked about wanting to keep rates low unless we really see a significant uptick in inflation. So it seems like there's nothing on this change to the composition of the voting members that would change the trajectory of the Fed.
And that's exactly right. You could almost compare him to being the member of the board that was most dovish on the last FOMC, currently 2019, which is James Bullard from St. Louis. In one meeting, you'll remember that he actually dissented from a decision to cut by 25 basis points because he actually wanted 50 basis points of cuts in that particular meeting. So Kashkari could be seen as basically the same voice, replace and replace out.
But if the president finally does submit his 2 nominees to the Senate for approval to the Board of Governors, and we know the president wants lower interest rates, the president even talked about negative interest rates.
Yeah.
Judy Shelton had actually in public statements almost appeared as if she would follow what the president was
by
pushing
cutting
for.
rates. Yeah, exactly. Now, Chris Waller, who's the other nominee, and Judy Shelton, their nominations have not been sent to the Senate. We're heading into an election year next year. The Senate is about to take on an impeachment trial, so whether or not they even have the bandwidth to get those nominees confirmed is going to be one thing. We haven't seen, for what it's worth, all 7 members of all 7 seats of the Board of Governors actually filled in many years. So, it's probably not a lot. There's not a lot of pressure for the administration to get those 2 nominations through, but if that were to be the case, yes, you could argue that that would be a further dovish tilt on the current Federal Reserve.
Yeah, so, all right, so the Fed is on hold right now, really not expected to do anything next year, at least based on where we are right now. It seems like the variable could be what happens with the don't call it QE.
Yeah,
$365 billion so far is the expansion of the balance sheet since September. That's a breakneck pace. How long does that continue? What do these new incoming voting members think about these programs? And there's also a potential standing repo facility as well.
I mean, the real jolt to the re-expansion rather, of the balance sheet was the repo facility that the New York Fed offered by, originally it was this very small amount. They then expanded to the tune of $120 billion a month. What we do know is that the Federal Reserve itself has then started expanding the balance sheet, promising to buy short-term Treasury T-bills at a pace of about $60 billion per month. They said that that's the game plan through the first half of next year, at least through the first half of next year. So at the very least, maybe we could see it extended through the rest of 2020, or maybe on the upside, they could actually increase that pace of purchases in 2020. It really depends on what they're seeing. Jerome Powell has said in press conferences, telling reporters many times that the strategy in terms of the balance sheet is going to be flexible. So it's entirely possible that if more recession worries emerge in 2020, that they then try to actually increase the pace that they're currently buying at. So that's definitely going to be a variable. What's interesting and what's important to note is that the FOMC does have a say in terms of the balance sheet growth. Interest rate policy is the thing that people tend to focus on largely in terms of, are rates going up or down? But the balance sheet is going to be a big part of those discussions as well.
Yeah, definitely. Thanks, Brian. Coming up, markets are at record highs, but how long can the rally last? Our next guest says it won't end next year. Plus, take a look at some of the winners on the Dow right now as we see it and the other major averages push to those records. Apple among them, among the stocks on the rise today.
Welcome back to On the Move. I'm Jared Blickery. We got the Dow not at a record high yet, but it's up 72 points. S&P 500 and NASDAQ are both at record highs. Former's up about 1/3%, and NASDAQ's up about 0.5%. Here's a price action today. Up and away. It's a gap and go. We got pushing in on 3240 here in the S&P 500. Dow Jones Industrial Average closing in on 29,000. Should be an interesting end of the year. Speaking of which, we're still in the Santa Claus rally here. We got a few days left into the end of next week. That'll be the official end, where stocks typically rise 1.3%. You got to take a look at the 10-year T-note yield. This is over the last 10 days. It did reverse course one more time today. Started up, now it's down a little bit and just kind of bouncing off this 1.90 support. The resistance level we're watching is 1.95%. Might get locked in here as we head into the end of the year. I'm not expecting a lot of volatility in the markets. The VIX, for that matter, is at 12.61 right now. We got to take a look at the U.S. dollar index. That is down only slightly, but check this out. We got gold up solidly above $1,516. All of this happened in the last few days without a concomitant really change in interest rates. So I think this breakout is important. Let's take a look at the year to date here, and we can see that we started out, we were kind of basing, and the market took off in June, July, August. It's been kind of going sideways to down here. This could be considered a bull flag, which it is now broken out of. So we'll want to keep an eye on this heading into the new year. So now we're going to take a look at our heat map, and we can see that the Dow is mainly in the green here. Apple, record high, 1.3%. Microsoft, at or near record high, 0.5%. JP Morgan, I'm going to quit saying record high now, but it's at a record high as well, 0.75% up, along with Goldman Sachs. If we look at the sectors that are leading today, we got energy, financials, tech, and communication services. All of these are outperforming, even real estate and discretionary is right now. To the downside, we just have healthcare and industrials slightly in the red. We're going to be right back.
It's been 1 year since the S&P 500, Dow, and NASDAQ all began to recover from what was the worst ever Christmas Eve sell-off. In 2019, all major indexes are up more than 20%, but will the rally last? Joining us to discuss this is Rich Steinberg. He is Chief Market Strategist at the Colony Group. And we want to take a look into 2020. You're forecasting that the S&P 500 will stay in a range between 3,000 and 3,500. Is there any case you could make as to why, and I'm going to be optimistic, we could break out above that?
Yeah, I think the only way we break out above that is if we have a replay of this year where investors are willing just to pay up for earnings. You know, last year earnings were supposed to come in for 2019 at $174. They came in at 165, so you had earnings compression and P expansion. So the only way we could really go above 3,500, in my opinion, is if people feel that there's just no other place to put their money. You know, next year people are looking for 178.5 in earnings. That may be too high, but at 19.5 times multiple, you get to 3,500. So you'd have to really trade at extremely high PE levels in order to get more bullish than where you're at. It could happen if the dollar weakens and earnings surprise to the upside from overseas earnings.
So if it's sort of steady as she goes, range bound, Rich, how do you get a leg up in this market? What do you think will outperform? Are there areas of the market that you think will do better, or is it other assets entirely?
Yeah, I think you have to kind of get paid to wait and see how the economy and election plays out. So I think there's definitely a sense to overweight some some dividend names where you're getting paid 3 or 4% to wait with a total return of 7 to 10% if the markets do okay. And, some sectors are beaten up like financials. So if you start to see a rotation to go back there may be some momentum. Don't forget, you have a lot of algos that are controlling between ETFs and algos. You're looking at 70+% of the market's volume being tied up in those kinds of trades. So momentum works both ways. So I think it's really time to kind of watch money flows and just be smart about what you're willing to pay for that next incremental earnings.
Rich, Jared Blickery here. We talked about your bull case. Let's talk about the bear case. What takes the S&P 500 down to 3,000 or even below that? Number of headwinds out there. You pick them, but what's on your radar?
Yeah, so I would call this like the Goldilocks versus the Three Little Bears scenario. We talked about the Goldilocks, everything kind of being not too hot, not too cold. The Three Bears, the Three Little Bears pigs looks a little bit different, right? It's earnings don't come in. You have earnings compression. If we're at $171, and if you say that you don't get PE expansion because earnings come down from consensus, you get to about 3,000 at 17.5 times. If the first phase of the China deal doesn't look as robust as people think it is right now, that could be an issue. And of course, the bond market could play a little bit of havoc if we go through the 2% level and you have reallocation of macro funds going from stocks back to bonds over the 2% level. I think that's why you stay invested where you are now, knowing that there's probably a little bit of asymmetric downside risk to this market, but overall, I think you're going to be in a trading range of, plus or minus 6%. We would expect some profit taking to occur in January or February.
I want to interrupt you, and I want to put this in a context that all of us can understand. So help us if we were your clients, based on what you just said a minute ago about watch, capital flows. Last 2 weeks, we've had people on the show who've talked about $1 trillion just in money markets. We've written about the fact that we're seeing flows back into equities, but there are people who are saying that this is fear of missing out, and that's the end of a cycle. So if I were your client, if we were your clients, and we were calling you right now saying, hey, we want to get in on this, what would you tell all of us?
Well, if we have cash on the sidelines, we would just be opportunistic if the markets pull back to add some exposure. And really, the whole FOMO, or fear of missing out concept, really is tied around greed and fear. And the fear gauges are way low, and the greed range is way up in this market. So this is time to be patient with sideline cash. You don't need to be fully invested. Just be willing to make a little bit less to know that you can protect the downside if there's a pullback.
I think the headline there is time to be patient with sideline cash, because we've had others on the program who say better jump in. But Rich Steinberg, Colony Group Chief Market Strategist, good to have you here on The Move.
Okay.
Well, as high hopes continue for that U.S.-China trade deal, oil is benefiting. It's trading at over $61 a barrel. Earlier today, it rose to a three-month high of $67 a barrel. And joining us to discuss from the CME is Todd Colvin. He is Senior VP at Ambrosino Brothers. Todd, it's great to see you. So we've had this little leg up in oil as of late, but do you think it can be sustained? It was perhaps, I mean, maybe not surprising given that we've seen the risk-on rally, but oil for much of the year has not really been benefiting necessarily from that risk-on rally.
No, it hasn't. And go back to early October, things were a lot different in the oil markets, but we've rallied about $10 since then, and it's been a very steady, slow and steady rally with only a few hiccups, which were probably timed around some not so optimistic market communications between the president and the media in China. But I think at this point, oil's going to probably hold its range as we head into for the next few days into year end. It's a mix of optimism for trade. It's a mix of optimism for global growth at around 3%. And it's a little bit of optimism with the last OPEC deal coming through and saying they're going to continue to maintain their production cuts. At this point, you need all three of those things to continue this rally, but I think it slows a little bit because higher oil prices, to be honest, while they're helping a lot of those in business, it is not a friend to anyone to see sustainable higher oil prices. That will become an obstacle to growth at some point.
Todd, an article that posted on Yahoo Finance just this morning, though, pointed out that the great leveler in all this is the United States, now the world's largest oil producer because of shale production. But we've seen that flatten and perhaps even get pulled back. And then you get J.P. Morgan and Goldman. They've upped their predictions for 2020 regarding oil. So what am I missing here? Help us understand where we're truly headed, because they seem to be more optimistic than you are.
Well, I think that the oil markets do bring out a lot of different opinions. Like you just heard from on your last guest with stocks, you do hear a lot of different opinions back and forth. It's going to basically supply and demand. Get to your basics when you talk about oil. Where's the demand going to come from? Is it going to be global growth? Is it going to come from the United States? Supply side, is that going to be pushing it? Obviously, the decline in shale has helped oil prices, and obviously the OPEC cuts have helped oil prices. A trade deal with China getting through phase one and possibly later phases in 2020 will be positive. But will that global growth engine, continue to need those levels? And I think at this point, seeing north of $70 a barrel for WTI is going to start to create a little bit of an obstacle to that growth. So at this point, I think they're comfortable with oil north of $60. But getting much further than that, you have to start finding where is your growth component going to come from that's going to sustain that rise in oil prices.
Hi, Todd. Jared Blickery here. We got some big supply coming on deck next year, not only increases in U.S. shale, but also increases in supply from Brazil, Norway, Russia. And I've seen estimates pegging crude oil, WTI, at $45, $50 by next year end. And in part and parcel with that, OPEC might have to cut production even more. They're already doing 1.7 million barrels a day, maybe going up to 2.2. Do you see that in the cards, given it seems Russia's reluctance to really go the distance here?
Yeah, getting everybody to play fair can be troublesome when you talk about the OPEC and non-OPEC members. But at this point, I think, yes, OPEC will remain in the game, similar to, if you want to categorize it, as our Fed remaining in play with monetary policy, despite the fact that things look good economically. OPEC will remain in play to keep their production levels at such that will keep demand and keep prices at a certain level. At this point, we used to say it was somewhere between 55 and 60. Now we're getting north of 60. So if you're looking for lower oil prices down in the 40s again, that would certainly bring on much more aggressive cuts out of OPEC, especially if the global engine growth doesn't sustain that 3% that is expected to keep oil prices and keep economic growth where it is and moving higher.
Todd, I'm curious about the oil producers also, particularly the U.S.-based ones, because it's been a sort of a tough slog for the energy producers in the U.S. this year. What's the outlook look like for next year?
Well, I think, again, when we talk about the U.S. economy, we've got it at a place now where the Fed seems to be content with growth. The GDP numbers have been getting better. And at this point, talking about getting oil prices or getting oil production back online in the shale sector would be very important. And I think that will continue with equities moving higher, with yields moving lower in Treasury side. I heard you talk about fear of missing out. What about there is no alternative? The other acronym people are using. You could find commodities as a place for people to put money as an alternative, given that the rise in equity prices, and maybe look for one follows the other at this point. But I think right now the oil sector probably continues to see modest growth as long as the economy continues to show optimism and those GDP numbers that we saw last quarter.
All right, Todd, thanks for that. Todd Colvin, Ambrosino Brothers Senior Vice President, joining us from the CME. Happy holidays, Todd. Thanks.
Coming up, President Trump tweeted about Jerome Powell a total 80 times this year, but what's in store for next year? Oh boy. Plus, 'tis the season of gift returns and exchanges. Where do all of those returns actually go? It ain't the island of misfit toys. We'll tell you straight ahead.
It's just after 11:30 a.m. here in New York City, about 2 hours into the trading day. Stocks are rising. That means we're at records again. We were just talking about oil prices. We're seeing them bump higher above $61 a barrel and hold above that level, up 0.8%. By the way, the weekly oil inventories, as Jared Blickery informed me earlier, are out at 11 a.m. tomorrow. Typically, they come out at 10:30 on Wednesday, but for obvious reasons, i.e. Christmas, they weren't out yesterday. Sending it back, how rising returns are piling up in the most unexpected places. Google's war on Bitcoin, why the company's purging crypto content from YouTube. Plus, more violence in the streets of Hong Kong. Protesters celebrate Christmas by ransacking the city's shopping districts. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. This was a year the Fed came under the attack of President Trump, who tweeted about the central bank and its chairman, Jerome Powell, more than 80 times. With us to discuss this, as well as what's going on inside the White House, is John Tamny. He is director of the Center for Economic Freedom at FreedomWorks and editor of Real Clear Politics. Also the author of the book, Who Needs the Fed? John, the Fed not signaling any rate changes in 2020. Let me ask you to answer the question, which is the title of the book. Who needs the Fed? Don't we?
No, we don't. To pretend that we need the Fed to fiddle around with interest rates, that's necessary for economic growth, defies common sense. Let's never forget that the Fed projects its always overstated economic influence through a U.S. banking system that represents 15% of total credit in the U.S. economy. And let's stress that it's the least dynamic credit of all. Banks, as a rule, cannot lend toward growth and toward dynamic ideas. They have to lend toward sure things. But the U.S. economy grows based on new ideas constantly entering and pushing out the old. And so the Fed's just not.
Let me interrupt you. You just said the economy is based on new ideas pushing out the old. The financing for that comes from monetary policy. I mean, if we didn't have the Fed, say, in 2008, I'm not sure many of us would be employed right now. That's what they were talking about.
Well, but of course we would be employed. In fact, we'd be employed better precisely because when government actors enter into an economy and prop up what markets don't want, they naturally slow it. Let's never forget that Japan was literally reduced to rubble by World War II, but within a few years, it and Germany were two of the richest countries in the world. What kills a country is not the failure of a business. What kills it is government intervention. And so you look at the Fed. What could the Fed possibly do? It bailed out Citibank for the 5th time in 25 years. Can you give me a reason why the U.S. economy is reliant on Citibank? Has that somehow made us more prosperous, propping up what markets have been trying to put out of business for 3 decades?
This is an academic discussion because the Fed ain't going anywhere, at least in the short term, right? So given that the Fed exists and probably will exist for our lifetimes, barring a revolution of some kind or a bigger change than we have seen, what do you think the Fed should be doing, given reality, given not the idea that it's going away? What do you think the trajectory of the Fed should be next year?
I think you put it so well. The Fed's always going to exist because politicians always need a convenient whipping boy. But let's be clear what the Fed does, okay? So it regulates the banks. Okay, how'd that work out in 2008? The Fed exists as a lender of last resort, but by definition, any well-run bank would never go to the Fed for a loan because doing so is an admission of bankruptcy, at which point the Fed sets or tries to set the overnight rate that banks lend to one another at. We don't need the Fed for that. And so, yeah, the Fed's always going to exist. My only argument is that it's just not that important. And so the Fed, could it move rates down this year? Sure. Will that cause the stock market to rally? Well, ask the Japanese. They've been at zero for how long? How's it worked out for their stock market? Implicit in this idea that the Fed can just generate good times is that it can somehow predict what companies are going to be important in the future. Implicit here is that the Fed decide we're going to prop up the stock market, and in doing so, we're going to prop up 5 companies, Apple, Google, Facebook, Amazon, and that were the biggest drivers of the stock market rally. But at the same time, we're going to engineer GE's decline. We're going to engineer Ford's decline. We're going to put Sears out of business.
John, hold up a second. We want to get Jared in on this.
Hey there. Okay, so the Fed's not going anywhere. It looks like they're on hold in terms of interest rate policy for the time being, but they're also expanding their balance sheet once again. Looks like risk markets are responding positively to that. What do you think? Where do you think this goes next year?
The Fed's always looking for a reason to be relevant, and so it's always going to act. I just don't think it means very much. Let's never forget that even if the Fed weren't expanding its balance sheet, it's not as though well-run banks wouldn't have a highly liquid market looking to liquefy the assets it has on its balance sheet. And so what I've always argued is what the Fed's doing is probably something that market forces might be doing on their own. The Fed can't alter reality, and how we know that is that if it could, if it were a fraction of as powerful as people want it to be, then QE would have led to a massive economic boom, but it didn't. The Fed can only confirm reality. And so it expands its balance sheet. Okay, but ask yourself what would happen if the Fed didn't exist. Would banks somehow not have a market for their loans? I don't think so.
All right, John Tamny is the director of the Center for Economic Freedom at FreedomWorks. Thank you for being with us on this holiday day after Christmas.
Thanks for having me.
Coming up, YouTube goes to war with crypto, why the company's pulling all crypto ads off the site. Plus, how long can Disney Plus capitalize on nostalgia? Dan Roberts has some thoughts. Well, despite a quiet day of trading, we do have some big movers to point out, both of them in the biotech space. Let's start with Immunomedics. That company saying that the U.S. FDA has accepted the company's biologics license application that seeks accelerated approval for its treatment for breast cancer. So the shares getting a big pop on that news. We tend to see these outsized moves in the biotech stocks when they get these sorts of approvals, even if they're sort of interim approvals. On the downside, we also have a biotech company. This one is called Spectrum Pharmaceuticals. Those shares are plunging after a study into Spectrum's lung cancer treatment did not meet the endpoint that the company was shooting for. So those shares really just collapsing in today's session. We'll be right back. As the holiday season begins to wrap up, consumers are making lots of returns, but where do they go? It turns out 3% of them, it's about £5 billion, end up in landfills. That small percentage amounts to that much. To discuss, Adam Vitarello joins us now. He's the co-founder and president of Optoro. Optoro basically seeks to reduce this. Almost half of those that Optoro surveyed admitted to throwing away 25% or more of total returns. So Adam, thanks for joining us. Your company basically looks at the sort of return cycle and tries to make it more efficient. Where are the breakdowns here? Why does so much of the stuff that's returned not end up getting reused or resold?
Right, and good morning and happy holidays. Thanks for having me on. So, returns is becoming really a growing problem, especially with the growth in online. And I think, over the past 30 days or so, there'll be about $100 billion worth of returns in the United States alone, a crazy, staggering amount. And the reason why these goods end up hurting the environment and ending up in the landfill is because there's not a good process for it. And so imagine, you have a chip on your couch and you try to return it. It's just not economically feasible to return that. And so they oftentimes just tell you to keep it. And what do you do with something that's damaged? You might throw it away. So Optoro is in the business of streamlining that process, making returns easy for consumers on one hand and profitable for retailers on the other side.
I just want to put this into context, and if you can help us understand visually what this looks like. 50% of return stock at the retailer, so we go to the brick and mortar. 25% return to the vendor for credit from the retailer. That stuff doesn't wind up getting resold? Doesn't the majority of stuff that gets returned wind up getting sold, whether it's at a discounter or something?
Yeah, so the vast majority of goods do get resold, but a lot of goods don't. And so you may have had the experience yourself where someone said, hey, just keep this item. And a lot of retail, and so that's one example of goods that don't get resold that oftentimes end up in the landfill. Another is that if you actually send something back to a retailer, let's say you bought something online at Nike.com and you returned it to a Nike store, they oftentimes don't carry that good in the store because they carry much wider variety online. And so they have difficulty figuring out what do they do with that. Or imagine a sweater that you bought, right now, let's say someone gave you a sweater for Christmas and you returned it in February. Well, now there's the next season, right? And so spring is coming. And so those retailers don't know what to do with those goods. Some of them end up going into landfills.
Adam, I know you guys saw a gap here, and that is where you jumped in, but I'd love to get your take also if you think there are companies, big retailers, that have done recycling right in this regard. I mean, you mentioned some of those stores that it's problematic when you return goods to them later and how that ends up in a landfill, but are there stores that have specifically attacked this problem, and do you think that can actually help business for them?
Yeah, absolutely. I mean, I think Patagonia is an example of one brand that is doing this really well. And I think you can look at returns, but I would say looking at the whole circular economy and reuse in general, Patagonia has a program called Wornware where you can take back any old Patagonia and they'll actually give you credit for a new Patagonia item, and then they'll actually fix that up and resell it. I would say it's absolutely good for business because not only does Patagonia's brand improve and they get a really cultish, loyal following, but then they actually are able to resell those goods on the secondary market.
Hi, Jared Blaker here. So it sounds like there is a pretty good arbitrage opportunity potentially. I know your company is in the business of making this process more streamlined. Does it simply, does eventually it get all arbitraged out, or is this, do you see this problem just increasing into the future and really without much resolution?
Yeah, I think, the problem of returns is certainly going to continue to grow. And I would say actually that the best companies don't view it as a problem. They view it as an opportunity to really connect with their customers. A lot of folks, like you think about Zappos and even Amazon now, they lean into returns. Amazon actually just expanded its free returns policy because they saw that if they offer a really great returns experience, those folks actually turn from some of their worst customers to their best. And so we think returns are actually going to grow. The question around what do you do with those goods when they come back, it needs to be streamlined. Our technology platform and others, Amazon's doing some good things here as well, ultimately just connects those items as efficiently as possible to their next best home. And you need to be efficient because a lot of these items are cheap. And if you don't do it efficiently, it's not cost effective, hence why some of them end up in landfills.
Yeah, or they just tell you to keep the thing. Even if it's not damaged, sometimes
Exactly.
they tell you to keep the thing. All right, Adam
Exactly.
Vittorello, Optoro co-founder and president, thank you.
Thank you so much. Happy holidays.
You too.
Google is at war with Bitcoin and crypto. The tech giant is removing hundreds of Bitcoin and cryptocurrency ads from YouTube. It's being called a crypto purge. We want to turn to our in-house crypto expert, Dan Roberts, and we want to ask him if crypto experts are being targeted here. And you take issue, too, with the fact that we're calling it a war on crypto?
And it's also not just ads, right?
It's not ads.
It's videos where people talk about how to
That
invest
happened
in
last
crypto.
year. Yeah, so en masse, YouTube removed a bunch of, call them crypto influencers videos. So this is original content posted by people, and then in some cases, small publishers. But really, it's individuals. It could be Blockchain Jared, or at Julie Binance Coin, whatever their usernames are. These are not videos from big publishers like, say, CNBC or crypto news websites, or us. Yahoo Finance has some videos about Bitcoin. It's not that. In many cases, I think, these are people who are shilling and pumping one specific coin. But one initial response from people was, oh, that'll make sense if it's just so-called altcoins. But also, in some cases, it's videos about Bitcoin. So it's everything. And yes, you're right that Google, which owns YouTube, has kind of made its distaste for this industry clear when last year, for a period of 3 months, it removed all crypto ads. But then it reversed that decision, brought the ads back. Now, taking down a bunch of videos, all these people who posted the videos are getting notices that cite either dangerous or harmful content, or in some cases, promoting the sale of regulated goods, which is very interesting. Look, cryptocurrency, it's a misconception that it's unregulated. In many cases, it is regulated. Maybe you could say lightly regulated, but that also proves my point that I suspect what's happening here is YouTube deciding to remove these videos because they are shilling, pumping, promoting bad investments. Alternative cryptocurrencies.
But it's so fascinating to me that YouTube is making what is a qualitative
It's a judgment call, yes.
Right? Do they remove multi-level marketing videos
Amway.
from YouTube?
I don't know the answer to that.
Do they remove? We know they have struggled with removing sexual content,
and
content
political
with
ads that are
minors.
misleading.
So it's really interesting. Like, how do they pick this? Have they released any
It's
kind
also
of?
a free speech issue, which people are pointing out. I
have
just
they-
retweeted before the segment started someone who asked, well, wait a minute, this is a video platform that really has a monopoly on video content online, in a sense, original video content, and now they're making a judgment call.
Can I throw this into the discussion? What does YouTube gain by doing this?
Well, they can
the
say to critics, we're
credibility?
cleaning up our platform.
Okay, so they're cleaning up the platform, making these value judgments. Is this going to extend in? I mean, why crypto and why now? I gotta ask this question because we've seen a lot of these altcoins just kind of collapse in and of them into themselves. The value of a lot of the crypto trades. There's been a huge wipeout in wealth. Is this really an issue anymore? Do they see the tide changing where we're going to see these investments kind of maybe flourish again, or maybe there's too many of them?
them?
I think those are all fair questions. I want to make sure we also give the caveat. The people who had their videos removed have posted the notices they received. They received, kind of form notices from Google. But Google and YouTube have not officially responded in some kind of overarching way as to why they did this purge right now. I suspect that one retort or one answer from YouTube would be, we're protecting our users. They're trying to help people from not losing their shirts, investment-wise. Someone sees a video posted by Blockchain Jared, and Blockchain Jared has 30,000 YouTube fans. And so he seems credible, and he's saying, buy Binance Coin. Binance Coin is a great investment. And YouTube is realizing we got to clean up this content. But look, I think you're going to see some pushback from the community as to, is this in YouTube's standards of conduct? Well, is YouTube just free to label any video they don't like as dangerous and harmful content and then remove it? Also, we should mention that people who've had their videos removed do have the chance to appeal that decision. It's not like the videos are gone now.
Right.
This could be a whole show, but we're going to have to leave it right there. Coming up, protests continue in Hong Kong over the Christmas holiday. Plus, Madonna apologizes to her fans after canceling a concert and delaying her European tour.
Would you be
Protests continue in Hong Kong, where demonstrators marched through shopping malls today. It's the third day of protests, which have included clashes with riot police. These latest demonstrations started Christmas Eve, but the protests in general began more than 6 months ago in opposition to a Chinese government crackdown on independence. Strikes over pension reform in France forced thousands of people to give up their holiday travel plans. Only a fraction of France's high-speed and intercity trains ran over Christmas. Transit workers have been striking along with other government employees for more than a month over plans to merge France's 42 pension plans into just one. The man who was once married to a Norwegian princess and once accused Kevin Spacey of sexual impropriety took his own life. 47-year-old Ari Behn died by suicide on Christmas. He leaves behind 3 daughters. 2 years ago, Behn accused actor Kevin Spacey of groping him during a 2007 Nobel Peace Prize concert. The Material Girl had to cancel her last Miami concert and is delaying her European tour. 61-year-old pop icon Madonna says her doctor ordered the delay because she has been in pain and suffered some injuries. Madonna told her fans via social media, quote, "I was in tears from the pain of my injuries, which has been indescribable for the past few days." We'll be right back. Time for Word on the Street. We're going to check in with the panelists and find out what stories they're watching. Dan, you want to talk about Disney. So, nostalgia past the holidays?
Well, Disney Plus, yeah, and I was just going to say, we know that this platform launched earlier in November and that it quickly amassed reportedly 24 million subscribers. Now, big grain of salt you have to take that with is that there is a deal for Verizon customers, our parent company, to get the first year for free. So a lot of people say you have to take the numbers we're reading about Disney Plus with a grain of salt. How many of those people, when their free year expires, will re-up? But point being, there was a lot of good stuff on Disney Plus to watch over the holidays. I watched Muppet Christmas Carol with Michael Caine as Scrooge. Great movie. There was other good stuff. We watched Newsies. A lot of good content. But the knock on Disney Plus lately, and I think it's fair to ask this, has been that everything is old. Even in a sense, what's new is old. The Mandalorian, well, it's a spin-off show from Star Wars. There's original Marvel content coming in. It's all prequels, sequels, remakes, reboots, and there's also Lizzie McGuire, a reboot. Everything on the content is a nostalgia play, and that's very good. There's a lot there. It's a huge kitchen sink. But how long will that last? Can Disney Plus really be framed as a threat to Netflix when everything on it is a nostalgia play?
Well, here's what I would say two things. First of all, interesting thing, the most recent Star Wars movie, not the one in the theaters, but The Last Jedi, you have to go to Netflix to watch that. It's not on
Just
Disney
for now.
Plus.
Yeah, it hasn't
Second of all, I would push back against that whole nostalgia thing. My kids love the Marvel stuff because it's new to them. And I think that is something that has been the counter argument to what you're saying is there's always a crop of new viewers. Yeah. They don't care if that stuff is old.
By the way, I love it too.
They enjoy
I'm a huge
it.
Marvel fan.
So,
I love this stuff.
I wonder.
But I think this is a fair critique of the platform.
For adults, but for kids who are coming up, they don't care.
Disney
if
needs
stuff's
to get you to do that one-man Cats you gave us last week. That would be a hit. Yeah.
For cats. Jared, you're watching Gold, which has done really well this year.
Yeah, well, it's been a great year for gold. I think it's up the most since 2010. It looked like the rally was stalling out. It was kind of trending down for several months, but it just recently broke out. In fact, only one day ago, trading day, it broke to the upside. And so we're seeing it above 1,500 again, kind of a critical, psychological support level. But it's not just gold. Copper has broken to the upside, silver, a lot of commodities have. And what's impressive about this, it's not really going hand in hand with a weaker dollar. A lot of times just, the price of the dollar itself can determine commodity price, but it's not happening here. And also interest rates. We're not really seeing any big move in interest rates right now. Typically, as they go lower, people go into gold, but they're not. That's not a tailwind right now.
Dr. Copper sending a signal about global growth?
Yeah, Dr. Copper has been bullish for several months now. Before we even got the phase one finalized, or at least noticed that it was going to be finalized. So yeah, copper has been in growth mode, or has been projecting that the world's going to be in growth mode next year. And commodities as a whole are ending the year pretty strongly. This is an incredible year for just about all asset classes.
I think Dr. Copper is the next Marvel supervillain.
Yes, I think you're right. We'll see if its prognosis is correct. Jared, thank you for being with us this hour. You're going to, of course, make some appearances next hour as well. Appreciate it. And Dan's going to stay right there. Coming up, consumers spend big this holiday season. We'll break down the numbers for you. Muhlenberg is out. Calhoun is in. What we can expect from Boeing's new CEO. is noon here in New York City, about 2.5 hours into the trading day, and stocks are higher. We've got new records again for the major averages. Let's take a look at the 10-year Treasury yield as well as we get a little closer to the end of the year. It's moving higher by just a basis point at 1.92%. Holiday shopping boom. Early data shows online sales hit record highs over the holiday season. What's next for Boeing? How the company's new CEO plans to make nice with the FAA. And moving forward, how a new crop of voting members could reshape Federal Reserve policy in 2020 or not. Maybe it'll just stay exactly the same. Welcome to On the Move. I'm Julie Iman.
And I'm Adam Shapiro.
Well, so much for all those warnings about that shortened holiday season. The strong U.S. consumer spent big in the run-up to Christmas. Overall holiday retail sales between November 1st and December 24th rose more than 3%. That's according to data from MasterCard's Spending Pulse report. And online sales soared, up 18.8% from the 2018 holiday shopping season. That's 14.6% of total retail sales. I also want to offer a clarification from last hour. I said that this number did not include bricks and mortar retailers that also sell online. I am told by MasterCard that indeed it does. So if Target makes an online sale, it counts towards that online number. Joining us now for this hour is Praz Subramanian, and we're also joined by Nate Checketts, CEO and founder of men's activewear retailer Rhone. So let's start with the holiday shopping season. How did you guys find it, and what were the trends that you were seeing?
Yeah, it was unbelievable for us. We were worried about having 1 week less between Thanksgiving and Christmas this year, which always impacts it. But Black Friday to Cyber Monday, man alive, consumers came alive. And we had record numbers year over year. We also saw huge growth in mobile, 75% year over year growth in terms of mobile shopping. And the other interesting trend that we saw is Black Friday was bigger this year than Cyber Monday for e-com, which is the first time that's ever happened kind of in U.S. history online.
I am curious about your products, and I went online, I looked, and I wear a white or a blue shirt. I mean, last week I wore a purple shirt, and it was the first non-white or blue shirt I've worn in years.
Decided to mix it up.
We tried to, yeah, right, there you go. Two things I noticed. I can get a dress shirt, and I tend to overdress, I guess. It's Charles Turwood. I can get an all-cotton shirt for roughly $35 with the discounts they're offering. Your shirt, which sold out, should point out you sold out of this shirt repeatedly.
Yeah, 5 times.
Is $118. What's the difference between that shirt and the shirts I'm getting on the cheap over at Turwood?
Yeah, so one of the most amazing things about our dress shirt is it's made out of all Italian fabric on a knit machine. So it's knit using 4,000 different needles. When you put it on, you feel the difference. It's the most comfortable dress shirt in the world. We tried every single dress shirt on the market. The other thing is you can take it, you can stick it right in the laundry machine afterwards. It doesn't need to be dry cleaned. Okay. So the savings that you have pays for itself. Every time you go and take your shirt to the dry cleaners, you're paying, anywhere between, you can pay as low as 99 cents, but usually it's upwards of $3 or $4. That adds up over time. We say the shirt really pays for itself.
Hey, Nate, so you mentioned that shorter holiday shopping period. Do you think that actually helped boost online sales because people had less time to go in?
Yes.
Help guys like you?
Absolutely. I think that, there was kind of this rush where all of a sudden Christmas was right around the corner. People were eager to get it. And I think also the U.S. consumer is smart. They've learned to start kind of putting their purchases in a consolidated pattern to plan ahead. I remember growing up, we were rushing to the retail store kind of the days leading up to the holidays. I still did that with my kids just for nostalgia this year. But I'll tell you, I think people are planning farther and farther ahead, and it's not just online, it's also in retail. Our retail stores saw a huge boost, our 4 retail stores, during that kind of Black Friday week and Cyber Monday week.
I want to ask about margins because there has been a broad strategy of discounting across retail over the past several years. Yep. Is that something you guys do as well? And what about on the shipping front? So what does that do to your margins?
So a couple of things. When it comes to discounts, we really only discount twice a year, and we're pretty disciplined about that. We understand that the consumer wants a deal, and we're willing to give it to them at certain times of the year, Black Friday and Cyber Monday being one of those times. But that can eat into margins, and if you're not disciplined in it and you only use discount as a strategy, over time that can really erode margin growth. When it comes to kind of the other piece of it and how do you extend the rest of the calendar, I think we try to stay disciplined in terms of kind of having this multi-channel approach. So wholesale, we're Equinox's #1 men's brand, we're Peloton's #1 men's brand. That helps balance us out, and then our retail stores really kind of keep the strategy through the calendar year so we don't have to discount so much online.
But is the growth going to be for you in the next year? Is it going to be a focus when you talk about multi-channel on your own retail, or is it going to be about getting into other stores?
Our growth has, over the last 18 months, has really been on our direct business, so e-com and retail stores. But wholesale has been a great business for us. It gives us visibility into the end consumer, and I think a lot of these digitally native brands are using that as a strategy, using wholesale as kind of somewhere between 10 and 25% of their business. I was in Target over the holiday shopping season. I couldn't believe how many digitally native brands that had started online, were in that environment.
And now some of the big box retailers own those brands also.
Yeah, exactly.
All right, Nate Checketts, thank you so much, CEO and founder of Rhone. Appreciate it.
I'm going to get one of those shirts too. They restocked. I saw that today, so I'm gonna...
We'll make sure.
Sticking with retail, Tiffany & Company got a big boost in holiday sales from customers in China. Scott Gamm on the floor of the New York Stock Exchange will tell us what that's about.
That's right, Adam. We're watching Tiffany's stock today. It's not really doing much, really because of the overhang from the announcement last month that it agreed to be acquired by LVMH for $16 billion. But Tiffany today releasing some preliminary holiday sales data saying that sales rose between 1% and 3%, driven by, as you mentioned, that double-digit gain out of China. Now that was important because it helped to offset some of the declines that Tiffany saw out of Hong Kong amid the broader protests in that region over the past 6 months. And staying with the holiday theme, we're also keeping an eye on shares of Amazon, now up 3%. Earlier this morning, the stock was up 1%. The company saying that people shopped at record levels during the holiday season and that tens of millions of Amazon devices were purchased. Now, Amazon stock has underperformed the broader market this year, up about 20%, while the broad market is up about 30%. And then we're continuing to watch Boeing stock. It's down right now. Of course, a lot to watch with Boeing this week, with CEO Dennis Muilenburg resigning back on Monday amid the broader 737 MAX crisis. Now, Boeing is still up for 2019. It's up about 2.5%. As long as it stays above $322 a share, the stock will remain in the green for the year, guys.
Thanks, Scott. And incoming Boeing CEO David Calhoun faces a number of challenges when he formally takes his post next month. They include the continued crisis caused by those 2 fatal crashes of Boeing's 737 MAX jetliner, as well as a strained relationship with FAA regulators over returning the grounded planes to the skies. Dan Roberts is back with us, as well as Praz, who's sticking around. So we've heard reporting that one of his first priorities, Calhoun that is repairing the relationship. With the FAA.
Along with, 2, 3, 4, 5 other things,
yeah,
but sure.
Exactly.
Yeah, you said the relationship is strained. I mean, that's one word for it. I'd say it's completely under the microscope. I mean, it is front and center, and clearly the relationship was problematic, and that has been exposed. I mean, you're always sorry once you get caught, So, first of all, there's obviously the loss of life, and that's priority number one, and that was horrible, those 2 crashes. But what that brought about is shining a light on probably an entire culture. Like, I think a problem that permeates, it looks like, the whole corporate culture at Boeing, which was, the reporting wasn't often listened to when people raised issues, FAA too close and too cozy with Boeing, and
who's getting off
things that need to be fixed.
Let's, in a bit of context, yes, Boeing, clearly some issues. The FAA was coming under attack from Congress prior to the crash of these 2 planes. There was a move to privatize many of the FAA functions. The FAA has dodged a bullet so far, but let's not forget they had a partner with the Boeing complicity in this, because the FAA was asleep at the wheel, and no one seems to be screaming and yelling about the FAA's failure in this front.
Well, some in Congress are, I think.
Yeah, and kind of Boeing sort of had that marriage with the FAA, pretty tight relationship, and that they leaned on each other. But I think the bigger story is, Dan mentioned credibility. Like, Calhoun was on the board the whole time. Like, what does he bring to the table that's different than outside the company than what was already there? Muilenburg was at least an engineer. He had that background. He brought that to the table. Calhoun was just a board member. I don't see how they can really change.
Well, but he's got not necessarily direct aviation, but he was at GE at the engines. I mean, he's had a link for the last 20 years to the aviation industry. He certainly knows what's going on. We would hope, if you're a shareholder in Boeing, that he knows what's going on.
I guess I'm talking more about the cultural shift. Like, how do you get back to, we're Boeing, we care about our customers, our flyers, our engineers. And the engineering team, they're talking about that needs a wholesale change because of how they focused on profits as opposed to getting the plane flyable.
And they would say, hey, look, at least it's an outside person, but you're right, he's a board member, but it's an outside hire because he's coming from Blackstone to take this job.
Which is his day
better
job,
to,
yeah.
Better to take someone from outside if you really want to show investors and show the public we're reinventing ourselves. You take someone from the outside rather than an internal hire. Now, the one thing I want to make sure, I know I said this earlier, but to play devil's advocate to all the laundry list of problems that we just said, Boeing is still going to be the most powerful, engine, no pun intended, sorry, of our air travel economy in 2020.
Well, GDP,
beyond.
they talk about them shutting down.
It's too big to fail.
Right.
Yeah. So Boeing's not going anywhere.
No.
Okay.
He's got the new CEO's got some things to fix, but he's not going anywhere.
Some of the voting members of the FOMC are going somewhere, but not because they're being fired. 4 regional Fed chiefs it's out with the old, in with the new. 4 new chiefs are set to join the Federal Reserve's rate-setting panel, the FOMC, in January. Voting slots at the Fed, they rotate every year. But will the new group bring more or less consensus over rate decisions in 2020? Yahoo Finance's Brian Chung joins us now with some more insight. Brian?
Yeah, so a little bit of musical chairs. For those that aren't aware, you have your Fed board members based in Washington, D.C., like Jerome Powell and the other 4 current members of the board that have permanent votes in determining where interest rate policy goes, for example. But then there are also the 12 Reserve Bank presidents. These are regional heads that are based in many parts of the country, many corners of the country, that provide their regional economic take to the table. But among those 12, only 4 of them have votes each year. So they rotate on a calendar year basis. So as we head into 2020, we're going to get a new cast of 4 Federal Reserve Bank presidents that will vote in these interest rate meetings. So to introduce them, they are from the Minneapolis Fed, Neel Kashkari; from Philadelphia, Patrick Harker. You also have Loretta Mester from Cleveland. And then lastly, you have Robert Kaplan from Dallas. So these are 4 new members that will be part of the board. And the Palace intrigue is really going to be, where will these members take interest rate policy in 2020? And for those that are maybe hoping for some excitement in 2020, the answer might be a little disappointing, maybe no change at all. So as a reminder, in the Fed's last meeting only a few weeks ago, they had signaled through their dot plot projections that rates will probably stay the same in the current range of 1.5 to 1.75% by the end of 2020, barring any sort of economic changes. If there were to be some material difference in the economic outlook, then maybe the individual voices of those 4 Federal Reserve Bank presidents could come into view. As a reminder, though, the other 8 Reserve Bank presidents, they still have a seat at the table, but again, they just don't have votes. So they participate in the discussion, but they don't ultimately vote on where interest rates go. So a lot worth watching as we head into next year.
Brian, do we have any insight into these 4 incoming voting members, their views on the repo operations that the Fed has been conducting?
Yeah, so if interest rates don't end up moving, then a lot of attention could shift to the balance sheet management at the Federal Reserve. When you talk about the repo operations, keep in mind that the New York Fed has been managing a day-to-day operation to allow for the flow of wholesale funding that can allow broker-dealers and banks to close out their positions at the day's end. So that is going to continue. The Federal Reserve itself at the board has also committed to expanding its balance sheet by a pace of about $60 billion per month, mostly and actually entirely in short-term 3-month Treasury bills. So that will continue at least through the first half of 2020. We haven't heard too much about those specific 4 Reserve Bank presidents in terms of what they think about the policy going forward, but it seems like at large, a lot of the Federal Reserve officials have committed to actually continuing that pace of purchases through the first half of 2020, but also being flexible, saying that we could increase or decrease that amount depending on what we see in the economic conditions in the wholesale funding market through 2020. So worth watching, but for them, it's basically going to be data dependent as we head towards next year.
So they say. All right, Brian, let's talk more about these changes at the Fed with our panel. It seems like from what Brian is saying that it's not necessarily going to mean any big sort of revolutionary changes at the Fed in the new year, but still something to watch. I think particularly somebody like Kashkari, who's been kind of outspoken.
Yeah, Kashkari's on, he could ask, were the doves right, Trump asking for these rate cuts, he got them. Economy, doing fine, stock market taking off. Now 2 of the hawkish members are being replaced also with 2 other hawkish members, being Eric Rosengren and Esther George, who both were against rate reduction. So in that portion, I don't think much is going to change. But Adam, I know you know more about this than I do.
Well, it's not that I know more about this. I'm just curious, though, as an investor, what I heard Brian say was very interesting. That when you talk about the purchase of the 3-month treasuries, that's actually intended. What they're doing there is they're driving down short-term interest rates, and they're increasing the spread, say, between the 3 or the 2 and the 10, right? So if you're an investor, hearing what Brian's just put into very easy to understand language for us as to what the Fed is doing, it gives you some sense of where you might want to be going with your strategies, whether you want to be conservative and go into bonds or whether you want to jump into equity.
It could. I also think that if you're an investor, you might be right if you think that maybe the Fed won't play as central a role in 2020 in terms of how stocks move. Because in 2019, the Fed was a huge story, whether it wanted to be or not. And I think it probably didn't want to be. But Jay Powell, came under so much scrutiny, not only because of the Trump tweets, but just, it's like I think a lot of people forgot it. It's not the Fed's job to make sure that stocks go up at all. But, a result of all the Fed action in 2019 was that every Fed meeting, not only what the Fed chose to do with regard to rates, but also Jay Powell's press conferences, what he said, his remarks were so picked apart that on many days it looked like markets were reacting directly to that. And that technically you don't want that to be happening so much. And it seems like in 2020, if there's no raises or cuts, then it's not going to be as much of the case.
We talk about the president and his tweets and the pressure on the Fed and all of that, but I'm remembering back for the 2008 financial collapse, Jim Cramer was screaming and yelling on CNBC.
They don't get it.
Right.
They don't get it.
My friends are telling me, right, they don't get it.
Maybe they get it now.
Phew. That's what I have to say about that.
Coming up, we're nearing the end of an historic decade for business. Next, we announce Yahoo Finance's top company of the decade. Plus, before we go to break, let's take a look at some of the biggest winners in the Dow today. Look at that. Apple, did you get a new iPhone? Apple.
Stocks in the green. Welcome back to On the Move. I'm Jared Blickery. We got the Dow up 43 points, about 15 basis points. S&P 500 is up 0.25%. NASDAQ is up almost 0.5% here, and this is going to be 10 in a row for the NASDAQ, 9 of those being record closes, something to think about here. S&P 500 really not doing much over the last hour, but maintaining most of the day's gains so far. Russell 2000 is underwater right now, underperforming. Now we got the 10-year T-note yield. It's kind of been oscillating back and forth. You can see today it was down about 2 basis points. Now it's up about 1 basis point, and that's kind of been the story over the last few days. This is a chart we've been looking at, 1.90 to the downside, 1.95 to the upside. Can't really figure out if it wants to break down or break through this. We'll have to see what happens into year end. We also got some strong action in commodities. The crude oil is on the rise here. That is up about 1% today, hitting a 3-month high. We can see building on gains made from yesterday. And then gold futures. We've got to check out gold again because that has broken to the upside, well above $1,500 per ounce. We can see it's up 2.5% over the last few days. Let's check out the NASDAQ 100 heat map here, and we can see Amazon is on a tear. Amazon is a leader in the NASDAQ 100, and if we look at a year-to-date chart, we can see it's just beginning to break above this resistance level. Got a few more dollars, got a few more cents to go here, but we're going to want to keep an eye on this because it has been underperforming not only the market itself, but its XLY, its consumer discretionary subgroup. Facebook up 0.75%, Alphabet up 2/3. Let's take a look at the performance sorted, and we can see that NetEase too, and Lulu and Apple, lots of strength here all around. To the downside, we got Insight, Dollar Tree, and Ulta Beauty. We've taken a look at this one at various times in the year. Kind of broke down in a big way. Still kind of a broken stock, but is trying to base here. It's going to have to climb above 270 to even consider taking another run at those highs there. Well, we're going to be back in a minute, so don't go anywhere.
Stocks are at record highs to end the year, and our next guest says the rally will continue into 2020. Joining us now is Hillary Kramer of Kramer Capital Research. I guess by how much is the question, right? Because I think, Hillary, that the consensus is that we'll see sort of a middling rally next year. But how robust do you think it will be?
It still will be single digits. We're not going to see a 35% increase in the NASDAQ 2 years in a row. It's almost statistically impossible. I mean, and yes, that's what we say, and that's why we talk about black swan events. But the economy has just gone so forward based on really rates being at just the lowest level possible and money's sloshing around. But we're seeing a few little cracks here and there with the banks having trouble with car loans, and everyone will tell you, yes, it's a tight real estate market, but really people have been outpriced, which means the inventory will start to pile up. But I do see a very good, strong year next year. As we head towards the election, there will be people on the sidelines who learned their lesson in 2016, which is you never know.
Yeah. You never know, and yet, if you look at, we had a guest last hour talk about watch the money flows. We've seen money start to flow back toward equities, and yet they're still vast. We're talking trillions of dollars on the side, which has not totally returned, and it will take a long time to return.
And that's absolutely right, and that's why the market's so exciting, and stocks are so exciting. If you just invest in the spiders, let's say, sure, we're going to go to 3,300 to 3,500 if you go just SPY, but it's going to be the kind of market where it's more of a stock picker's market. It may be the year that GE suddenly goes to $20 from 11, and we have a double there. Or Boeing, at 320 goes back to 440, and then other stocks like Microsoft, which I love. I absolutely love Microsoft. It's a stock I own in my own portfolio and have for years. It may just languish, especially Xbox, slow down in next generation software. All of that means that we are going to see rotation. Certainly the banks are thriving. It's great for them because really a lot of their competition got knocked out in Europe, and our banks like JP Morgan, I love Goldman Sachs, and Goldman Sachs finally above 230. I think it could be a $300 stock. We could be sitting here a year from now saying, how come we all went back into AMD? What were we thinking? Why did we go into Intel? When in actuality, it could very well be the Goldmans and the GEs that are the big winners.
So looking at like outside events, it's an election year next year. How does that play into this whole equation of what investors are going to do with their money?
Well, because the market is just everything is just so fast right now, and the way technology works, we could see some whipsawing around. My fear has always been if we have anything exogenic happen, so let's say any kind of geopolitical
North
event.
Korea.
Right. Let's say a bomb goes off somewhere. The problem is that we don't just go down 6 or 7%. It's sort of like selling begets selling, just like buying begets
Well, because
buying.
everything is algorithmically and computer assisted and all of that, and that exacerbates any of the moves that we have.
Julie, exactly. That's exact problem. And so many investors have made so much money. I mean, it's kind of incredible when you think about it. Stocks like Visa, which are great, and they may continue to rise. I mean, that's another one I like. People just have so many doubles and 300% winners. You could see a lot of selling take place. The IPO market, that's an area that I'm concerned about specifically, Pras, in asking that question, because that's where some new IPOs might not be able to get the kind of flow of money in. I'm seeing that a lot of these biotechs right now, it's kind of crazy. There's a lot of opportunity there. Goldman, JP Morgan, they've put out some great IPOs this year. DTIL, VIR, Biohaven Technology. It's a migraine medication and migraine prevention. And these companies just got lost. And it's so interesting that all the attention's been on Uber and Lyft. And so what we could see happen is that they're not going to catch a bid like they should be. That's where the investors who want to double their money or triple their money really should be focusing. And also we have to think about a lot of the healthcare companies. Like I follow Biomet Zimmer, ZMH. So these Medtronic.
Medical device companies.
Exactly. Yeah. So the medical devices, if there's any concern about, if Elizabeth Warren is coming in versus Donald Trump again, we could see the medical devices really take a fall after they've done very well after a number of years really just being sleeper stocks until this year.
That makes sense. Well, you've given people a lot of stock ideas and packed a lot in there. Hillary Kramer, thanks for being here of Kramer Capital Research. Appreciate it.
It's been a great 10 years for many companies, but only one can be the Yahoo Finance Company of the Decade, and the winner is Disney. Dan Roberts is here to explain all the reasons why Disney is our big winner.
That was a long drum roll.
Well, look, Disney, not one of the top 10 or even top 20 best stocks of the decade, rose about 400%, so it did go up more than the S&P did. But it's not just about stock performance. I mean, we looked at M&A activity, we looked at reinvention, and we'll talk about that in a moment when we talk about leadership. We also named a CEO of the decade. But for company of the decade, I mean, just look at what Disney has done in 10 years. You know, right now when we talk about Disney, all the conversation is around streaming with Disney Plus, and I would add not just Disney Plus, there's also ESPN Plus and Hulu. Disney now has a three-pronged approach to OTT, but that's just the hyper recent. I mean, this decade was Lucasfilm. That was in 2012. It's sometimes crazy to think that that was only 7 years ago, and in that time, Disney has put out 5 new Star Wars movies. 4 of those topped $1 billion at the box office. One of them topped $2 billion at the box office. So this decade had the Lucasfilm acquisition. It also had the Fox acquisition, huge. And look, the jury's still out on whether that was worth $71 billion. There's some critics already rushing to say that Disney overpaid. But boy, you're ignoring then Marvel, Lucasfilm, and Pixar in terms of the IP and new franchises Disney was able to squeeze out of those acquisitions. So give it time before you evaluate whether $71.4 billion was too much to pay for Fox. And all of that I'm bringing up is still just on the media side. Parks revenue, which by no means is meant to be just a side note, doubled it over the last 10 years. And look, Disneyland Shanghai opened up. I mean, that was a mega undertaking. Interestingly to me, that was what Bob Iger in his new book said it was the biggest achievement of his time as CEO, was opening up Disneyland Shanghai. I mean, the regulatory hurdles, and physically that is 11 times bigger than Disneyland in California.
Wow.
So quite a lot of highlights. I mean, a company that it's just so much more complicated than a big media and entertainment giant gets bigger. I mean, so much happened for Disney in the last decade.
And yet, I was going to switch gears to the leadership of the decade, because as you mentioned, you guys picked a CEO of the decade too.
Yep.
Ironically, not by Iger.
Reed Hastings.
And at Bob Iger's competitor.
Yes, and look, I was saying the story, some readers might say, well, wait a minute, are those two things kind of contradictory because these are two competitors now? But Disney and Netflix were really not competitors until quite recently. And I think our reasoning, and sure, we could have said that Netflix was the company of the decade. And by the way, when it comes to stock, Netflix, the #1 best performing stock of the last 10 years, went up 3,700%, 3,700%. You see it on your screen there. And look, when we talk about CEO of the decade, I think we wanted to make a point about leadership. And I think that although Disney had this incredible 10 years, I mean, look, we also could have made Iger CEO of the decade. But Hastings pulled off what some people out there have called a double pivot, which I think is a fair term for it. 2 major complete reinventions all in the last 10 years. So as of 2007, Netflix was a company that sent out DVDs in the mail. Then it launches streaming, not until 2010, which by the way, I know, it wasn't that long ago. 2010 launches streaming as a standalone subscription option. When it first started streaming, it was just an add-on.
Yeah.
So if you want to pay a little more, and we at this desk remember this, I think a lot of people out there have already forgotten those red envelopes in the mail. By the way, 3 million people in the US still get the DVDs in envelopes.
Wow.
But 2010, Netflix launches streaming as a standalone option.
The criticism of it.
That was a major reinvention, and if you recall, at that time it also said that its DVD business would change names to Quickster, and it quickly abandoned that idea. Then fast forward to, I'd say in the last 3 years, the second reinvention. For a while, Netflix was a place to find licensed content. So yes, it had a ton of stuff, but it was made by other people. Then, second reinvention, Netflix becoming a maker of original content, and now really the maker of original content. I mean, case in point, small little stat here that I think is eye-popping. This year, 34 Golden Globe nominations for Netflix. ABC, NBC, CBS, 0.
All right.
Just real quick, pivoting back to Iger. Looking back on it 10 years from now, is he going to be mostly known for all those acquisitions or the big pivot to streaming, right? Like, what's he going to be? What's his legacy?
That is the question. And look, I think he sees where the puck is going with OTT and direct-to-consumer. He said before they launched, ESPN Plus even, that direct-to-consumer, i.e. streaming, has to be our #1 priority as a company. So I think he will be talked about as an M&A god, with all those acquisitions over 15 years. But you're right that I think the streaming is where Disney is headed in terms of the media and entertainment. But look, there's still parks, there's cruises. Disney Cruise Lines is going to double in the next 5 years.
All right, coming up, polling impeachment, how President Trump's troubles stack up against past administrations. And before we go to break, let's take a look at some of the top trending tickers on Yahoo Finance today. Can you say online shopping?
$12:35 here in New York City, 3 hours into the trading day. We're watching stocks trade higher on this day after Christmas. We're also watching gold trade higher, and right now you can see that gold is trading at $1,514 an ounce. Playing politics, a new poll shows nearly half of Americans approve of President Trump's impeachment. The hottest trade on Wall Street, why 401k plans have not fully embraced the ETF. Plus, tweeting on Christmas, why the president is threatening to bring in the feds to fix California's homeless problem. Welcome back to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for staying with us. Well, there's a new poll out from HuffPost and YouGov that shows that nearly half of voters approve of the impeachment of President Trump. Joining us now to discuss is Doug Wead. He's author of Inside Trump's White House, the real story of his presidency. Doug had unprecedented access to those close to the president. And I'm curious, on one level, this presidency feels very transparent because of the sort of constant communication via tweet, frequent comments to cameras as well. So is there anything perhaps, especially when it comes to impeachment and the public opinion about it, is there anything that we as Americans, as voters, maybe don't know about the White House's state of mind on the matter?
I don't know. I asked Jared about the staff and how they feel during this assault and this great controversy over impeachment. He said there are two kinds of staffers, those who want to help Trump save the world and those who want to save the world from Trump. So there's still controversy even among the White House staff.
Well, you had, incredible access to insiders at the White House. I'm curious, what would you say to all of us is the greatest misunderstanding of President Trump? on the part of the people, not the president's misunderstanding of events, but those of us who are watching?
Well, for me, it was the calculation involved. I have interviewed 6 American presidents and known some of them extremely well, had them in my home, been in their home, been in business with some. And having served on senior staff at the White House, I know that it's a lot more calculated than anyone would ever imagine on the outside. So I went in thinking, I'll bet some of this is more calculated than it appears. But I was blown away. There's calculation in the chaos. I think Sun Tzu, maybe correctly or incorrectly, has attributed the quote, out of chaos comes opportunity. But that's what he does. He blows up NATO. He rebuilds it, raises $100 billion. NATO's stronger than ever. He blows up NAFTA. 17,000 pages, the North America Free Trade Agreement. He just blew it up and rebuilt it better than it had been before. So I saw that there was some calculation behind his methods and what he does.
Doug, Dan Roberts here. Thanks for coming on. Let me ask you, in your time reporting out the book and, as you said, interviewing a lot of people at the White House, just how upsetting is the impeachment, even what has happened so far with the House, to Trump personally? Now, of course, Trump supporters have brushed a lot of it off as, partisan stuff, and it's just the Dems doing their thing. And a lot of people have even gone so far as to argue that the impeachment helps his reelection campaign because he can point to it and say, look, it was a biased witch hunt, et cetera, et cetera. But clearly, even if it doesn't matter, even if it was just symbolic, he doesn't like it, and it's extremely upsetting to him. Tell us a little bit more about how Trump feels about it.
Yeah, I think it hurts him, but he would never acknowledge that or say that. On election night in 2016, around 5 p.m., when the feeling was he was going to lose the election, they came to him and told him, hey, what are we going to say to the people at the Hilton that are waiting to hear from you? What are you going to do? He said, well, I'm going to go downstairs, go out on Fifth Avenue. I'm going to tell folks I tried my best. I worked very, very hard. I'm a patriot. Then I'm going to get on an airplane tomorrow, fly to Ireland, and I'm going to play a game of golf. So there's a part of him that is going to survive no matter what happens, and he'll tell himself that. And maybe he's better at that than most people are, but still he has to feel that this is personal, because in some ways this impeachment is helping him. It's not helping his enemies, but they don't care. They're doing it even if it's self-destructive because they want to hurt him personally. Ivanka said to me, I refuse to be bitter. I will not be bitter. I don't function unless I'm happy. So I choose to be happy. And I think that's how most of the family are dealing with this.
So you said you have interviewed a number of presidents. What stands out to you about this presidency as being distinct from the others?
Well, it's interesting, Julie, that all of these presidents are good listeners. I wasn't prepared for that. You only see Trump when he's talking. So there were many times where I had to say, wait, because he was interviewing me. He is a good listener. They're all good listeners. But he's different because he hasn't had the political experience, and he didn't bring with him an army when he moved into the White House. There's positives and negatives to that. We can see the negatives to that. If you run for Congress or governor, you've got this army, and they move into the White House with you, and they fill all these positions, and they cover for each other. You don't have to inherit the so-called deep state from other presidents. But there's a disadvantage in that, too. I've been a part of that army with presidential candidates, and not only does he have the army has him. There's a limit to what he can do without offending his base or the money or supporters he has. With this president, he can turn on a dime. He can do something that conservatives don't like or liberals don't like or Republicans don't like. I also noticed he brought people onto his staff who didn't like him and didn't agree with his policies, and he brought them on anyway. John Bolton is an example. He likes a good argument. He likes them to fight it out. He wants you to fight with him and tell him why you think he's wrong. Then he makes a decision and expects you to fall into line.
Doug, thank you so much. Doug Weed is author of Inside Trump's White House. Appreciate it.
Coming up, ETF boom, why your 401k plan could be next to embrace the $1 trillion trend. Plus, before we go to break, let's take a look at some of the most active stocks on Yahoo Finance today.
Let's take a look at some trending tickers from yahoofinance.com. You guys are watching the biggies today, apparently, and those that are linked to online shopping. As we've been talking about, Amazon has come out with some preliminary numbers about the holiday season, and they have been strong, as well as those numbers from MasterCard Spending Pulse that showed strong growth in online spending. So we've got Amazon shares actually up by about 3% today, as it has been benefiting from perhaps that sentiment over the holiday shopping season. The shares, though, for the year just about paced what's gone on in the broader markets. They're up about 23%. Apple on your watch list as well today. Those shares up 83% year to date, so obviously performing a little bit better. And I believe they are trading at a record again today. And then Shopify, I wanted to point that one out again as well. Shopify kind of does the back office, if you will, for a lot of the online retailers. Those shares have just about tripled year to date, and they're trading up by another 3% in today's session. If you're following today's trending tickers, make sure you're watching the ticker. It's right here at 2 p.m. on Yahoo Finance. The S&P 500 and NASDAQ, and I think the Dow, too, hitting fresh record highs as Wall Street looks to close out the decade with a bang. With valuation so high, is there still room for growth in 2020? Joining us now is Ideal Asset Management CEO Rahul Shah. Thank you for being here. So, Rahul, we've had this debate, especially in the latter half of this year, between sort of value and growth, right? Yeah. And a lot of folks seem to be tilting towards value. You still, though, say growth is worth it at a certain price.
Yes, exactly. We've had, obviously, a very strong end to the year 2019, and with the Fed on hold for the foreseeable future, I think the path of least resistance for the market is higher. So therefore, we prefer secular growth stocks over value stocks going into 2020.
And what do you mean by secular growth stocks?
What we mean there is we're looking for companies that are in dominant positions within an industry that have a macroeconomic or a demographic tailwind that will propel the company's growth for a multiple year period.
JP Morgan Chase, we just had a guest on who said, look at financials in the coming year and expecting some growth there. So I don't know if you can go specific with a stock, but if you can, is JP one of those?
You know, JP Morgan is actually not, we have nothing against JP Morgan, the company, but what we prefer is Visa over the traditional money center banks, because we think that the growth rate is higher. You're looking at a mid-double-digit growth rate. And as you know, here in the U.S., we all use our credit card so often, but in a lot of emerging markets, they still have a lot of cash-based transactions. So we think there's a strong tailwind of growth for both Visa and MasterCard for the multiple-year period. And with valuations so high, we also prefer growth stocks, but we would avoid actually the very high multiple growth stocks like your Salesforce or Amazon, and we would avoid your very low multiple tech stocks. So what we're looking for is on 2020 numbers, maybe between 20 to 25 times earnings, because those companies have a story that's being rewarded by the street, and we want to go with areas that have momentum. But at the same point, we want to not pay too high a multiple in case we get more volatility, which, as we all know, can happen a lot in Wall Street. If you hold stocks for a 3 to 5 year period, we think in these type of stocks you'll be good.
So value, okay year this year, underperformed for 15 years it seems. The Nasdaq's at 9,000. Why do people hate value so much?
Well, there's definitely as you pointed out, if you've been a really deep value investor and you've avoided a lot of the tech names, you have severely underperformed the market. So you can keep beating the value drum as much as you want, but at some point you have to go with where the market tides are shifting. And I think a lot of it is obviously the increase in technology, the way we use, like if you look at Amazon, the whole shopping experience has been changed. So if you go bargain value hunting among retail names, you could really do really bad. So we think, you're better off going with companies that have the technological trends going with them.
Rahul Shah from Ideal Asset Management. You're the CEO, and we appreciate your being here on the day after Christmas.
Thank you. Appreciate that. Happy holidays.
A decade ago, $1 trillion were invested into ETFs, but what does the future hold for ETFs, specifically in regard to your 401k? Joining us from the newsroom is Yahoo Finance's Jared Blickery. So bring us up to speed. When do we get to choose ETFs in our 401k?
Oh, it's right around the corner. I bet we've all been waiting for this. And maybe it'll help the situation where we've seen, this has been a year where we've seen a lot of ETF equity fund outflows. That trend has been reversed as of late, but we've seen tremendous flows into bonds. And you consider, if you have a particular opinion about the market, there's an ETF for just about anything, including gold, GLD, which just broke out yesterday. And, going forward, investors really should have the ability to choose their own ETFs, but it's probably going to get to a situation where people are over trading or probably picking the wrong investment vehicles to guide their investment decisions, because most people are buy and hold, but people who do try to time the market tend to get it wrong. So that's the unfortunate downside of this particular thing.
Well, I guess so, unless you end up holding the SPY or holding the QQQs, which a lot of people do. We were just showing a chart about the forecast growth for ETF assets. Dave Natick over at ETF.com, he's the one who's made this forecast that we're going to get to parity between mutual funds and ETFs. He's saying now by 2024. And he also has said that people really scoffed at him when he started making these kinds of predictions. But with the growth, and especially if you start to see broad 401k adoption, it's not so tough to see that really accelerating.
Yeah, I agree with that. And there's some other things entering too. Consider the race to zero brokerage commissions. You have companies now that are selling their order flow but not making as much money off of that as they used to on brokerage commissions. So what do? They are able to offer their in-house ETFs and mutual funds, but more so to the ETF space recently. So that's what Charles Schwab is doing. And when you have several trillion-dollar asset managers being able to promote their own funds, people are going to gravitate towards those funds. So I wouldn't be surprised if his math is correct, and we do have ETFs getting more money than mutual funds in 2024.
All right, stay tuned. Thanks, Jared. Coming up, swiping safely, why debit cards are ranked among the least secure ways to pay. Plus, challenging the status quo inside an Olympic skier's non-traditional engagement.
Let's take a look at the top trending stories on Yahoo Finance right now. Debit card transactions may be on the rise, but they are actually the least secure way to pay. That's according to the Federal Reserve. More than $7 trillion of card payments were made in 2018. Yahoo Finance's tech editor says the most secure way to pay is actually Apple Pay, Google Pay, and Samsung Pay. An inside look at organized crime. The World Economic Forum asked about 17,000 business leaders about the ways organized crime impose costs on businesses. Among the countries that were impacted the most include El Salvador, Mexico, Venezuela, Haiti, and Brazil. Among the least impacted were Finland, Iceland, Singapore, and Switzerland. We'll be right back. Time for the buzzer beater round. 3 stories, 1 minute each, and we're going to start with this. 11 years after J.P. Morgan is breaking even on its purchase of investment bank Bear Stearns. The deal closed in May 2008, but then the recession hit. In the past 10 years, J.P. Morgan stock is up 231%.
So this presupposes that you bought Bear Stearns stock at $30, where it closed on the Friday before the fire sale to J.P. Morgan, which ended up being
almost $10 a share. Remember, the deal was $2, and then people went nuts, and we're talking March 2008.
Big presupposition.
So, yeah.
Yes. Yes. Well, they found the Wall Street Journal found a guy
who bought it
and held it and ended up with the J.P. Morgan stock because it was a stock deal.
He hodled.
And then held it since then.
He held it.
Now he's hold, but he says he'll hold on to it so he has a story to tell his grandkids.
Was it 300 shares? What was it? 30?
Oh, that one guy had?
Yeah.
I don't remember exactly how much he had in particular.
Yeah.
Yes,
Nothing.
But it's just sort of, turning of an era, I guess.
But do you remember?
Well, look, this happened at it was a distressed asset. I mean,
yes, definitely.
So, what do we say now? Is it a failure? Is it a failed acquisition?
All right, who's going to solve California's homelessness crisis? It turns out the federal government may step in. On Wednesday, President Trump tweeted a warning to California Governor Gavin Newsom, saying the federal government will intervene even if Newsom is unable to solve the crisis, or I guess if Newsom is unable to solve the crisis. Pross, you're laughing.
Just a little smack of Gavin Newsom there. What's he really going to do? What are they really going to do in California?
Yeah, Gavin Newsom should actually maybe call the bluff and say, "Okay, Mr. President, come on in,"
Come on in.
because you can't put people.
Fix it.
Yeah.
Let's see what his plan is.
This was fought 30 years ago. The ACLU. There are no mental hospitals in which you could put these people where they used to be housed.
I'm very interested to see what President Trump's idea is to fix homelessness in California. Let's see it, baby.
He's very concerned about the people of California and not just concerned about sticking it to a political rival.
There's a legitimate issue. We have economic homelessness and we have mental ill homelessness.
And if you go to San Francisco, I mean, I've never seen
there is a legitimate issue.
It's more apparent.
But that's not really what this is about.
Yeah. No. Political rivals.
All right, we're going to move on. Olympic skier Lindsey Vonn got engaged again, and this time she popped the question. Vonn gave an engagement ring, are you listening, ladies, to her already fiancé, NHL star PK Subban, for their 2-year anniversary. If you put a ring on it.
I like it.
Exactly. Yeah, why not?
The gender roles. Cool.
Although it's interesting because they're already engaged, and now it would have been even better if she had just proposed to him straight up.
When I first read the story, I was like, wait, she actually proposed to him? What a lucky guy. But it turns out not the case. But hey, it's fun to sort of return the favor, right?
Agreed.
And you would like that, wouldn't
Did
you?
your wife give you diamonds or gold?
What I see more of people saying isn't, wow, she proposed to him, but they're saying, see, men should have some kind of ring they wear. And I do think it's often strange how, the woman wears an engagement ring and the man wears nothing. There's no way of knowing.
Either that
the dowry?
or nobody should get rings. How about that? You just make the promise. You don't need a piece of metal
but
or
then that
gems.
song goes away.
Granted, I got one and I wasn't, I'm not going to give it back. But you know, I'd say
The beer's not
turn it on its head.
The beer's
Yeah, I don't. Tiffany doesn't like that idea.
That's all right. They'll be fine.
Happy
Thanks,
day
guys.
after Christmas. Wi-Fi PM is next.
It is 1 p.m. in New York City, and the Santa Claus rally is officially underway, with the Nasdaq touching 9,000 for the first time ever. On tap for today, Christmas is over and new shopping stats are officially out. How strong online sales gave holiday retail a big boost this year, that's next. Plus, the fight for $15 is gaining traction nationwide, and Amalgamated Bank's CEO joins us to discuss, as the minimum wage in over 20 states is set to increase next year. And Campbell's is jumping on the Beyond Meat bandwagon by creating its own veggie-inspired snack. We'll reveal the flavor of their new goldfish crackers just ahead. All that and more, this is Wi-Fi PM. I'm Heidi Chung, filling in for Zach Guzman, and joining me today, the day after Christmas, is Wi-Fi PM's Yahoo Finance's Brian Sozzi, along with New York Post finance reporter Thornton McHenry. Thanks so much for joining us. Congrats on the new gig.
Thank you.
Brian, it's your debut today, right?
I'm just happy to be here, keeping the seat warm for y'all.
Thanks for joining me. Let's check the market action today. We are midway through today's session. The S&P and NASDAQ hitting record highs earlier in today's session, and the NASDAQ above that 9,000 level for the first time ever. We will be continuing to monitor all of the market action today, but first, consumers spent a pretty penny this holiday shopping season. According to MasterCard's Spending Pulse report, overall retail sales rose 3.4% between November 1st and December 24th, and online sales increased nearly 19% as specialty apparel and electronics dominated e-commerce. Joining us now for more insight is MasterCard's senior advisor and former Saks chairman and CEO, Steve Sadoff. Steve, thank you so much for joining us. The last time we spoke, you kind of gave us a preview on what to expect this holiday shopping season, but we finally have the data out today. So can you sort of break down the biggest takeaways from this report?
Sure, happy to. And this really turned out to be a very good holiday shopping season. Everybody was apprehensive because of the shortened season by 6 days, but the numbers coming in at 3.4%, and that's ex-auto. If you look at it as ex-auto and gas, it's a 4% growth. The 3.4% is off of a 5.2% last year. So overall, this is exceeding the expectations by about 3 or 4 tenths of a percentage point. Very strong data. It came in late. It was a shorter season, started off very strong over the Thanksgiving holiday season, had a lull during the early part of December, and then very, very strong coming in at the end. The Saturday before Christmas, the Monday before Christmas really looked exceptionally strong. Internet drove a lot of growth. You saw on the screen an 18.8% growth on the internet, and that now represented 14.6% of all retail sales. And that is the highest level that you've ever seen out of the internet on an extended period of time. So really a good holiday season, and it indicates that the consumer, which we are all worried about, and that's 2/3 of the U.S. economy, is tracking along quite nicely.
Stephen, online sales absolutely look good, but we have gotten reports throughout the month of weak physical traffic in physical stores. If you're an investor, you're looking to invest in the department store space, a lot of these stocks have gotten hit, Macy's, JCPenney. What could the store closures look like from that space in the first half of 2020?
Well, if you look at the sectors that performed well, you had electronics, you had hardware, you had restaurants, grocery, all performing very well. The department store sector over the holiday season was down 1.8%. And even their online business was growing at about 6.9% relative to the 18.8% total growth. So department stores, and they have for some period of time, are facing headwinds. They got a situation where there are consolidation, you have store closures, and they've got to reinvent the experience within a department store. Otherwise, you're going to continue to see the contraction within that sector. So clearly, you're going to, given the trends of lower traffic and less productivity, you're going to see consolidation and contraction within the store base.
In terms of the retail space, how are people seeing this as something that's going to continue to next year, or is this kind of a last call situation? I mean, are we going to have another Christmas like?
Well, let's start with the retail. I hear all the time, retail is dead. The reality is retail is very healthy. These are terrific numbers. If you look at a 3.4% on top of a 5.2% last year, it is saying that retail is vibrant, but retail is different. Retail, you've got the digitally native brand, you've got omni-channel, you've got buy online, pick up in store. Brands and companies that are adapting and putting in the infrastructure and making the investments are performing well. The traditional brick and mortar store that isn't changing is having a much harder time. So are you at a tipping point with the internet where you're now at 15% growing at an 18.8% growth rate? Clearly, if you're not playing in an omni-channel perspective and an omni-channel basis and making the investments, you've got problems. But I think retail, the mindset being that it is growing is where we ought to think about it, but different. So you have the digitally native brands, for example, are all opening up stores because they're finding when they open up a store, they get 3 times the volume on their online business. So it's just a changing landscape. And when you use the examples of the Macy's, the JCPenney, the Kohl's, they're having to adapt dramatically in a world where the consumer may be changing faster than they are.
Steve, I want to talk a little bit about Amazon because the company reported a record-breaking holiday season as well, adding 5 million new Prime customers who either started free trials or began paying memberships worldwide. The company also reported that Prime one-day and same-day delivery quadrupled this year versus last year, noting that 3.5 billion packages were delivered globally in 2019. So this is pretty impressive, Steve. Do you anticipate that Amazon is going to continue to dominate the space as well as the likes of other big box retailers like Walmart and Target?
Well, Amazon represents almost half of the internet sales, and you've got the internet growing at almost 19%. So Amazon is setting the standard. It's not just in terms of the same day or one day shipping, which is now setting the standard for other retailers to have to mimic, but it's also in terms of features, functionality, ease of shopping. That's where Amazon really is so impressive and so important in the retail space, because even if a brand doesn't compete directly with Amazon, they have to deliver the way that Amazon is delivering, and it's remarkable growth that you're seeing. But other retailers, you use the example of Walmart and Target, they're competing differently, and they're doing it in their own way and performing exceptionally well. So there's a lot of opportunity. I see lots of categories doing well. We talked about electronics. We look at hardware. You look at restaurants, grocery. Experiential brands are performing well. So there's a lot of segmentation going on within the retail industry. You have so many ways that you can get to the consumer, and it used to be just that you had to go through a certain channel, let's say the department stores. Now there are lots of other ways that the consumer is able to get very differentiated product.
Stephen, just based on your years of experience in the department store space, do you see a place for a JCPenney in the next decade of retail? I see Target and Walmart making better clothes, investments in same-day delivery. I see a company like a JCPenney, high debt levels, years of struggling sales.
Well, JCPenney has had a tough run. They've got it. During the Ron Johnson era, their sales went from $18 billion to $12 billion in sales, and they've now got to figure out how to generate some growth. I think Jill Soltau, who's gone in as the CEO, is doing a very good job of trying to remake the merchandise, get back to basics, focus on apparel. But they've got to generate top-line growth. It's very hard given the amount of debt that they have, the amount of depreciation, and the requirement to keep a fresh store base to do it without top-line growth. So the challenge for them is generating growth. I look at somebody like a brand like a Kohl's, where they're bringing a lot of differentiation, Amazon returns, exclusive brands, changing the experience in the stores. That is what's required. Now they've got to translate. Right now we're in a very interesting period because we had very good top-line sales growth through the Christmas period. Lots of online sales. You're also going to get a lot of returns. Well, Kohl's is now a place where people are going to be able to return their Amazon products. Are they going to be able to translate that into incremental sales? Whether they do or not is going to be a very big factor in terms of how that company does. So you've got to look at how do you change the experience for the consumer? Because go back to the JCPenney example, if they don't do something different, and you see a new approach that they've tested in certain markets, if they don't do something different, it's going to be very hard to get to that growth path that you're talking about. But a lot of other retailers are demonstrating that that can be done.
Steve Siodoff, thank you so much for joining us today.
Thanks.
Credit card payments are on the rise, with total card payments surpassing 130 billion transactions in 2018, according to the Federal Reserve's latest payment study. But swiping that card may not be the safest way to pay for goods, as magnetic stripes can make consumers vulnerable for fraud. So guys, debit cards are particularly dangerous because they use money from checkings and savings accounts. But does it surprise you at all, to be honest?
I feel like everything is subject to being a fraud at this
Right,
point. I mean,
right.
it's you just got to live your life. But yeah, I mean, we're going back to cash or just full on doubloons, I think, at a certain point for safety.
Let's lose cash. I'm going to the gas station. I'm using my card. It says protect your PIN. Clearly, there's a fundamental flaw in this stuff, and I think the hackers have gotten out in front of a lot of people with the magnetic stripes, which harken back, 20, 30 years?
But you know what surprised me is, though, you know how we made that shift to the chips, and that was supposed to be safer? Mm-hmm. Allegedly, it's not even that much safer. So whenever I go to a store and I use the chip, no one even checks my driver's license or my ID or anything like that. I just stick a card in there. They're like, oh, it's safe, so we're not even going to check the identity. But I feel like that's not even the right move either.
There's no time for that. If you're using a chip in a department store, those employees have to go service online orders now. They don't have time to check your face. Come on.
Some of the safest payment methods, though, are smartphone services like Apple, Google, and Samsung Pay. My question, though, is also, what about services like Venmo? Do you trust that? Can that truly be trusted at this point?
Again, I think you're taking a gamble at every point. My plan is to not have very much money, which I think is working out well for me generally. There's a lot less to steal, a much less of a prospect. No, but I think Venmo. Yeah, it does seem strange. Especially someone my age is like, this hack can't be right. But yeah, I use it.
Well, this is only going to get worse, Heidi, because you go to a lot of places and they no longer accept cash. Why? It's a cost of doing business for them, and they don't want to deal with cash. Take the cash to the bank, have to hire an extra employee to handle the cash. They don't want to do it. When their wages are going up in some, let's say, restaurants, $15 to $20 an hour a pop, you have to take out costs somewhere.
Yeah, and I think, this is all just up to the consumer, right? And the person using the card, you got to be safe and be smart. Yeah, but coming up here on Wi-Fi PM, Boeing backlash, what the company's new leadership plans to do differently, as a new report reveals disturbing allegations about the 737 MAX jet. Incoming Boeing CEO David Calhoun is working to mend the company's relationship with regulators. The Wall Street Journal reports the executive called the FAA head earlier this week as 737 MAX concerns continue to ramp up. New documents reviewed by a congressional panel reportedly show some, quote, very disturbing revelations regarding the grounded jet, according to Reuters. Guys, what do you make of the continued fallout that we're seeing at this point?
I mean, it seems like that everything with this whole thing has been odd, timing-wise. I mean, why now we're switching jockeys of this horse? I mean, they've lost, what, 55 billion or more, 60-something billion in market cap throughout the year. Their planes can't stay in the sky, idea is what is the FAA's concern. And now they're switching CEOs. It seems to me, and this guy's going to focus on FAA cooperation, which makes you wonder what they've been doing before. I mean, it's just this, the Boeing to me has become this sort of, it's like a slapstick stock. It keeps tripping over itself, which is terrifying because it's such a massive company employing so many people.
I think it's a poster child for corporate greed. It's a stock and it's a company I covered closely in late 2017, late 2018. The stock was seemingly going up every day. It was powering the Dow higher. There was just a continued focus on them raising their dividend and buying back tons and tons of stock. And I think what you're seeing with Boeing is the culture at this company is in a big pickle. And you have to see Calhoun, the new incoming CEO, he has to clean house with a lot of these executives. You are not going to reset a culture at a company like Boeing unless you clean house and set a clear message. We're not going to tolerate this nonsense anymore.
Right.
Yeah, I mean, in a way, sorry, but Boeing, yeah, so what your point, Boeing's almost like watching what happened in GE over a decade happen in a year.
Yeah.
It's wild.
Absolutely.
It's like a Benjamin Button GE situation. It's wild. It's this hilarious timeline thing.
Well, this is what happens when you are so focused on making bottom line numbers. And I think at Boeing, the past couple of years, they've been so focused on beating earnings in a big way that they've lost sight of focus on how to safely make airplanes, which is the business they're in.
So Boeing responded to the report in a statement to Yahoo Finance stating, quote, Boeing proactively brought these communications to the FAA and Congress as part of our commitment to transparency with our regulators and the oversight committees. As with prior documents referenced by the committee, the tone and content of some of these communications does not reflect the company we are and need to be. We have made significant changes as a company in the past 9 months to enhance our safety processes, organizations, and culture. Now, some would argue that they actually haven't really made any progress on any of those fronts. But my question is, okay, a lot of people were saying Muhlenberg was on borrowed time here, right? Some would say he lasted much longer than he should have. But do you think Calhoun is the right person to make sure that the 737 MAX gets into the air as soon as possible? Because what is Boeing without the 737 MAX at this point, right?
Well, they're essentially a defense contractor.
Yeah, that helps. I mean, I don't know. I think if it's a culture thing, which again, I mean, I don't know how to make planes, but I do watch culture from that. We're seeing what happened with Wells Fargo a couple years ago, which was, they wanted a fresh start and they just promoted somebody, and it did not work out well. So the idea, I don't know if they're going to go with this or if he's a trial balloon to see how Congress likes him. And in the background, they're conducting a furious search for a new CEO.
And if you're if you're an investor and you're wondering about this stock, should I get into it? Should I not get into it? You look at GE, and I think that's a perfect example. It could take years to fix a culture. New CEO at GE, well, he's no longer a new CEO. He's almost 2 years into the gig. It takes time to change culture. And for him, he's had to sell off businesses. He has really had to hop on these earnings calls and deliver a clear, consistent message. Even now, there are a lot of people concerned about the culture at GE still after his leadership.
And I'm sure we're going to talk about Boeing for many, many days and months to come.
Would they hire Elon?
It's coming, right?
Yeah, Elon Musk, CEO of Boeing.
All right, shifting gears here, Uber co-founder Travis Kalanick is severing all ties with the ride-hailing giant. Kalanick will step down from the board effective December 31st, and the New York Times reports as of today, he will have dumped his entire stake in the company since its stock lockup period expired back in November. Brian, Uber is down over 20% since its public debut, and as you can see there, the chart's not so pretty at this point. So as an investor, do you get into this stock now? Is this a buying opportunity, or should you just, if you're an early investor, should you just dump what you already have?
Well, I couldn't speak to whether it's a buying or selling opportunity, but when you see the founder out there dumping all their stake and essentially waving goodbye to the board and all his inside information to the company, usually not a good sign. Now, I've said consistently I'm not a big fan of Dara Khosrowshahi, the CEO of Uber. I still don't think he has communicated well with Wall Street. A lot of the people, the coverage analysts that I talked to on Wall Street, are not happy with his leadership. In many respects, it's been tone deaf.
Okay, it seems as if Kalanick's new project, though, is cloud kitchens or ghost kitchens, right? So do you think that this is a good bet at this period in time when we have all this drama about competition in the third-party aggregator space? And is delivery truly the future here?
I mean, I think his problems lie less with the business model than they do with him. I mean, I think Travis has a lightning rod. Also, I mean, I think from my perspective, getting out of Uber makes sense for him for a number of reasons. He can get liquid now. He needs the money. The people who have been running Uber now have seen him as an existential threat since the moment they got rid of him. So everyone's going to breathe a sigh of relief he's gone. But I mean, for Cloud Kitchens, he's going to go raise money from the Saudis again. This is what Travis does. So, I mean, getting cash heavy now is a good idea. Then he can go to the Saudis and ask for more money. But I mean, the idea is who he's friends with less than I think his ideas. I mean, he's a good salesman. The guy's a good entrepreneur. He can make anything sing for a while. But it's the end of it that he has the problem with.
And who's to say he won't come back and have that Steve Jobs moment?
I mean, a lot of people would argue that the culture of Travis Kalanick is still deeply ingrained in Uber's culture. So his presence will never be gone.
I think Dara's problem communicating, I think Brian's right, he does. And I think it's been a real nightmare situation for that guy. But I think it's because he's communicating something Kalanick built in his head. I mean, Uber is very convoluted as a company. It's very hard to understand what they do, I think, even from inside. So, yeah, the one guy who communicated well is the guy who thought it up.
They do help me get to work, though.
Yeah, I mean, you just jump in, that's fine.
Yeah, of course. But coming up here on Wi-Fi PM, a fight for the $15 is gaining traction nationwide. Amalgamated Bank's CEO joins us to discuss as the minimum wage in over 20 states is set to increase next year. Welcome back to Wi-Fi PM. Let's take a quick look at where the markets are right now. All three of the major indices are holding on to gains here. We have the S&P and NASDAQ hitting record highs earlier in today's session, and the tech-heavy NASDAQ is holding above that 9,000 level. The fight for $15 is gaining traction nationwide. Over 20 states are gearing up to raise minimum wages in the new year, but one bank is already ahead of the game. Amalgamated Bank says it was the first bank to raise its minimum wage to $20 or $15 back in 2015, and just this year upped its minimum hourly wage to $20 an hour back in July. Now joining us to discuss this is Amalgamated Bank CEO and President Keith Mestrich. Keith, thank you so much for joining us.
Thanks for having me, Heidi.
So tell us a little bit more about why you think the states should raise their minimum wages here, because while it's good for a lot of these employees, some would argue that small businesses would suffer here.
Yeah, Heidi, it's going to be a really happy holiday for a lot of people around the country. At the first of the year, 21 states are going to raise their minimum wage, and it couldn't come at a better time. As you know, the economy's been on fire now for a very, very long time, but many of the rewards have really gone to the people at the top of the ladder, not to the people at the bottom. We haven't had a minimum wage increase at the federal level for over a decade, but many states are beginning to take that action. Our company was proud to take that action, and it's just time to actually share the wealth with the people who do so many of the important jobs in all of our companies.
Now, Keith, where have you, when you take your wages to, let's say, $20 an hour, where are the increases in services? Where have you taken price increases essentially to offset some of those costs?
Yeah, there's a dirty little secret in the banking industry, which is the average wage for a teller is around $13 an hour. So those people who handle those important transactions every day, either at the front of the house for us in our branches or in the back of the house in our operations things, in our mail rooms, the people who clean our offices, do the food service at our companies, are the people who are really making seeing the most increases in their paychecks.
And where are you seeing it? How many states are you guys in?
We're in 3 states. We have offices in New York, the District of Columbia, and in California.
And Keith, when we talk about a lot of these other industries, though, aside from the banks and financials, specifically the restaurant stocks and companies, their margins are severely pressured when we see wage inflation like this. Do you think that they're going to have to just raise prices and deal with this? Is this just going to be the new norm?
Thanks, Heidi. I'm a bank CEO, not a restaurant CEO, so I wanted to do what was right in our industry to make sure that the people who work in the banking industry were taken care of. The studies are really divided. In many studies, there is very little demonstration that raising the minimum wage has any impact on employment whatsoever. In fact, there's a lot of studies that show when you raise the wage across the board, it actually leads to increased business activity in sectors like the restaurant industry and other retail stores.
Keith, has the Trump economy been good to the customers of your bank?
Trump economy, how much of it's attributable to Donald Trump and how much attributable to Barack Obama is hard to discern. But certainly the economy that's improved over the last decade has been good to the people who work for us and the people who are our customers.
All right, Keith Mestridge, thank you so much for joining us.
Happy holidays.
Coming up, gold vaults over $1,500 an ounce. We'll explain why the yellow metal is shining up next. Welcome back to Wi-Fi PM. All 3 of the major indices holding on to gains, with the S&P and NASDAQ hitting record highs earlier in today's session. Let's check in with Scott Gamm on the floor of the New York Stock Exchange. Scott?
And Heidi, what's most fascinating about today's action is actually the leadership in the Dow right now, most notably driven by Apple. The stock is up 1.5%, hitting a record high today at $288 a share. Of course, it's approaching $290 a share. Some of the other gainers in the Dow today as well include names like JPMorgan Chase, Visa, and Microsoft. And then just following those stocks, you're seeing strength in the energy components of the Dow, most notably Exxon and Chevron. And that's largely because oil prices are up right now. We've got West Texas Intermediate crossing $61 a barrel. We did get some data earlier this morning from the American Petroleum Institute showing a weekly decline in crude inventories that is supportive of oil prices, which are actually at their highest level since September, when we saw those airstrikes in Saudi Arabia that, of course, boosted oil prices for a few days back in September. And then finally, take a look at gold prices continuing to rise today, moving more firmly above $1,500 an ounce. gold prices are actually on track for its best year since 2010.
Thanks for that breakdown, Scott. We'll check back in with you in a little bit. Coming up here on Wi-Fi PM, protesters return to the streets in Hong Kong. The latest developments as demonstrators target malls during clashes with police. That's up next. Good afternoon and welcome to Wi-Fi PM. I'm Heidi Chung, filling in for Zach Guzman. And joining me on today's show, we have Yahoo Finance's editor-at-large and co-host of The First Trade, Brian Sozzi, along with New York Post finance reporter Thornton McHenry. Thank you so much again for joining us. It's been a fun show
Great
so
to be
far,
here.
right?
Yeah.
All right, let's check the market action again. All three of the major indices are higher. We do have the Dow up about 54 points midway in today's trading session, and the NASDAQ is holding above that 9,000 level. Now, some of Hong Kong's malls have become the latest battleground for protesters, demonstrators gathering in shopping centers throughout the city earlier, where riot police stopped, searched, and questioned a number of masked individuals. Malls were targeted on both Christmas Eve and Christmas Day as well, with protesters aiming to attract attention by forcing malls and stores to shut down. Guys, now this protest has been going on for more than 6 months at this point, and we've heard numerous American companies mention this on the call, saying that it has impacted their business not only in Hong Kong, but neighboring China as well. So at this point, what do businesses have to do? And just on a bigger level, what are these protesters going to have to do, I guess, going forward?
I mean, it's a massive issue that sort of seems to be, we seem to be in this weird period where we like to ignore it periodically to focus on things that we feel that then we realize how much it impacts everything going on. I mean, now it's sales, but it's also the trade deal, and it's also, I mean, I think, you know, even Europeans, I mean, the British are going to have to figure out trade partners. I mean, the Hong Kong protesters are holding a lot of cards right now. And it seems like, yeah, it's going to keep, the longer it goes on, the more and more things we're going to realize the systemic place it has in the global economy.
It's also become very unpredictable. Before these protests into Christmas Day, things have settled down, or they seem to settle down for a little bit, but they could pop up at any minute, very much social media driven. But when you're big companies, you're a Tiffany, you're these high-end luxury retailers, you can't do anything. You've spent millions upon millions to erect stores there, hire staff. You're stuck there for the time being. There's nothing you can do.
I have to say these protesters have been rather strategic when it comes to when and where they are protesting. If you remember, they took up shop essentially inside the biggest airport in that area, the international airport, and this time really targeting malls and places where people were supposed to holiday shop. So at this point,
hey, look at those photos. It's
pretty brutal. It's something that definitely a lot of people internationally are keeping an eye on, and we are keeping an eye on as well. Tiffany & Co. is shining bright this holiday shopping season. The luxury retailer estimated sales growth of 1% to 3% during the holidays, with China driving overall growth. Guys, Tiffany will soon be bought out by the parent company of Louis Vuitton, LVMH. So do you think it's a good sign headed into this acquisition?
I wasn't too happy with these holiday sales results. To me, I know Tiffany called out a momentum shift in their Americas business, but there are still structural problems in the U.S. for Tiffany. Chief among them, their stuff is too expensive, and it has not evolved. I think LVMH has to get in here and do it very quickly, figure out some way to diversify this company. It's not restaurants, maybe it's some high-end cookies. I'm unsure what it could be, but diversification is needed in a big way.
But to be fair, Tiffany's is trying to turn around their company, but with LVMH's help, they could probably expedite that process, right? Because LVMH definitely wants a presence within the luxury jewelry space. They don't really have a big market when it comes to that. So I feel as if while Tiffany is still struggling, there's potential here. We're starting to see signs of life, right?
I mean, I think, Tiffany, these numbers are great, but I think you got to look at the future in terms of, I mean, you need a pretty strong economy for people to keep buying, diamonds to put in their Louis Vuitton bags with their champagne. I mean, that's LVMH is selling a very specific.
It didn't cost me that much.
Yeah.
No, I'm just kidding.
Fell off a truck. But yeah, no, it's a weird thing. I mean, they used to be. Economies used to be cyclical. Maybe they're not anymore. We don't know. It seems like they're losing their cyclical nature. But in a downturn, I mean, LVMH is not going to do great.
I will add this anecdote. During the past, let's say, year and a half of this great bull market, and more recently this market melt-up, you have Tiffany out here reporting a 1% to 3% sales increase. That's not good. That's not good at all.
You're not easily impressed at all.
No, you should be taking your stock market gains in Apple, Nvidia, and AMD, go out and buying some jewelry. And they're not. And I think that speaks to the structural problems at this company. Good luck, LVMH.
Yeah, it's going to be interesting to see what happens once LVMH actually takes over here. But coming up here on Wi-Fi PM, The Force is with Star Wars at the box office. We'll reveal the jaw-dropping haul for The Rise of Skywalker next. The latest Star Wars movie is raking in the cash at theaters this Christmas Day. Industry estimates show that Disney's Rise of Skywalker raked in $35 million, making it the second best performing film ever on Christmas Day at the domestic box office. Guys, I don't know. I didn't watch it. I have no interest in seeing it, but it's pretty impressive overall, right? Like, Disney's continuing to dominate the box office. I think we have to definitely recognize that. But another Star Wars movie, I have fatigue, if I'm being honest.
Can I punt this one to you? Because I've never seen one Star Wars.
Yeah, no, this is a litmus test I've decided for people who were born. You can tell who was born after like 1980. Because I mean, like, yeah, you talk to people who were born my age who are like, you hear these kids saying too much Star Wars, and I'm like, too much Star Wars. I spent my entire childhood and adolescence begging for more Star Wars. It was a huge thing if you were an early 80s, late 70s kid. And I'll definitely see it. Now I have my own kids, so it's hard to get outside. But yeah, no, I mean, I think what I liked about this story though is how 2 days ago it was a flop, and now it's just destroying. And I think that's the thing, is I think what we're dealing with is almost like numbers that are philosophical
Yeah.
at this point. I mean, and also the Avengers have put us in a place where I think box office is out of its mind.
But to be fair, Marvel, Star Wars, they all have such loyal followings. I feel as if people are just going to watch it anyways, just because it is a Star Wars film, right? Are there lightsabers? I'm going to watch it.
I think it's also a factor of streaming. I think streaming has helped it in a way because, I mean, I know for a fact for me, personally, if there's a movie like Marriage Story or one of these, I'll watch that on the small screen, I'll wait. But Star Wars, Avengers, like you got to see that in a theater. If you're going to see it on a big screen. It's still fun.
Well, you know who's cleaning up off of this? It's Hasbro. They have made predominantly most of the toys for these Star Wars movies. So you're looking at them. They probably had a pretty darn good fourth quarter.
But speaking of streaming that you brought up earlier, Thornton, the popular Star Wars spin-off The Mandalorian is set to release the finale of its 8-episode series tomorrow. I know you're excited about that. The Disney Plus series has opted for a more traditional TV release, dropping 1 episode a week. The weekly release schedule allowed viewers to watch at the same pace and spark conversation following each episode. So it's interesting to me to see these streaming companies sort of revert to the old ways of just cable television or just television in general to do a 1-episode release. Do you think that's the move here? Because Netflix refuses to sort of do it. They're not really doing that on a wide scale, but it also seems to be a way to hold on to these subscribers, right?
Yeah, I mean, I kind of like it. Again, I'm old, so it seems like a fun. I like the idea. I'm waiting to see a show. You know, it's kind of the fun of it. And yeah, I mean, I will admit, I'm into The Mandalorian.
Are you into Baby Yoda?
Very much. I'm not to spoil anybody, but you know, Baby Yoda's in trouble. I want to see how this thing. I want to see him. I want to see if he's safe at the end of it.
I'll take the other side of this. I want my 20 episodes dropped in one day. I just want to plot myself down. I want to watch these 20 episodes in one. The morning show, one episode a week.
Wait, so have you watched all of the morning show? Because
I'm done. I'm all caught up.
Really?
It's amazing.
And you recommend it?
Absolutely, it's great.
What are your thoughts just on the space right now in terms of Apple TV Plus, Disney Plus, Netflix, HBO that's coming?
Well, now that I've paid $5 for this Apple TV Plus, there's really no other content on it. So I've paid $5, $10 to watch the morning show. I just recently canceled my Apple TV Plus. Season 1's over.
Really?
I'm done with it. I'm ready to go. I do encourage everyone. Rambo: Last Blood. That's the real movie here. Just saw that recently. Rented it for $6 on Amazon Video. Killer movie, killer ending. Really graphic.
If you don't leave the house much, it's great to have all of them.
I guess so, but at what point, I feel like this is the question we ask all the time. At what point is too many? Are there too many out there? Are you going to subscribe to every single one?
Yeah, we've got the Peloton subscription too.
Yeah. You are in
It's
love
all
with
streaming.
Peloton.
It's all streaming.
I think you'll see. I mean, I think the answer is like, you know, I think we'll see a year from now. I mean, if it's been too much, how saturated and how broken down it is. I mean, I think Netflix will suffer first. I mean, I will say Disney Plus. Again, having kids, like Disney Plus, the interface, the vastness of the library. I mean, I think our house used to be, the kids we've needed to like shut the kids down and put something on a screen. Netflix was our go-to. Disney Plus has taken over entirely.
Well, now you have HBO coming too.
Yeah, well, we
mean,
used to make them watch Game of Thrones a lot. They're young.
I know this comment is highly controversial, but I'm not a huge Star Wars fan, and I honestly have no interest. But all of the Baby Yoda content that I see online has made me so curious about The Mandalorian. I might just sign up for Disney Plus.
He's objectively adorable.
Isn't Baby Yoda teaming up with Popeyes?
I don't know, but
I'm just
everyone's
totally
obsessed. I mean, everyone's teaming up with Beyond Meat and Popeyes at this point. But before we go to break,
He's plant-based.
Before we go to break, let's take a look at the Dow leaders so far today. We have Apple, JP Morgan, and Chevron leading the charge there. And on the flip side, the Dow laggards today, we have Boeing, 3M, and Home Depot dragging the index lower. Coming up, Campbell's is jumping onto the Beyond Meat bandwagon by creating its own veggie-inspired snack. We will reveal the flavor of their new goldfish crackers just ahead. Welcome back to Wi-Fi PM. Let's take another quick look at the market action today. All three of the major indices continuing to hold on to gains. We have the NASDAQ up about 0.6%, holding above that 9,000 level. Now, plant-based meat was one of the biggest food trends of 2019, but will the hype continue in 2020? Dunkin' chairman Nigel Travis definitely seems to think so. Let's take a listen to what he had to say in an exclusive interview with Yahoo Finance's Brian Sozzi.
I go and see my doctor, as you should do at my age, regularly, and all he talks about is plant-based foods. And I really think it's a trend. We're very happy with what's happened with Beyond Meat at Dunkin'. Again, I want to compliment Dave Hoffman, my successor. It was all his initiative. I can't obviously talk about the numbers because it really launched in Q4, but we're excited about it.
I have to say, plant-based meat, Beyond Meat, Impossible Foods, whatever it may be, has just had a crazy, crazy year. Do you think this is the future? This is just it?
Well, at the bare minimum, you need more. You need plants. There's an industry. There's more population. Population is growing significantly, and you can't rely on just old school cattle to get the job done and feed people. You're going to have to use plants, and that's where items like this come in.
So I understand the whole aspect of it's more eco-friendly. You don't have to, raise a cow from the beginning and feed it and watch it grow only to slaughter it. But the argument that it's healthier, I sort of feel isn't as believable at this point, because when we take a look at the nutrition facts of a lot of these items, the sodium content is super high, almost on the same level as regular beef.
There's also a lot of fat in here. When you cook a lot of these products, you can see the fat coming out of when you put it on your tin foil. So there's, it's not as healthy, I think, as some of the marketing leads you to believe, but it is potentially a little healthier than meat.
Are you guys fans?
I've had it twice. It's pretty good.
The sausage is good.
But
It's very
is it something
underrated.
you would feed your children?
I mean, my children don't eat, but if I can feed my children anything, they're watching now, they should eat. I would choose. I don't think I have any qualms about them putting it in their bodies. I mean, there's enough stuff they put in, we probably should be putting in anyway, especially at Christmas. But I'd feed it to my kids.
The next iteration of this idea next year is more chicken. You saw Beyond Meat test that chicken at KFC. I would say fish. I would also say Beyond Meat is the year of bacon for them. I think they'll make a splash on bacon next year.
But bacon as well as steak, too. I don't know how that's going to taste, if I'm being honest with you, because when I think of a steak, I want that marbling. I want that juicy fat. So to mimic that using pea protein isolate.
Keep going. I won't even try. Keep going. You get me all pumped up. I mean, no, I don't think that they're with steak or fish just yet. Bacon for them, it's something they've been working on the past few years. I think they drop that pretty soon in 2020.
I mean, I'm sure next year we're going to see all sorts of different plant-based meat options.
I mean, I can't believe that's what the CEO of Dunkin' looks and sounds like, so I'm shook. I always assume it's going to be like a Ben Affleck character.
So in short, he's the chairman. He used to be the CEO. He took the company public in 2011. He's 70 years old now. He sits on 5 boards.
Yeah, looks great.
He looks good,
he's a robot. Yeah.
Well, Beyond Meat isn't the only brand hopping onto the plant-based trend. Campbell's owned Goldfish brand is set to launch a line of veggie goldfish crackers next month in sweet carrot and cheesy tomato. And guess what? As we do on this show, unfortunately, Zach is not here to do this with us.
Womp womp.
But we have to try it, right?
Yeah.
That's our favorite thing here. So I want us to try one, and then we're going to rank it as we do when Zach is here, 1 through 10.
Okay. Yeah, switch. We got an open bag here.
Open bag. This is the what flavor?
Oh, that's weird.
Sweet carrot.
Can I protest these?
Okay. Which flavor did you have?
I'm gonna try the cheesy tomato.
I want to protest these, and it's very simple. One, I know they're trying to sell this as veggie crisps, and that's all fine and good. Cornstarch in here, a lot of saturated fat. This is not plant-based food the way I would think about it.
What do you mean?
This is not plant. This is really not made from plants. There's a host of other ingredients in here. I mean, it's great marketing. You can put smiles over it, smiling goldfish. It's not plant-based as far as I'm concerned. We'll leave it at that.
So I have to be honest with you. That was not all that great.
I like the tomato.
Really?
I thought it was like it's got a nice flavor to it.
It's greasy.
I mean, again, I have 2 people watching at home who are goldfish fanatics, so I wonder if my son's.
I want the
eat
younger
this.
generation's opinion on this because
Yeah.
I love goldfish and I love the regular one. I don't necessarily know that I'd reach for these.
Can I get a fork? Because I don't want to get my hands all greasy. I'm a millennial. I got to double phone it. Like, can we just be honest? Double
You're
phone.
too much.
All right.
But don't go away. We're headed to the New York Stock Exchange in just 60 seconds. Tesla is in focus as Wedbush analyst Dan Ives raises his price target on the stock to $370 a share, citing optimism over growth and profitability. In his note, Ives said that the Tesla bulls have a lot to be thankful for, stating in part, quote, if Tesla is able to sustain this level of profitability and demand going forward, especially in Europe and China, then the stock and bull thesis will open up a new chapter of growth and multiple expansion in our opinion. Guys, this stock has been on a crazy run right now, record highs. What do you think this is all about? Do you think that this is a sustainable story here, or is this just all the bulls coming back out from hiding?
It's a great time to be a Chinese car maker based in LA, as far as I'm concerned. I mean, like with the trade war sort of cessation, quote unquote, whatever it is, the translation. Yeah, I mean, I think it's that. I think Tesla's sort of been on its uptick. I think things have played in its favor more. But at a certain point, I mean, to have this much action this week, I just keep thinking if it's not a short squeeze yet, it's going to be one soon.
It's almost, their market cap is, I believe, should be 2 times Ford right now.
Yeah.
We're talking Ford here.
Yeah. Well, we used to be Ford.
Yeah, I mean, at least Ford is making money, and that's very key, I think, to Ives' thesis on this company.
Yeah.
Sustained profitability. They had this run has pretty much come on the back of that surprising third quarter profit. Was $129 million. They need another quarter of that, and they need to be profitable next year. That's what the movement's saying.
Deliveries as well, though, right?
Yep.
The fact that they need to deliver the Model 3s, but they also have this new model, the Model Y, that they're working on as well. When is that going to be able to be driven by customers?
Where are the semi-trucks? Still no semi-trucks.
I feel like
it's hard for me to sit here and watch Brian question the steady, reliable hand of Elon Musk.
Oh, well, I have to do it. I'm taking one for the team here. I'm taking one for the team.
He's so boring. He's always, yeah.
It was so much fun. Thank you so much for joining me, Thornton McHenry and Brian Sozzi. I will talk to you guys very soon. But let's check in with Scott Gam on the floor of the New York Stock Exchange right now. Scott?
All right, Heidi, I'm joined now by Thomas Hayes, the chairman of Great Hill Capital. Tom, great to see you. Let's start off with the broader markets because we're seeing this melt up that has really persisted for about 6 weeks, 2 months now. What are your thoughts on that?
Well, the market is discounting forward earnings growth, so you have 9.6% earnings growth expected for 2020. You have the China deal behind you, which is much better than expected. You're going to double exports off the 2017 high watermark baseline. So a lot of good things are being priced in. Short-term indicators are looking a little bit overbought, but there's no reason for taxable investors to sell right now. Institutions have been underweight. Retail investors have sold out of equities $135 billion this year. And so they're behind the eight ball. And they're going to start coming in, and you'll see some profit taking in January. But on balance, things do look constructive in 2020. You may get some profit taking, but overall, the table is set. The Fed is accommodative. The liquidity has increased $340 billion since the summer. Quantitative tightening has been halfway unwound, so we're constructive moving forward.
Let's talk about opportunities across the market. I know you've been buying some of the energy stocks, especially the exploration and production companies within the sector.
You bet. Exploration and production, I think, is a tremendous opportunity here. If you take the top 30 weights of the subsector that have comps in 2009 when they were trading at great financial crisis lows, basically that earnings power has increased by 32.4%. And then for next year, the top 30 weights have expected earnings growth of 24.9%. Here's why that's interesting. You got over 50, if you add those together, over 55% of earnings power that's not priced into the subsector. Basically, we're trading down, if you look at the basket, to 2009 great financial crisis lows when WTI crude was trading at $33. 2016 oil depression lows when WTI was trading down to $26. And here you have an increase of 55% of earnings power. You've got crude at $61 a barrel, and you're trading at the same price as 2016 and 2009. So why is everyone so pessimistic? First off, it's a historically low weight of the S&P. So right now, managers don't feel like they have to be involved.
About 5 or 6%.
Yeah, it's even down, exactly, 4.2%. And every time they get started, the last few years, Charlie Brown comes in and takes the football away. So managers are like, I don't need it, I'll just overweight tech. But I'm telling you, you're going to see, Jennifer Ablin did an article in the Financial Times about 3 weeks ago. She asked me for a quote. And the title of the article was Big Name Investors Enter the Battered Down Energy Sector. Yeah. And we named, Warren Buffett did a $300 million equity investment in Occidental Petroleum. Jerry Jones did $1 billion investment in natural gas this summer. He's trying to do another $1 billion with Chesapeake. Right. Sam Zell, who's not traditionally an energy investor, he's in the oil patch. Tom Barrack, Lee Cooperman, all these billionaires are getting in while everyone else is getting out.
So some big names in there, but let me ask you, how linked are energy stocks to the price of oil? Because even at $61 a barrel, that's still down from the 2019 high back in April of 66.
You bet. We're in a perfect range. So the key range for producers and for consumers is between $58 WTI and $72 WTI. So Aramco just did their IPO at $1 trillion valuation. But here's the thing. They only floated 1% of the expected valuation, so about $25 billion of $2 trillion. They're looking to diversify their income streams, and in order to do so, OPEC has to keep the supply tight. What does that mean? Is it going up to $80 or $90? No. But this range of 58 to 72, and most of the U.S. E&P producers' break-even is below $50 a barrel. So this is an exciting, unique opportunity. You know, even the bigger producers have mid-single digits cash flow yields. And let's say you've had massive capital discipline. Wall Street said, no mas. We give you guys money. All you do is drill, 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 and bring the price down. And basically what they're saying is, we're going to rein in. You're going to return that capital to shareholders through buybacks, through dividends, and that's what's happening. And once they start to return that capital, cut the production, that's going to normalize the price, increase the margins on the existing wells, and we're off to the races in 2020.
Just very quickly, 10 seconds left. What percentage of your portfolio should be in energy going forward?
Well, I think you want to be overweight relative to the index. So if the index is 4.2, you look at an opportunity. You know, if you're aggressive, you see some of these guys like Icon's got $5.5 billion in energy. You could go up as much as double to 8%
Tom, thank you.
Or more.
Got to leave it there.
Yeah, thanks.
Thanks for joining us. Heidi, back to you.
Coming up, the power of Amazon. We're breaking down the e-commerce giant's holiday sales next. The ticker starts in 2.
Good afternoon and welcome to the ticker on Yahoo Finance. I'm Shauna Smith. Checking in on the market action on this Thursday. We are still seeing gains. The Dow up 56 points, barely holding on to the green. Apple is a big performer, or outperformer today, I should say, up just around 1.5%. We're also seeing gains from JP Morgan and Intel. Those three stocks are the top performers in the Dow. The S&P and the Nasdaq also holding on to gains. Well, let's start with our big three tickers today. We have Amazon posting a record holiday shopping season. New Boeing 737 MAX documents reportedly showing, quote, very disturbing employee concerns. We also have Microsoft, Apple, and Google facing a big hurdle as they try to push further into the healthcare space. Well, first, let's get to Amazon. It was a record day for the company, the retail giant, reporting that billions of items were ordered on its site, with shoppers buying tens of millions of Amazon devices during the holiday shopping season. Yahoo Finance's Dan Roberts is here with me. And Dan, we're seeing Amazon stock posting gains today. How big of a win was this holiday shopping season?
Well, I would point specifically, Shauna, to the fact that Amazon shared that 5 million people signed up for a pre-Prime trial as a result of the holiday season, and that is very encouraging. Now, of course, the retort to this, very much like the criticism you hear about the Disney Plus numbers, is that people say, well, how many of those people who signed up for a free trial will actually stick around when that free trial ends? And the reason I mentioned Disney Plus, we've heard big numbers for that, but a lot of the people who are new subscribers to Disney Plus are getting a year free thanks to our parent company, Verizon. So how many of those people will re-up after a year? We'll see. But it is interesting because you hear from people, gosh, doesn't it feel like anyone out there who would have signed up for Amazon Prime would have signed up by now? Aren't we at full saturation in the US? And the answer is we're not. Now, as for Amazon saying we had a record shopping season, as you shared in the intro there, they were vague. You know, millions of items sold, billions of dollars spent. Oh, okay, we don't really get the actual figure, but I'm willing to believe that Amazon had a record season. I think if you extrapolate it out and just talk about retail in general, we know that there were huge numbers for overall spending for this holiday season. People talked a lot about the shortened cycle, 6 days shorter between Thanksgiving and Christmas. Who cares? It didn't matter. Record numbers. But what does it mean going forward? You know, would you assume that for Amazon, every year will just be a bigger year than the year before? I wouldn't necessarily assume that, because eventually we're going to see that shift to e-commerce from everyone else. Everyone else is going to catch up. And interestingly, we're showing these numbers from MasterCard Spending Pulse, whatever they call it, their tracking system. They shared that something like 15% of all, there it is, online sales. Oh no, that's how much it went up, 18%. Yeah. But the percentage of all the US holiday shopping that was e-commerce, that was online, was, there it is, 14.6%. I'm very surprised by that. That still sounds like a smaller number than you'd think. You would think that we're at a point where the number would be higher. So I think that's a little bit of cold water on the idea that, oh, no one goes to brick and mortar anymore. It's not true.
You know what, I do.
Amazon still has a big leg up. It's ahead in the race, but others are catching up.
I do agree with that, because when I saw that number, I had the exact same reaction. The fact that it only counts for 15% of all the retail sales during the holiday shopping season. It seems like when you talk to people, when you see how they're spending money, more and more people are just doing it online. So the fact that it's only 15% is a very small number. But really speaking more so, Dan, to the overall picture right now of the U.S. economy, the fact that U.S. retail sales are up, that big number was up over 3.5%, I think it was just around 3.8%. That really points to the fact that the U.S. consumer feels pretty strong right now.
Yeah, very strong. I think that we already had an indication that all the numbers would be good when we saw the Black Friday numbers. Cyber Monday was good, and interestingly, the e-commerce sales were bigger this year on Black Friday than on Cyber Monday, and that hadn't happened in years past. So a huge Black Friday, huge holiday shopping season. The e-commerce growth is interesting. Now, all of this is just to say, okay, things are pretty good, and yet, if trade continues to be an issue, I mean, I know we have the phase one deal, fine, but what we had heard from a lot of prognosticators was soon enough, the tariffs, and let's remember that a lot of these tariffs are still in place. I mean, some were cut in half, some new tariffs were delayed, fine, but there are a lot of tariffs in place on imports from China, including on some imports from Europe, from Italy. If those continue, what you hear certain experts say is soon, the average shopper will feel the hit on their wallet. That clearly didn't happen in time for the holiday shopping season. But man, if there's no resolution, and even with the phase one deal, a lot of people think we're still going to have kind of status quo in terms of trade tensions with China for a long time to come, at least for another year. If that overhang continues, or even, God forbid, worsens, let's say the talks don't go so well and nothing gets done after this mini phase one deal we saw, then maybe eventually you do see a hit on the wallet of the average shopper. But for now, U.S. consumer very strong.
Exactly, and that's a concern really just for the broader markets too as well. When we talk about this rally into year end, whether or not that could continue in 2020, which obviously would then reflect consumer sentiment. That's a big debate out there. All right, Dan, thank you. Well, we are also watching shares of Boeing today. The stock down almost 1%. Now, Reuters is reporting that new documents reviewed by Congress reveal that what's being called, quote, very disturbing revelations regarding the grounded 737 MAX fleet. Yahoo Finance Brian Chung is here to break break this down. And Brian, I know that we need to go over this very slowly just because we need to reverse a little bit, explain exactly what's happening. What do you think the implications are of this report?
Right, so basically this comes from documentation, again, reportedly from the Transportation and Infrastructure Committee regarding the development of the 737 MAX that was involved in the 2 deadly aviation accidents, one with Ethiopian Airlines in the beginning of 2019 and one with Lion Air in Indonesia at the end of 2018. That is all old news, but the news today is apparently a new string of text messages that show continued concerns about the Boeing 737 MAX development. We don't, unfortunately, at this time know exactly what was in those text messages. The exact details were not reported by Reuters, but there was a source from the committee that did tell Reuters that they were, quote, very disturbing. Now, what we do know is that some of these text messages appear to be from the same pilot that had flagged concerns about the Boeing 737 MAX development in 2016, specifically with the MCAS system that is allegedly to blame for both of those aviation accidents that I just described. Beyond that, we don't exactly know what the details of these text messages are. For what it's worth, Boeing has their own statement that says, quote, Boeing proactively brought these communications to the FAA and Congress as part of our commitment to transparency with our regulators and the oversight committees. As with prior documents referenced by the committee, the tone and content of some of these communications does not reflect the company we are and need to be. We have made significant changes as a company in the past 9 months to enhance our safety processes, organizations, and culture. One of those changes that you could assume they're referring to was the change at the top by replacing CEO Dennis Muilenburg with the current chairman, that's Calhoun, who will be taking over in January.
Brian, do you think the new CEO, David Calhoun, do you think that there is enough, I guess, belief in him or enough confidence that he will be able to turn around the right now pretty frayed relationship between the FAA and Boeing?
Yeah, absolutely. I mean, there's definitely a lot of concern there. What we do know is that David Calhoun does come from, obviously, inside Boeing. He is the current chairman, so you could assume that he already has a working relationship with the FAA. The challenge here is that it's not necessarily that the FAA and Boeing are not working together. That actually might be the concern here, that maybe the two of them were both extremely passive in the development of this aircraft before it ended up flying, with all the risks that it had, with the bugs that may have been known by pilots even internally at Boeing before the 737 MAX ultimately was pulled and then actually stopped, because the presses have actually stopped at Boeing in terms of manufacturing these planes. One problem is that the FAA has said it's been disappointed with Boeing in terms of the types of documentation that it has received from Boeing. One example being the first round of text messages from that pilot that I described earlier. Actually, the first text messages were sent from Boeing to the Justice Department in February, but the FAA didn't receive those same text message documents until way later in the year. And the FAA has said on the record that they've been extremely disappointed as to why Boeing did not turn those documents over to its chief aviation regulator before it turned it over to the Justice Department, who was investigating it for a separate reason. So that strain should continue as David Calhoun, again, gets prepared to head up the company beginning in the next month.
Brian, thanks so much. The story is far from over. Again, Boeing shares down almost 1% so far today. Brian, thank you. Well, moving on, tech giants are still working to gain consumer trust. Now, as Microsoft, Google, and Apple push further into the healthcare space, there's one big problem, and that's the fact that people are wary of sharing their personal data with these companies. Yahoo Finance's Anjali Khemlani is here. And Anjali, when you take a look at some of the hesitation amongst consumers, it's a huge hurdle when it comes to these tech giants. How do you think they best address this situation?
Well, it really depends on each one of them and what their specific issues are to address, right? We've seen over the past year, at least, that some of these big tech companies have been dragged in front of the media, in front of the cameras, to be heard on their influence on the internet and about how they're, dealing with privacy overall. And that's really where the source of this mistrust comes from, especially for something as personal as healthcare data. And so as it's being learned, basically, as more and more is coming out about where they are entering the healthcare space, whether it's cloud services or whether it's through actual tools and startups, that's where the concern is really coming from.
Anjali, is the thought out there that they will be able to overcome this hurdle? Because lots of talk in the past has been, when we've seen it outside of the healthcare space, really just technologies losing consumer trust. I mean, specifically Facebook comes up. A lot of users of Facebook have been able to move past some of those data breaches. So do you think that will be the case here?
It remains to be seen. I mean, we've seen, just you guys were talking about it earlier, Amazon doing record numbers despite, some people mistrusting the service or having issues with the way that they conduct business. So, and that's one example of just how different the situation is for a company like Amazon that is also trying to enter the healthcare space, right? We know with PillPack, it's doing its thing, to see how it utilizes the data. Right now, we're basically living in a space where a lot of stuff that we do is recorded constantly. Data is being collected at every step of the way, and how consumers go about asking for more transparency is really going to be the telltale sign.
All right, Anjali, thank you. Well, coming up with the NASDAQ and S&P hitting yet another record, will the year-end rally continue into 2020? We've got the details. Stay with us. Stocks are climbing with the NASDAQ vaulting over 9,000 and the S&P 500 hitting a new record. But the big question is, will the momentum continue into next year? Joining us now on the phone is DR Barton. He's the Chief Technical Strategist for Money Map Press. And DR, thanks so much for joining us here. When you take a look at this rally into year end, do you think this will continue into next year?
Yeah, Shawnee, I think we have lots of good things happening and that are leading up to a strong finish and a good open for the new year. One of the things that we've heard bandied about in various places in the media is the Santa Claus rally. Some people think that's leading up to Christmas, but the traditional view of the Santa Claus rally that the Hirsch family popularized in their stock trading almanac was the last 5 days of the year, so the day after Christmas up through the end of the year, plus the first 2 days of January. And that just has a really strong seasonal tendency to be up. 37 out of the last 50 years we've seen an up stock market in that period, and there's some good underlying reasons for that. But this year, I think we have some really strong things that have helped that. Specifically, worries that maybe the consumer confidence and retail sales would drop off heading into Christmas after being so strong earlier. That just wasn't the case. So that's one more thing to check off the list of worries heading into the end of the year.
Yeah, DR, I want to talk about some of those numbers. At the top of the show, we were talking about the strong retail data that we got out when it comes to the holiday shopping season. Does this really paint the picture that maybe the U.S. consumer is stronger than we initially thought?
I think it really does. And, we've seen some good consumer confidence numbers coming out of University of Michigan and several other places leading up into the holiday shopping season, the Christmas shopping season. And, we've just seen number after number. You talked about the e-commerce numbers that came out this morning that showed, 18.8% growth year over year, which is mind-boggling, as good as they were last year. We saw Super Saturday, which was last Saturday's sales come in as the biggest single shopping day in U.S. history at $34.3 billion across the country. So all of these numbers just show that people are really feeling good about where they are right now, financially, economically, and they're being very generous this season, and lots of stuff being bought, which is good for retailers and the economy in general.
DR, today we have the NASDAQ above 9,000. NASDAQ is the tech-heavy index. When you take a look at technology's performance so far this year, it has been a major outperformer in the markets. Does this still have more rooms to run?
I think it does. You know, one of the big drivers there, of course, that we have the huge mega techs that we always talk about. But you know, the semiconductor stocks have really got beaten down late last year, early into this year, and have made a major rebound. And I think that just shows well for some of the spending that's going on in the tech area. So it's not just consumer stuff. It's not just social media stuff. I think we're seeing some real underlying strength in where dollars are flowing to upgrade, renew, buy new equipment, and that's a really good positive as well.
DR, how much of the trade resolution is already priced into the markets at this point?
I think a good bit. I think enough, Shauna, that we've kicked the can down the road for the next bit of negotiation. You know, when everyone said that we're going to do the phase one deal, and now we got some news out this morning that they're getting really close to the final documents to be able for Presidents Trump and Xi to sign. I think that gets us. That gets us to a place where the markets are saying we're just happy. Let's let all of these other numbers we're talking about carry the markets and not have to price in too much discounting that we could have a hiccup there. I think the real test, and we might even get some sell the news once we get that signature, maybe a bump up and then a drift down. But you know, the real news will be what happens after that, and I think the markets right now are just pricing in a fairly comfortable level of we like what's going on in that direction right now.
All right, DR Barton, thanks so much for calling in today.
Well, thanks for having me.
Well, coming up with the NASDAQ above 9,000 and the S&P 500 hitting a new record high, we've got today's biggest winners and losers next. Welcome back to the ticker. Let's check in on the markets. We have the Dow pushing further into the green, up just around 60 points. S&P and NASDAQ also holding on to gains. NASDAQ continuing to be the big outperformer today. Scott Gam standing by on the floor of the New York Stock Exchange. Scott.
Well, Shauna, as you mentioned, the Dow up a nice 59 points right now, but there are some laggards within the index right now, most notably Boeing, which is down a little bit less than 1%. Some of the other decliners in the Dow right now include names like Merck, Walmart, and Home Depot. Now, moving to another stock we're watching today, KKR, that's up about 1.3%. The company announcing plans to acquire Overdrive from Rakuten. The price was not disclosed, but Rakuten actually acquired Overdrive about 4 years ago for just over $400 million. And then we're also seeing strength, Shauna, right now in the energy sector. The two energy stocks within the Dow, Chevron and Exxon, are up right now. We did get some data showing a decline in weekly crude inventories, that data coming from the American Petroleum Institute. And oil prices right now are up, crossing $61 a barrel, the highest level since September. And then finally, before we go, take a look at gold prices moving firmly above $1,500 an ounce. That's the highest level in several months. Now, we should also point out that gold prices are on track for their best year since 2010, Shauna.
All right, Scott Gam, thank you. Well, let's take a look at Aurora Cannabis. The shares today are moving to the upside, despite Jefferies downgrading the stock from buy to hold. Now, the move coming after Aurora's board announced that its chief corporate officer, Cam Batley, is stepping down. You see the stock up just around 2%. Joining us on the phone is Cody Sanchez, managing director at Cresco Capital Partners. And Cody, when we take a look at Aurora stock, it's moving to the upside today, but year to date, the stock is down almost 60%. When you take a look at the performance of not only Aurora, but really the cannabis space overall in 2019, what can we expect heading into 2020?
Sure. Well, I think Aurora is a case we have to look at individually because, as you've noted, they've had leadership changes. This isn't the first one. Missed revenue projections and, quite a high burn rate with a questionable balance sheet that looks like they may run out of cash. So I think the market is very understandably saying, you guys haven't executed. What are you going to do moving forward to move towards a path to profitability? Now, the cannabis stocks overall, and we are in the space, so we certainly have a focus on this, are really interesting to us because there are many public cannabis companies that have been completely eviscerated from a stock valuation perspective when they actually are on that path to profitability. And so we are actively going in and investing in companies that are increasing their revenue and their EBITDA and moving towards positive EBITDA in the first 2 quarters.
So, Cody, what are some of those companies that, from your perspective, are getting it right?
Yeah, I mean, we're invested in this one, so, we definitely put our money where our mouth is. But one is TerrAscend. They just closed a $20 million private round that we participated in, and they did it at really sort of reasonable terms. You compare that with the dilution that shareholders had to go through in Aurora that was really painful. TerrAscend is actually increasing their revenue or has increased their revenue by 53%. So they've brought in, $27-ish million. And their EBITDA, while still not positive, looks like it could be in the first quarter of the year. I also think a company like Acreage, for instance, that is backed by Canopy Growth and Constellation, who just took their CFO and made it the CEO of Canopy not too long ago, before they put in more, quote-unquote, adult management, looks really interesting, too. So these are companies moving towards a path to profitability, which is what you have to look for.
Cody, one report out today that got our attention, Bloomberg is reporting the speculation is mounting over a Coca-Cola cannabis drink. A now deleted video was reportedly posted to YouTube. And in that video, a man explaining that the company is planning to debut a new line of its classic drink in Canada that will feature CBD extract. Do you think, one, if this is true, how big of an opportunity, how big of a market is this for Coca-Cola?
I can't imagine that they are not actively looking at this space. We are in talks with many beverage companies and have talked with some of the biggest ones out there because we've made our first investments in beverages. We invested in a sort of a seltzer water drink called Can, which is a private company out of California. And when I tell you that these people are actively looking at it, they're investing in funds like ours, not only from a corporate venture perspective, but also partners in these large firms, of which we have people from some of the biggest across the world, because they see this declining alcohol curve that happens in almost every state as soon as cannabis becomes legalized. So you have an inverse curve. As people start consuming cannabis, they start decreasing their alcohol usage. As people start consuming more healthy seltzers, they start decreasing the the high sugar and high fructose products such as Coca-Cola. So I think they're crazy not to look at the space. And given the fact they're giving us their money, I think it's pretty safe to say that they will put dollars in as soon as legality allows it.
All right, well, we will see. Cody Sanchez, thanks for joining me today.
Thank you.
Well, coming up, Dunkin' chairman and former CEO Nigel Travis weighs in on whether or not the plant-based food revolution is here to stay. We've got the details. Stay with us. Welcome back to The Ticker. We're watching plant-based meat. It's one of the biggest food trends of the year. But will the hype, though, remain in 2020? Dunkin' chairman and former CEO Nigel Travis seems to think so. Take a listen to what he had to say in an exclusive interview with Yahoo Finance's Brian Sazi.
I go and see my doctor, as you should do at my age, regularly. And all he talks about is plant-based foods. Mm-hmm. And I really think it's a trend. We're very happy with what's happened with Beyond Meat at Dunkin'. Again, I want to compliment Dave Hoffman, my successor. It was all his initiative. I can't obviously talk about the numbers because it really launched in Q4, but we're excited about it.
Brian Sazi joins us now with more on this. And Brian, I think the big question is, how big of an opportunity is this for some players in the space like Dunkin' Donuts?
Well, Shauna, the secret sauce in fast food is to excite customers. It is a very competitive space, and you constantly need these new and exciting items and some really good marketing behind it to get people and human beings into the store, and now increasingly mobile ordering. So for Dunkin', by all indications, this Beyond Meat breakfast sandwich has been successful. If it hasn't been, that is, they would have not rolled it out nationwide as they have done a couple months ago. And I suspect in 2020, you'll be finding more of this faux meat on more Dunkin' products. And I say go for it because the stuff tastes pretty damn good.
Brian, is it all about the health craze, or is there more playing into this whole movement towards plant-based food?
It's catchy. You've seen the traction over at Burger King with the plant-based Whopper from Impossible Foods. It's all about driving excitement, all about driving buzz. In this age of taking photos for Instagram of your food, what more exciting than going to Dunkin' Donuts, grabbing a big giant energy cold brew, and taking a photo of your plant-based breakfast sandwich and using a hashtag for it?
Brian, I know you closely follow this space, and just in terms of more and more companies getting in with the plant-based food, trying to alter their menu, trying to really innovate their menu items. When you take a look at who's doing it right, who do you think is a leader when it comes to this?
I think it's still the folks at Burger King. They've had a lot of success with that Impossible Burger, and good for them. You see Dunkin' Brands come in there with the sandwich too. You've seen KFC Yum Brands. I don't think is moving as fast as you would like them to do. They have been testing the Beyond Chicken at KFC. That has come out earlier this year. I also talked to Domino's Pizza CEO Richard Allison late last week. He tells me they have been testing plant-based foods internally, not in the restaurants just yet. I don't think he's ready to pull the trigger, but I wouldn't be surprised if Domino's launches something next year as well.
All right, Brian, switching gears here just a little bit. You also asked Travis about President Trump's tax reform plan, because this was largely praised by business owners originally, but Travis actually says that a typo in the print is causing some headaches. Let's listen to what he had to say.
I think this administration has tried very hard to help small businesses. And I think the Tax and Jobs Act that came out in 2017 was intended to do that. So that's been good. And they showed a lot of flexibility towards organizations like franchisees. The issue we have right now is an issue that's been very frustrating. In that act, there was a typo. In fact, it was a cut and paste that didn't take place properly. Restaurants and other businesses like grocery stores for many years have had the opportunity to depreciate over 15 years. It got turned back to a prior version of 39 years. That has a terrible effect on cash flow. It really affects small businesses. And on the way to the studio today, I was talking to people in Washington, both in the House and in the Senate, to push this over the line. It didn't get in the tax extenders bill. It needs to be tackled because it was a complete mistake. It's completely bipartisan in terms of the view it needs to be fixed. It doesn't impact the economy because it was scored at a zero impact. This is bad news for restaurant owners, for franchisees, and all the companies, the contractors who build restaurants, remodel restaurants to keep them up to date. So this needs to be fixed very, very urgently.
Saz, you can hear the fact that he thinks that this needs to be fixed as soon as possible. Is there optimism there that this will be addressed?
No, and it really should be, because to Travis's point, this looks to be, we talked to a lot of tax experts, this is an oversight, it's a typo, and it needs to impact. Now, I don't want to lose all your viewers here, but without getting too wonky in the accounting weeds, this typo is hurting the cash flow of many small businesses and those especially in the restaurant sector, and even their profits too. They really need to get this fixed. It's pretty ridiculous that mistake was made altogether.
Yeah, and he's talking about the fact that it could really hurt the restaurants again next year. All right, Sazi, thank you.
Thanks.
Well, coming up, the financial sector is a big winner this year, but is there still time to buy? We've got the details next. We're checking the closing price of oil today. Crude trading to the upside, up almost 1% at $61.68 a barrel. Now oil touching its highest in over 3 months on trade hopes and lower U.S. crude inventories. While financials are a top performer this year, the sector getting a boost by the strong stock market rally, posting gains of nearly 30% so far this year. Joining us now is Ken Leon. He's Global Director of Industry and Equity Research at CFRA. And when you take a look at the financials outperformance so far this year, a lot of winners in that space. Looking ahead to 2020, what do you expect?
Well, the momentum was really set in the back part of this year. Rates were still leveling off and possibly could go up later next year. So half of the revenue for financials, particularly the banks, come from net interest income. Then when you look at the business, it's all driven by America First. And what I mean by that is the strength of the consumer. So when you look at the financials, whether it's cards or it's consumer loans, auto, or mortgage origination, these have been the key drivers for bank performance 2019. That's going to continue into 2020. The other side of the equation is really commercial loans. And there's always the worry in terms of credit quality or some episodic event like oil that could all of a sudden change the equation as it relates to lending. So far, there hasn't been any industry that we would view to be a risk for 2020.
So who are the winners in this space? Is it the big banks like the ones we have on the screen like JP Morgan, Goldman, Wells Fargo, or is it also some of the regional banks as well?
So first slicing the biggest segments, in the large banks, we think they're in a great position because they're gaining market share. We hear often that they're laggards in terms of technology. They are investing billions in their business. They're doing it for a variety of areas. They're gaining market share on some of the smaller banks, mostly because small business loans are done person to person, not online. So forget about the robo-advisors. And they're also being intelligent with technology to really drive execution, whether it's the paperwork for loans or it could be for the capital markets. They're very stable, and they continue to gain market share. You know, the U.S. industry at large has so many banks, but when you look at the concentration by assets, you have to be talking J.P. Morgan or Bank of America. Goldman Sachs is a very different story, which we can get into if you like.
Yeah, and it's because of their consumer lending business, or more focused on the consumer?
The stock has actually done just as well as the banks we like, J.P. Morgan and Bank of America. They're having their first investor conference ever with a new management January 29th. Yet capital markets really haven't done that much in the last 6 months. Underwriting, trading, these are not drivers for the business. Goldman's trying to change their strategy, but they're getting the same points as JP Morgan or Bank of America, where they're executing across the board. We have buys on JP Morgan and Bank of America, a sell on Goldman Sachs.
That's interesting there, because we can see a lot of these banks have really been strong outperformers so far in 2019. I want to switch gears here a little bit and just talk about the U.S. housing market as it stands right now. We've gotten recent data out, and a lot of it shows a pretty strong picture for the real estate industry. Heading into 2020, you say that we think 2020 is not the time for a bearish view on the U.S. housing market. Why is that?
And it's a great way from segue to financials and mortgages. If we were sitting here a year ago, a 30-year fixed rate mortgage was near 5%. Today, just looking, it's 3.7%. So that starts with demand side, affordability. That's creating opportunity for households shifting from very expensive rental apartments where when they have 1 or 2 children, they begin to need more space. There's a big secular change here too. So you got the low rates, and then we're seeing the move of entry-level homes. So the availability from home builders of smaller homes, but they have the open space, almost like where you were living in the apartment in a downtown area. It's becoming very attractive. The industry needs more units sold because the selling prices are lower. But housing looks really good for 2020.
What about the fact, though, that U.S. home prices are still high? I mean, historically, they are still high. They are pricing out some buyers. Do you expect that momentum to shift at all?
It's a great question. And looking at one of the benchmarks, which is the S&P Core Shiller Index, the rate of increases is very low now. It's about 2-3%. There's some markets 3 or 5 years ago that were up 15%. San Francisco, Seattle, they're now flat to down 2%. So fortunately on affordability, prices are still going up, but modestly. And that with affordability with mortgage rates is a pretty good picture on the demand side. The other factor here too is on supply, because when you look at the housing market, it's mostly existing homes. 5.2 million are in inventory today. In terms of new housing starts per year, it's about 1.2 million. So taking that supply, population growth is up 15% since the year 2000. So there is increasing demand, we think, because of the aging millennials who have higher income today and a need for moving to a home. And affordability is making ownership pretty attractive. So the bear case for this would be that we're late in the economic cycle. If we're investing in home builder stocks, it would be early cyclical, not late. But we think there's a secular growth story here. We like the builders that are well positioned for entry-level homes. Names like MDC, Meritage, and others.
Ken, how important, real quick, you mentioned the mortgage rate at 3.7%. How important is that for the U.S. housing market for that number to stay below 4%?
Well, kind of like a traffic light, I think we're in the green area between 3.7 to 4.2. The yellow, I think, is 4.2 to 4.5. Anywhere that we get in the upper 4% to 5%, it's going to be lights out, and these stocks would probably go down. That's not our scenario for 2020.
All right, Ken Leon, thanks for joining me today.
Thank you.
Well, coming up, Uber's co-founder Travis Kalanick is cutting all ties. Why this could be interpreted by some as a vote of no confidence for the company. We've got all that just ahead. time for our next three tickers. We have Tiffany, Uber, and Spectrum Pharmaceuticals. Tiffany getting a boost from China this holiday shopping season. We'll have more on that. Also, Uber co-founder Travis Kalanick cutting all ties with the company. And Spectrum Pharmaceuticals is plunging today after one of its cancer treatments misses its goal. And you can see the stock down almost 60%. Well, first, let's start with Tiffany because it's a winner this holiday shopping season. The retailer reporting a rise in holiday sales this year, boosted by strong spending in China. Brian Chung is back with me. And Brian, this is very different than what we were talking about just a year ago when it comes to sales over in the Asia Pacific, also in the Americas. Why are we seeing a turnaround at Tiffany's this year?
Well, mostly because of mainland China. So it saw double-digit growth in sales in that region. Total, in terms of their global sales, they actually expanded their top line by between 1% to 3% from November 1st through Christmas Eve. So that does cover a pretty critical sales period for them, obviously because of the Christmas season. They did say that they had some headwinds in Japan and also in Hong Kong. In Japan, they said that they saw sales actually fall 12 to 14%. And in Hong Kong, obviously, the protests and the unrest that continues in Hong Kong has prevented them from doing a better job in terms of their sales there as well. But again, mainland China was their double-digit growth on the top line, again, expanding by 1% to 3%. This is a pretty remarkable story when you consider that Tiffany is one of these global brands, obviously, that has been the apple of the eye in terms of LVMH and their acquisition of Tiffany. Again, it's a pending acquisition, but they are slated to pay $16.2 billion deal to acquire that company. And the reason why is because of those growth prospects in China.
Yeah, Brian, that was my next question. The LVMH deal with Tiffany, any, I guess, idea or thoughts from the street in terms of how that could change Tiffany's business moving forward?
Yeah, well, I mean, Tiffany was one of these brands that had for a long time been seen as kind of a very uniquely American brand. When you do consider the fact that actually sales in the Americas were still up 2 to 4%, people were wondering what is the actual global appeal of that baby blue box in other countries around the world. Maybe there was kind of an adoption phase where they needed to familiarize new markets with that brand. What we've seen is that hasn't happened to be the case with Tiffany. They have done pretty well in that region, specifically in mainland China. I think that's the reason why LVMH paid the premium that it did for Tiffany. Keep in mind that Tiffany, you could see the stock bump when the deal was originally announced or speculated in November and then finalized ultimately a few weeks ago. That ultimately that is a pretty big price to pay for a company that a lot of people had assumed for the longest time was an American-only brand. So now with this expansion strategy, LVMH hopes that they'll be able to not only expand their presence in that key Asia Pacific, that key growth region of China, but also that they'll be able to beef up their wearables department. Keep in mind, LVMH, Moet Hennessy, you think of those types of brands, but in terms of wearables, really all they have so far is their Bulgari watch brand. So they're hoping that they can create some synthesis here, leverage that Tiffany brand for continued growth in the Asia Pacific region.
All right, Brian Chung, thank you. Well, let's move on to Uber. Its co-founder, Travis Kalanick, is severing all ties with the ride-hailing giant. So Kalanick will step down from the board. This is effective December 31st. And the New York Times reporting that as of today, he will have dumped his entire stake in the company since its stock lockup period expired in November. Dan Roberts is with me. And Dan, the question here is, does Kalanick know something that investors don't? Is this something that we should be a little bit concerned about or read into at all?
No, I think, look, there's a little bit of profit taking here. He has sold more than $2.5 billion worth of stock, so he cashed out. Now, it is interesting because the sale of all the rest of his shares, along with him leaving the board, has led people to say, okay, it's really the end of the Travis era now. Well, the Travis era ended in 2017. I mean, that's what Dara Khosrowshahi would likely say. That's when he became CEO, was in August 2017. And look, we remember all too well because it was such a story for so long, sort of the trials and tribulations of when Travis was running that company. And let's also not forget, I mean, in hindsight, when you look at the entire run that Travis had, I mean, as a co-founder and as CEO in the early days, there was a lot of good that he accomplished. I mean, helped create this company. It grew to become the leader of this new space. They're, oft imitated, but many people will just remember kind of the end of that run where he was caught on camera berating one of the employees, arguing with the driver. He had said some offensive things, like he called Uber boober because he said he can get women because he's the founder of Uber. All these things that happened at the end. Now he's out, but he's been out for 2 years. And I think many people, even though the stock has not done as well as hoped since the IPO, really not done well at all, many people would say that they credit Dara with already having turned around the culture somewhat. Obviously, it's not going to happen overnight, but I think a lot of people will tell you that Dara Khosrowshahi company has gone to great lengths to try to fix the bro culture at Uber.
Yeah, and the big question going forward is just whether or not Uber has a clear path to profitability. I mean, that has been debated long for many years, but then also more so ever since their last earnings call. What do you think about that?
Well, it's interesting to me. I mean, the dichotomy between Uber versus Lyft for a long time, in the weeks and even months leading up to those IPOs, what you heard was there were many people who liked Lyft more because they said, okay, even though Uber is bigger, Lyft is more focused. Lyft is just in transportation. It's a ride-sharing company. Yes, they also have e-scooters. Uber has all these different businesses. Uber is getting into medicine. Uber has Uber Eats, which it broke out before the IPO and said, Uber, we think that's a $20 billion business, Uber Eats. Now you're starting to see it slim down a little bit because people have started to say, gee, can you get profitable? So we covered, I think a week ago, reports that Uber was selling off the Uber Eats business in India. So I do think that rather, after a time when Uber was launching new things, you're going to start to see it slim down because all of these unicorns are realizing that the pressure's on to achieve profitability. I mentioned e-scooters, a business that Uber and Lyft are both in. That's one of the industries where you're starting to hear most quickly from some of the big names that they care about profitability. Bird, I think it was, the CEO came out and said, well, the story for us in 2020 is going to be cutting costs. And it's like, well, sorry, but we need to achieve profitability. So yeah, I do think that's going to be the story. And by the way, the jury's still out on these stocks. Everyone is like, oh my God, Uber and Lyft have been disasters. Well, they just went public within the last year, so let's wait and see.
Yeah, exactly. And the debate that we've been having for years, especially over the past couple of months, path to profitability will remain heading into 2020. All right, Dan, thank you. Let's move on to a huge loser today, and that's Spectrum Pharmaceuticals. You can see the stock down almost 60% so far today. Now, this coming after the company said that a mid-stage trial of its lung cancer treatment missed its main goal. Anjali Khemlani is back with me. And Anjali, I was going through what this could mean for the company. One note stood out to me. It's from Cantor Fitzgerald, and they said that this drug was the key value driver for the company. What does this mean for Spectrum Pharmaceuticals then moving forward?
Absolutely. Well, and also to note that Cantor Fitzgerald did keep a neutral rating for the stock. It's a really big market, really. The non-small cell lung cancer is a very common type of lung cancer, and it has a really big market. They're competing with companies like Roche, Eli Lilly, and AstraZeneca in the market right now for specifically the kind of drug that they're working for. And so it could have opened up an opportunity. Now, it's important to note that this problem that they cited in terms of not meeting the goal is actually just in the first cohort, and they're still looking at the second and third cohorts of these trials, and did announce that they're going to take a look and sort of speak to it in early 2020. And this comes despite the good news from the FDA accepting a license for reviewing another drug which treats low white blood cell counts as a result of chemotherapy. Again, another really large market for the company.
Anjali, I want to switch gears here just a little bit and talk about QIAGEN. Now, this genetics firm, which said that it was originally looking to possibly sell the company, is no longer looking to sell it. The stock today moving down almost 20%, or just over 20%. Why did they reverse course?
Yeah, well, they actually said in their statement, that they believe that they have, quote, a strong and differentiated portfolio, end quote, to bring value to shareholders. So it looks like that's where they're leaning on right now, is just kind of staying tight. They did say that they were approached by several companies that were interested. Bloomberg reported that one of them was Thermo Fisher Scientific, which is also slightly down today. So, and it's been sort of a tumultuous end of year for the company, really, with losing their CEO in October, which really sent their shares down. But it does also have a really good relationship with the LabCorp, so it looks like it could have really good market access if, in fact, things go forward.
All right, Anjali, thank you. Well, coming up, gold crossing above a key psychological level. We'll tell you how to play it next. It's now time for our ETF report brought to you by Invesco QQQ. Now today we're watching Spider Gold shares. The ticker symbol is GLD. This coming as gold prices are soaring above $1,500 an ounce as political uncertainty remains heading into 2020. Joining us now is Todd Schreiber. He's a staff writer at Benzinga. And Todd, when you take a look at the price of gold, it's interesting that the price is now above $1,500 a share when you have the stock market at record highs. Bond market's also moving in tandem here. Why do you think we're seeing that play out right now?
Thanks for having me, Shauna. I think what's going on right now in terms of gold prices moving higher here just this month. I mean, before I came on, I was looking at GLD. Finally, we've had some noticeable weakness in the dollar. Just using the Invesco Dollar Bullish Fund as a reference point, UUP is that ticker. That measures the dollar against a basket of major currencies like the euro, pound, Canadian dollar, et cetera. It's been pretty strong most of the year until just the past couple weeks. So that's sort of providing a catalyst for gold. More broadly speaking, gold has been very, very strong this year, impressively so, against that backdrop of a stronger dollar. So if we start to see the Fed rate cuts that took place this year, sometimes some of the dollar weakening effect can take a few months, of maybe up to 6-7 months in some cases. If we see that trickle into next year, I think we'll probably see even more near-term upside in gold and GLD.
That's interesting because now we have even more of the uncertainty off the table just in terms when it comes to trades. Some of the uncertainty that was holding back or maybe attracting some of the safety plays now seems to be resolved. So even with that off the table, you still see the price of gold heading higher?
Yeah, I mean, for next year, I do. I wouldn't bank on, say, I mean, GLD's up right now for 2019, 16.5%. I wouldn't bank on that as a repeat performance for 2020. My expectation would be is that you could probably see flat gold prices for, say, into the first half of next year. If just sort of using a lot of the big banks that have been out recently with their 2020 S&P 500 forecast, they're bullish, but sort of the caveat that I've been seeing is for the first half of 2020, and then with the reference point being that things you'll get some more uncertainty, if not volatility, the closer that we get next year to the November presidential election. So we might see a shift from stocks in that May-June period into safer assets in the summertime. And I would think gold could establish a leadership position in the months leading up to November 2020.
Todd, what are the best ways to play gold at this point? What are some ETFs that stand out to you?
So GLD is the big one. It is the biggest one in the world. I would say for home gamers, do-it-yourself investors, someone that wants to carve out a little bit of their portfolio for a commodities holding that is intending on making that a long-term holding, you want a lower fee. So GLD is the choice of the pros, but it charges 40 bips a year. You can do better on costs with GLDM, which is the low-cost equivalent to GLD, or BAR, which is a Granite Shares product. Both of those charge around 18 bips a year. So those would be the cheap plays for in gold ETFs. And everyone's been flocking to cheap ETFs this year. So if you want to own a gold ETF and you plan on holding it for more than a year, best to do it in cost-effective fashion.
All right, it's Todd Schreiber. Thanks so much for joining me today.
Thanks, Shauna.
Well, coming up, why your debit card is the least secure way to pay for goods. And we've got the details on how you can protect yourself. Don't go away. Well, it's time to go beyond the ticker. Credit card payments are on the rise, with total card payments surpassing 130 billion transactions in 2018. This is according to the Federal Reserve's latest payment study. But swiping that card might not be the safest way to pay for goods, as magnetic strips can make consumers vulnerable for fraud. Dan Roberts, Brian Chung, and Anjali Kamlani are all back with me. Dan, the big question is, why is this such a risk? Why is this out there? Why should consumers think twice before? What do you think?
Well, cards have always been a risky proposition, and security has always been an issue with mag stripe cards. And remember that the U.S. is actually behind foreign markets like Europe with chip and pin tech. I mean, finally, we adopted that, but it took a long time. And yeah, hackers are able to easily duplicate cards, like, you know, when you swipe at a gas station, sometimes there's something in the reader that can make a copy of your card. So something to be cognizant of. I don't know if necessarily the problem has gotten worse, but it is true that even as payment tech gets better, the hackers get better too.
Brian Chung, real quick, do you think this will have more people use Apple Pay or Google Pay?
Yeah, definitely, because Apple Pay and Google Pay actually allow you to use a false, a generated credit card number, so that in case that is stolen, it actually doesn't intercept the actual underlying credit card data as well. So probably a safe measure there.
All right, guys, we have to leave it there. Anjali, we'll get to you next time. Anjali, Dan, and Brian, thanks for joining the show. Stay tuned. The final round is next.
Hello everyone, Miles London here in New York. This is the final round in Yahoo Finance. Big milestone here, the NASDAQ top at 9,000 for the first time. Tech leading the way higher today. We'll have more on that and all the market action coming up in just a bit. Plus, Americans shopping till they drop this holiday season. You won't believe some of the numbers we're seeing. And Wall Street getting bearish on beer makers for another reason you will not believe. That's our final round call today. Plus, change is coming to the Fed next year. What it means for Jay Powell and the gang. Joining us now, we've got Yahoo Finance's Fed correspondent, Brian Chung, and Yahoo Finance's Jared Blickry to talk about today's market action. So let's take a look at the three majors right now. We have some more milestones on the street. The NASDAQ above 9,000 for the first time. The S&P clawing back near a record. I think it's at a record, Jared, yes?
Yeah.
Dow?
Dow not.
Dow is not.
But it could close at a record.
Because we lost, what, like 50-something points on Tuesday. And so, anyway. Market's good. Market great. Classic stuff. Amazon leading gains higher. Putting out an interesting press release letting everyone know they do spy on you with your Ring doorbells, because they said so many people were doing caroling this year. So I guess Amazon's surveilling there. Apple, Alphabet, Facebook also leading the NASDAQ higher, on track rather for its 10th consecutive record close, its 11th straight positive finish. Jared, it's just been quite a rally, and is it time to now talk about it as a melt-up in this market as we get towards the end of a year that is really, I just think, you can almost not have enough superlatives to talk about what the market has been this year.
Yeah, and it's not just stocks. I mean, we're seeing so many asset classes not only finish in positive territory for the year, but nice gains for a lot of asset classes. And they came at different times. It depends on what we're talking about. Even the sectors and groups that we look at, some of them happen to have done well since September. Some of them, like Apple, have done well just about all year long. And then, you look at the subgroups, the industry groups, stocks, chip stocks, just amazing the performance they've had this year.
And you wonder to what degree the momentum higher is just in comparison to the really brutal December that we had in 2018, when there was the pretty dramatic market sell-off that to kind of skid into 2019,
which ended 1 year ago.
Which ended exactly 1 year ago. So I think there's a lot of concern headed into December about whether or not there would be another crunch in repo rates. Not to fold that into the discussion as well,
but
don't
happen.
Exactly.
DPs for later in the show.
Right, exactly.
So looking at the markets right now, again, pretty much everything up. We had Apple on the screen there, another stock that has doubled over the last year. And we talked about it last week, or not last week. It wasn't a weekend. It was only one day off.
Feels like
talked about it before the Christmas holiday, Jared, that Apple kind of came out, said everything that could possibly have gone wrong. The market shook that off. In time, now the day after, the market did react negatively, but really that's kind of the last piece of corporate news that was a macro mover. We've had so many negative headlines with the IPOs. Boeing remains kind of an unmitigated disaster, and yet those stock-specific stories, FedEx continues to cut their guidance and miss numbers, are not impacting the macro direction, if you want to call it that, of the major averages.
Yeah, we're not reading too much into FedEx anymore. Oh, and interesting, we had David Kotak on the show yesterday morning, and he speculated that Warren Buffett, Berkshire Hathaway might buy FedEx. And then the other guests chimed in and said, well, I think it would make sense if Walmart bought FedEx. But you keep having the quarters like they've been having this year, and the price is just going to get that much better.
Well, I mean, you look at the macro.
Who would want that business, though? The business
I was going to say, that's a big call.
The logistics. If you're interested in just a turnkey logistics business and the price is right, why not?
What are you turnkeying? You're turnkeying a house that needs like a new kitchen, and it probably needs to redo all the upper bedrooms. You might even have to do an addition. Like you're turnkeying a massive corporate.
Okay.
Massive corporate headache.
I'm not trying to defend
the
position.
I know.
But I think it's interesting.
You're just a messenger.
But no, I mean, to get to the bigger picture, though, right?
It's cheap for a reason.
Right. Yes. But to get to the bigger picture, I think it was Morgan Stanley that kind of had a tongue-in-cheek cartoon saying, well, okay, you've got tariffs, you got PMI falling, you've got earnings that have missed estimates. And what premium would you expect to see in an environment like that on the S&P 500?
Yeah.
Well, it's not what we're seeing right now, right?
I mean, given everything that's happened this year, the Fed is the big backstopper of everything. Because without that, I don't think we'd be looking at maybe even 10 or 15% returns. The economy could have easily turned in the wrong direction had they not pivoted. Despite, they had mountains of evidence, but still, they could be, what's the word, when you stick in your ways. But sclerotic, that's what I was looking for.
Wow.
Yeah.
That was not going to be my suggestion.
That's a great central banker word, sclerotic. Yeah. So they pivoted, and now we have 60 Bs a month.
There you go.
Right. There you go.
At least. All right, for more on today's market action, let's go to Scott Gamm. He's live on the floor of the New York Stock Exchange. Scott.
Well, Miles, the nearly 1% decline in Boeing stock right now is not preventing the broader Dow Jones Industrial Average from having a nice 50-point gain right now. And there continues to be negative headlines surrounding Boeing and the still grounded 737 MAX jet. Of course, earlier this week, Boeing CEO Dennis Muilenburg stepped down amid the broader crisis. But what's fascinating is that Boeing stock is still in the green for 2019. It's up about 2.5% this year, so certainly lagging the broader market. But as long as Boeing stock stays above $322 a share, it'll remain in the green for 2019. And right now, Boeing stock is at about $330 a share. A couple of other stocks we're watching right now, Chevron and Exxon, both of those stocks are in the green. Energy sector getting a boost today as oil prices get a nice pop, with West Texas Intermediate not only crossing $61 a barrel, but approaching $62 a barrel. We did get some data from earlier this morning from the American Petroleum Institute showing a 7.9 million barrel decline in crude inventories for the week ending December 20th. And then also take a look at gold prices. We talked about this earlier in the week, but gold continues to move above that $1,500 an ounce level. The 2019 high was back in August at about $1,535 an ounce. Gold prices for this year are on track for their best year since 2010. Miles.
All right, Scott Gam live on the floor of the New York Stock Exchange. All right, well, despite a shorter holiday shopping season, actually the shortest holiday shopping season we could possibly have, online sales were up 18% compared to last year due to retailers offering sales earlier in the season across all devices and channels. That's according to data from MasterCard Plus. Amazon coming out today touting their record-breaking holiday shopping season. 5 million customers starting Prime trials or memberships. The company also reported Prime one-day, same-day delivery quadrupled from last year. It's interesting looking at Amazon saying we had a record-breaking season. I guess it's good, but all it tells us is Amazon keeps growing, which, I mean, look at the stock, clearly doesn't seem to be good enough anymore.
Right.
Yeah, I'll take this. Amazon has basically been going sideways for a while. Now they're having a huge day today, up nearly 4.5%. And I see this as constructive because we had kind of a short-term uptrend with higher highs and higher lows as well. But this is really breaking out of a key level, which is 1850. Amazon has lagged not only the S&P 500, but its own sector, which is consumer discretionary, which is pretty incredible because Amazon itself is 22% of that. Home Depot, which is underperforming, is 10%. So 32% right there in those two stocks. And you're underperforming that group. I think it might be time for Amazon with this movement today to break out again to the upside, because really that's the only FANG stock that we've seen languishing for the most part. Even Netflix picked up recently.
Yeah, and it seems like from a fundamental standpoint, every time there might be a breakout, Amazon just announces that they're going to make a new round of substantial investment into something like one-day shipping. We saw that investors were kind of lukewarm to that reception. On one hand, yes, it's probably good from a competitive standpoint to be the first mover to try to get packages from your facility to the person's doorstep as fast as possible, but that involves an enormous spend, even for a company with the scale and the cash position that Amazon has. So, not necessarily a surprise that it's flat right now, but to map out what the growth trajectory is in the next 5 to 10 years is going to be a really interesting story as we flip the calendar to 2020 and start this new decade.
So they're seeing margin compression on the retail side of their business, but they could also see it on AWS.
I think that's
a huge story because they got some serious competition from Microsoft and Alphabet, Google, and they're ramping up their sales team. They needed to be better, or at least be a little bit more competitive in these enterprise sales, and so that could weigh on their margins, which is their profit center. AWS, their profit center in the coming quarters.
Well, and I think it always gets to when any company changes how they report any part of their business, you think, what's up here, right? When Apple said we're no longer going to break out device sales, the stock has more than doubled since then. But the thought was like, maybe this is bad, right? And kind of the other side of it is Amazon never talked about Prime subscriber numbers, ever. There was, kind of estimates that they had around 100 million, something like that. And then Jeff Bezos came out in his letter last April and said, we have more than 100 million. And now they're talking about signing up 5 million people, either for trial Prime memberships or for the full boat thing. So I think that, does that say something about Amazon's retail business that now they're more than happy to let us know how many people are getting into the Prime flywheel?
There's something to be spoken to that maybe in this non-GAAP earnings environment that maybe it's very similar to dividends in a way, right? You give information to your investor on the premise that that's information that you're going to provide basically to perpetuity, almost like a dividend, right? You issue a dividend only if you're confident that you can continue to distribute that capital for basically as long as the company is public. Now, with information like Apple, with information like Amazon, if it's these, or even with Uber and Lyft and these types, or if it were WeWork, if it were community adjusted EBITDA, right? Offering that type of information, if you pull it away at some point in time, what will be the reaction? It seems like it could generally mostly lean adverse, as we've seen.
Or even adding a new one like advertising sales. That would be interesting.
Well, right, that's the thing. And it's like, it's sort of it's like a philosophical, what do you want the market to think about your business kind of thing. Like, if you're giving us this information, are you saying that this information is of more import or is it of less import? And so I think I'll be interested to see in subsequent quarters if Amazon starts breaking that stuff out, what Bezos does in the April letter and all that kind of stuff. Coming up here on today's final round, we'll have the stocks to watch in this market. But first, let's check out where the big tech names are trading right now with about 50 minutes to go in session. here's some of the stocks we're watching in today's market. Diamondback Energy catching a bid as oil prices touch a 3-month high. The stock ticker is FANG, by the way, not the actual fangs, and it is currently among the best performers in the S&P 500 during Thursday's session. Also taking a look at shares of Immunomedics, jumping after the pharma giant said the FDA has accepted its application for accelerated approval of its breast cancer treatment. We're also taking a look at shares of PayPal, the company's CFO telling the Wall Street Journal that PayPal will continue to pursue takeover targets in the new year, ranging from $1 to $3 billion and focusing on the payments space. All right, coming up here on the final round, Wall Street getting bearish on beer makers. You will not believe the reason why, or I think you might believe the reason why. It's our final round call of the day. But first, take a look at some of the trending tickers here today on Yahoo Finance. All right, time now for our final round call of the day. Today we've got Cowen weighing in on teenage trends, specifically when it comes to the habits the law has age restrictions for. That includes vaping, smoking cigarettes, consuming cannabis, and alcohol. We'll focus on the drinking trends here because the note highlights something we've known for a while. Beer sales are down across the board. Now, Cowen kind of pointing the finger at teens here, finding over the last 5 years the percentage of teens who have indicated that they've been drunk within the last 30 days is down 600 basis points. I think that's good news. The problem is that you can't then get incremental sales of Natty Light. So that's pressuring beer sales overall. The beer sector continues to see category headwinds. Now we look at things a lot like White Claw and the rise of flavored seltzers. But this chart, you can say maybe teens aren't cool anymore or not, but this chart shows that beer has underperformed the alcohol category in every year that there hasn't been a recession since the tech bubble.
Right.
So, like, the only time people find themselves gravitating towards beer, though I guess it's really that they gravitate away from other spirits because they're more expensive, we have to be in a recession.
Well, the news for me...
Not great considering how the market's done this year, guys.
Right. But the news for me wouldn't necessarily be that beer sales aren't as great. We've heard that many times before, but the bigger news would be if teens are not getting drunk as much, right? I mean, because we had heard so often that beer sales are being, contracted from because people are turning to liquor, to wine, to these hard seltzers as an alternative. But it seems like the pie, if assuming what Cowen is reporting is true, is getting smaller among this key demographic at least, right? So does that tell you anything about when these teens ultimately go into their 20s, whether or not they will also continue that trend of not drinking as much? Well, if so, then that should be bearish not just for beer companies, but for all alcohol companies. But I don't think that's necessarily the case. Cowen still has an outperform on Constellation, on Sam Adams. So I mean, it seems like the story is that it's fine for these companies as long as they can adapt to different types of drinks like hard seltzers to keep those people coming back.
Yeah, that kind of came out of left field. I think and just on that tangent, hard seltzer, the reason I think it works and it's such a big hit is because they got the guys on board with it. When you had the beer substitutes before, like Bartles and James, several decades ago, then hard lemonade, and a lot of times you wouldn't go to a frat house, Zima process, you wouldn't go into a frat house and expect to see a lot of that. Yeah. But Truly just got caught caught up by the
Fortunately, it crossed over. Yeah.
So and some of the stocks really haven't.
Viv isn't really lifting off though.
No, it's not.
But it's Truly, White Claw.
Well, I was surprised that Truly apparently has 20 to 25% market share. That's actually larger than I thought.
I've seen a lot of Trulies at restaurants and bars. A lot more than White Claw, because of course they're going through the Sam Adams distribution.
Yeah, there was an issue with supply in White Claw this year.
Yeah.
I don't know if they were able to get over that.
But they're owned by Mike's Hard, and Mike's Hard was always kind of more of a retail-based, product, less so than being in a restaurant. But obviously, the Sam Adams distribution network is helping Truly, I think, kind of break through on that side.
Yeah.
I mean, I guess the distribution network, because White Claw, in my experience, has been harder to find than Truly. Maybe that's just because of the overwhelming demand. But for me, it seems like when it comes to liquor, when it comes to alcohol, the distribution channel might not be as important. It's obviously important because if people want it, they should be able to get it. But it's not as important because I've had friends that are willing to travel to multiple grocery stores if it means finding, because they're not going to drink, what is it, the pure, the flavorless seltzers? Come on. You're not going to buy that.
It's vodka and water.
Absolutely not.
No, but I'm saying in a restaurant. There's not as much White Claw in restaurants.
Would you ever order a White Claw or a seltzer at a restaurant?
At a nice steakhouse?
I think I have ordered a Truly out before. And I'm saying there's more Truly out at third-party establishments.
Right.
It's
Okay.
fine.
So they're winning that battle. Good for them.
None of these stocks, though, I'm looking at look very good from a technical perspective, and some of them just been really beaten down. I mean, Bud has been a perennial performer, but it's pretty far off its high. It peaked at over 100, so it's down at least 20% from that. And same thing for Constellation Brands. A lot of these stocks just peaked around August, and it looks like that rotation in values and cyclical, well, that didn't include these guys.
Also love the perceived risk among 12th graders has basically been cut in half on consuming cannabis.
Yes, well, there might be substitution effects here, too.
Yeah.
People are drinking less, smoking more.
Yeah.
Well, or Constellation might try to blend both of them.
I was going to say,
So,
there you go. Do people still watch Dazed and Confused? Like, do teens still watch that movie?
No, I feel like the weed-related show that comes to mind first is That 70s Show. That's the one I sympathize with the most.
Yeah. Or Workaholics, I feel like is
later, even later. Yeah.
Right, but like our teens today, like what are they? What cannabis-friendly content are they consuming? Is it Workaholics? Is it Dazed and Confused?
Any Seth Rogen movie.
Sure, yeah. Good Boys. Great movie. Great movie. All right, coming up here on the final round, market veteran George Young tells us where he's putting his money to work here with the market sitting right at record highs. But first, let's take a look at today's Dow leaders with 40 minutes to go in session. All right, the NASDAQ crossed 9,000 for the first time today. Our next guest says Not a bad time, however, to have some cash on hand. George Young is the portfolio manager of the Villere Balanced Fund. He joins us now to discuss. George, good to talk to you again. So I just want to start with your overall outlook on the market right now. Certainly, we've seen quite a rally in the last 6 weeks or so. You mentioned you have about 15% cash in both of your portfolios right now. Are you feeling a little cautious, or are you just looking for some better opportunities?
I think that's a good way to put it, both cautious and there are better opportunities out there. The problem is we're not seeing that many things we want to buy. We have our favorites that we've held for some time, but I think as everybody knows, this has been a fantastic year. I think the best on record since 1997, and we might eclipse that on the S&P terms. So it's making us a little bit cautious. So as you say, we've got about 15% cash right now. We're always looking for other opportunities. And sure, there'll be some things that happen because this market, as we know, stocks by definition are somewhat volatile.
Yeah, Jared Blickery here. Just asking about the composition of your portfolio and how that may have changed over the year, because we saw this rise in value in cyclicals starting in about September, kind of with a different interest rate regime, at least with the 10-year yield marching steadily upwards, up about 20, 30 basis points this quarter alone. What does that dynamic look like, and how do you see that playing out into 2020?
Well, we've got a little bit more concentrated portfolio. So we've got about 20 to 25 names in each of our portfolios right now. And what that means, we've seen a little bit more of a push towards technology. That's the largest segment within the S&P 500. So that's done incredibly well in the last 3 months. And that's something that we've seen that skewed the portfolio a little bit. One thing that's important that everybody's got to remember is taxes play an important role here. So it's one thing if you've got a series of holdings in your IRA, you of course don't pay any taxes there. But here we try to hold a little bit longer, meaning 3 to 5 years, something like that. And that's why it's important, and we're enabled to be able to hold smaller cap stocks that offer more growth. So that's generally where we see the opportunity. Again, the Russell 2000's not done that well in the last couple of years. It's averaged about 6% for each of the last 2 years. So it's weak this year, relatively speaking. And also, let's not forget the fourth quarter of 2018. So you've got to be a little bit guarded right now.
Hey, George, Brian Chung here. So you're talking about small caps just now. In terms of investment strategies for 2020, is that going to continue to be the case where you're kind of favoring those blue chip stocks over those small caps? And are there certain pockets even within those subsects in technology, for example, where you like the opportunities in the next year?
No, we really stay more in the small mid-cap area. That's where we seem to find opportunities over the year. And again, that's what's undervalued as a general rule at the moment. So our better course is to hold 15% right now. There will be some opportunities. Somebody missteps. They have a temporary lack of earnings realized. They have a change of CEOs. Their product is temporarily out of favor for some reason. There's a lot of things that can happen in the stock market. So we prefer to keep a number of stocks. We've got about 10 on our radar right now. They're watching and monitoring, getting to know the management, understand the goods they provide, the services they provide, to see if it fits into what we like.
Now, George, I want to ask about one of your names here we've discussed previously. That's First Hawaiian, because if you look at the Russell 2000 in general, it's, I wouldn't say mostly, but about 20% of it is smaller regional banks. So you have First Hawaiian as a name you like. Are there other regional banks? You mentioned there's 10 names you're looking at. Is regional banking an area, as the market seems to price in maybe a little bit of a turn in the economy next year, a space that you're finding some interest in?
Yeah, we do. And again, going back to our theme of small and mid-cap stocks, we like regional banks, which by definition are smaller than the large mega banks. And again, remember, these have an opportunity to be bought out. So First Hawaiian is one that was bought out some years ago. It's a little bit of an anomaly. So it's truly independent now. It was owned by a French bank for some period of time. The other one that I like happens to be in New Jersey. So obviously the other end of the country, Kearny, K-R-N-Y is the symbol. That's one that was a savings and loan. It was demutualized, and it's one that's very small, meaning it's about $1.5 billion market cap. So it's one that we've owned for some years. Very steady growth, low delinquent loans in a good area of the country that's going to continue to grow. So yes, that's another one we like a lot.
That's right across the river from us here in Lower Manhattan. All right, George Young with the Villere Balanced Fund. Thanks so much for stopping by. Have a great New Year. We'll talk to you in 2020.
Thank you. Bye-bye.
All right, coming up here in the final round, changes coming to the Fed next year. We will discuss with our two resident Fed experts what the shuffling of the voting members of the FOMC could mean for Jay and the gang. But first, let's check out where big financials are trading right now with just over 30 minutes to go in the session. back to the final round here on Yahoo Finance. Miles Southern with you in New York. I'm joined today by Yahoo Finance's Brian Chung and Yahoo Finance's Jared Blickery. We've got 30 minutes to go in the session. Let's take a look at where we stand right now. We've got the NASDAQ poised for a 10th straight record close. The S&P currently at record levels. The Dow just off a record high. All three majors, though, pretty much keeping up the theme of the end of 2019, which is stocks go up every single day. For more on today's market action, let's go to Scott Gamm. He is live on the floor of the New York Stock Exchange. Scott.
Well, Miles, we want to highlight some retail and consumer stocks as the holiday shopping season comes to an end. First up, Tiffany, the company releasing some preliminary sales data for the holiday season, saying that sales likely rose between 1% and 3% year over year from November 1st to Christmas Eve. Now, that was largely driven by a double-digit gain in sales out of China, which was important because it helped to offset some of the declines that Tiffany has been seeing in terms of revenue in Hong Kong amid the broader protests in the region. Now, Tiffany's stock not really doing much today. It really hasn't done much over the past month, just because back in November, the company agreed to be acquired by LVMH for just over $16 billion. And then, of course, Amazon stock finally getting a bid. The stock is up 4.4% right now. Earlier, it was up about 1%, but now it's more firmly above $1,800 a share. Amazon today releasing a press release saying that tens of millions of Amazon devices were sold during the holiday season and that people shopped at record levels during the holiday season. We know Amazon stock has underperformed the broader market. It's up about 24% so far this year. The broader market is up closer to 30%. And then finally, can't forget about the holiday shopping returns. UPS expects returns to hit a record level. I guess in the next couple of weeks, right? You get your gift and then a week later you want to return it. UPS shares are up. FedEx shares, by the way, are up as well. We don't say that often over the past couple of weeks for FedEx, guys.
All right, Scott Gamm, we'll talk to you after the closing bell. All right, well, as is the case every year, we've got 4 regional Fed chiefs set to join the Federal Reserve's FOMC voting committee next year. So we see some new names on that list. Some folks will roll off. These are the regional Fed presidents, including the always interesting, ever interesting Jim Bullard of the St. Louis Fed, rotating off as a voting member of the FOMC. And next year, among the members who will join as voting members, Neel Kashkari of the Minneapolis Fed, as well, I think, as Loretta Mester of the Cleveland Fed, probably one of the more interesting of these 4 names. But Brian Chung, you, of course, know these changes are coming, have thought about what this could mean next year. We've seen consensus form at the end of the year after some dissents. Do you have any sense or any guesses at how this new composition could change things for the Fed next year?
Well, based on what Fed officials have said so far, assuming the economic outlook doesn't change, then nothing. They'll keep the rates steady at 1.5 and 1.75 through the end of the year. Now, of course, predicting what's going to happen in 2020 was a game that the Federal Reserve didn't appear to play very well, as it predicted at the end of 2018 when it saw that there might be another 3 hikes through 2019. That wasn't the case at all whatsoever. We have 3 rate cuts this year instead. So, the forecast is going to really depend, on what we see in terms of the trade impact, in terms of the continuing slowing global growth. But, you mentioned Bullard, who is seen as one of the more perennial doves on the board, being replaced with Kashkari. I mean, that's almost a 1-for-1 switch right there. Yeah. Harker and Mester seen as hawkish, so that could be a substitute for Rosengren and George, which you saw this year. So maybe not all that much changes, to be honest.
Yeah, I think the interesting thing is going to be, well, I say this every show, every day, the Bs, like how much are they going to print? Don't call it QE, the T-bills, $60 billion a month, and also the balance, just in general, the balance sheet expansion. I think they might move toward coupon purchases. They're not going to want to because that will be seen as QE, so buying longer-term, longer-dated treasuries. But even if they don't, and they set up some kind of standing repo facility, all of this is just adding liquidity to the markets, and I think markets have responded to it in kind like they have before.
Yeah, and this is the bit, assuming interest rate policy doesn't really get interesting, if they end up holding steady, then it will be the balance sheet that'll be in focus. But what we should expect is probably not that much news in the first half, barring any sort of flare up in the repo market again, because they've committed to having that $60 billion a month of purchases through the first half of 2020. They said they're flexible on that, but they remain pretty committed. And when you look at where the Fed funds rate is right now, right, there are concerns about maybe some year-end crunches in the repo market because of maybe Forex markets mopping up a lot of liquidity, or maybe just the year-end closure from the big banks to try to get their GSIB positions in place. Look, right now the effective federal funds rate is around 1.54 at the lower end of the Federal Reserve range right now. So it seems like, based on 60 billion, that seems to be a decent number for right now, which means that maybe we don't see any pressures.
Well, remember, it was only 6 months ago we had Fed funds almost floating above the target range because they cut the rate on they cut the IOER rate because we continue to see effective Fed funds float higher. But I think what's interesting about this year's Fed is I know Jim Bullard kind of does it to himself, right? Like with the way he gets put on the side, like, Bullard just says some stuff because that's what he does. But I think that you go back to May, April, May, Bullard was the person who was coming out at that time really making continued cases for rate cuts. And I think in some ways, and maybe this is giving him too much credit, I think Jim Bullard shaped the conversation around why the Fed should cut rates and open up the possibility for more aggressive action, all that kind of stuff. So I do wonder with him moving off, and he was taken seriously because he's a voting member. Yeah. So with him moving off his rotation, who is the marginal bid, as it were, to shape Fed policy outside of Powell? Does it become Kashkari, who you mentioned is kind of a one-for-one swap with Bullard, or is it someone else? Does John Williams finally come into his own as the New York Fed president this year? I think that's kind of the outstanding question for 2020.
Yeah, and the problem is, until we see the transcripts X amount of years from now, it's going to be difficult to tell in retrospect who it was going to be beyond speculating. But what we do know is that the Federal Reserve presidents, even if they're not voting members, are still in the room. That's an important clarification to make. So they're all part of the deliberative process, but ultimately it's only the four that you just highlighted that will ultimately have votes. So among those that have votes, yes, it's possible that Neel Kashkari, who has really been hitting the drum in terms of saying the labor market can continue to tighten, that there's more labor market slack, which I think most of even the hawks would admit was probably true. People thought in 2018 when unemployment was 3.7, 3.9, that was it. And then we hit 3.5 and we're still probably going to go lower. So, there is definitely that voice that might end up, winning out
Well, then you got to ask under what circumstances does the Fed actually cut again more, or do they actually raise rates? And I think to the latter question, it's going to take a long time because, and I've said this before, but inflation is going to need to hit 2.5%. We're talking core PCE for at least a few months at a time to get that symmetric move above. Mm-hmm. And under what circumstances is that going to happen? You talk about slack in the labor market. I don't think there's that. It's that tight.
Yeah. All right. Just to wrap this up quickly, I kind of know what Jared's answer is, so I'll go to you first. Fed story of the year for you?
Repo.
There you go.
Yeah. They got behind it. They missed it.
Brian?
I think the Fed story for me was actually Bill Dudley. Bill Dudley's Bloomberg op-ed. The politicization of the Federal Reserve was unprecedented.
Really good one.
That's a good one. So I guess that opens up the question, though, just quickly before we get out of this. I've argued, I think a lot more forcefully, certainly than you have, that the Fed is responding to Trump, whether it wants to say it's not or however they want to do that. And so I do wonder, next year with the election, how much does that impact policy? Let's say we are seeing inflation pick up in August, or let's say we have another summer downturn as we had in 2019. Is the Fed hamstrung on that basis? So I would say yes, but I think they believe that the answer is no.
I've seen a lot of notes from economists that have said for the longest time the Fed needs to be independent, but then writing the same note that says they will not move on rates in 2020 because it's an election year.
Right.
Yeah,
doesn't that in and of itself some sort of subversion?
Thanks, Bill Dudley.
I think they've moved plenty of times in election years in the past. This is an organization with a long history. I don't think it's going to be that big of a deal. If anything, maybe they don't do the coupon purchases because then it's QE and that kind of backs President Trump.
They're not doing QE right now.
Right.
Yeah, I don't see things changing much.
All right, good stuff. Coming up here on today's final round, we'll have the winners and losers in the stock market. But first, take a look at some of today's most active stocks. All right, let's take a look at some of today's winners and losers in the stock market. Stocks that include Boeing after a congressional panel investigating 2 fatal crashes of the 737 MAX called Boeing's newly provided documents, quote, very disturbing. Springbank Pharmaceuticals plunging after the drug maker announced it has halted a hepatitis B trial. Now for some of the stocks in the green during Thursday's session. Amazon, the best performing stock in the S&P 500, up over 4% after the e-commerce giant said it had its best holiday shopping season ever. Also, Tesla shares hitting new highs earlier after analysts at Wedbush raised their price target on the shares to $370 a share. That's up $100 from Wedbush's prior price target. Tesla above $430 a share for the first time. Coming up here on today's final round, markets have even more room to run after an explosive 2019. Strategist Kevin Nicholson will make the case for us. But first, let's take a look at where the big retail names are trading right now, 18 minutes to go in session. Banner year for the market is wrapping up. Our next guest says his base case for 2020 is returns that are in line with historical averages. Kevin Nicholson is the chief market strategist at Riverfront Investment Group. He joins us now to discuss. So Kevin, you got a base case, 6%, 8% returns in U.S. stocks next year. So I guess I have to ask, do you see more risks on the upside or the downside of this forecast?
Well, I think at this point, I actually see risk to the upside. And the reason for that is because when you look at the market, look at the economy in the U.S., GDP is growing still above, 2%. It's slow growth, but we're still getting growth. You have unemployment at 3.5%, and we expect that to go lower in 2020. And you have a Fed that's on hold. And additionally, you have interest rates that are very low. So those are all conducive elements to help a equity rally here. And so we think that, you could see some upside, especially if you have trade headwinds that are now becoming tailwinds as they've gotten a phase one deal, at least agreement thus far. We'll wait for January to see whether or not it gets signed. So we think that that's very helpful to help equity markets going forward.
Hey, Kevin, Brian Chung here. So on that point, assuming it's baked into your scenario that trade headwind will disappear at some point in 2020, what's the play there? Are there certain types of equities that you would like, certain sectors that you would buy into if that were to be the case?
Well, for us, we've we're a value shop, and so we continue to like financials. Financials have been a place that are now starting to take off a little bit. I mean, when you look at the returns in 2019, where financials on a total return basis are up about 32%. So we think that there's more value to be had there, especially as, you know, the Fed, given the fact that the Fed is on hold, you don't have to worry about interest rates coming down any lower. And so the net interest margin that has affected a lot of banks will probably not be in play. And so we really like financials, and we also like technology, where we've been invested in softwares and services for most of the last year. The other place that we're going to look to is going to be dividend-paying stocks. And the reason for that is because we need some income in our portfolios. And right now, when you look at where, you know, 10-year treasuries are about 189, 190, somewhere in that range, you can get, you know, significant or equal yields in equities right about there, and plus you have more upside potential. So we're going to look for those companies that are able to grow their dividends and, you know, manage their balance sheets accordingly.
Jared Blickery, just following up on that, do you like the energy sector? Because this sector, it seems like it's been forever since it actually outperforms, but you like these dividend plays. And would you play it necessarily as a whole, maybe through ETFs, or would you look for companies really specific in it that you think have a better potential to grow beyond just paying a dividend?
Right. So for us in energy, we've, you know, been pretty neutral as far as our exposure in the portfolios, and we're going to do that, play energy through ETFs. We're not going to try to pick specific names because it's just too hard of a game to know who's going to be the winners and losers here.
And Kevin, just quickly, you guys like the U.S. over Europe. A very popular thesis we've heard from guests on this program is they like international equities more than the U.S. What are you kind of seeing here at home that makes you a little more bullish on U.S. markets than overseas opportunities?
Well, I mean, I think that when you look at the landscape, the U.S. just has better economic growth at this point. When you go to international markets, the problem that we see is that you still have a lot of political issues or political uncertainty internationally, as well as we feel that international markets need to have structural reform. If we can start seeing some of that structural reform, we believe that international will be a place to go, especially with our fixed income assets, as you know, yields are so low, as I've said. For us, international does give us an opportunity to put money to work if it starts to work internationally. So what we need to see is we need to see some structural reforms. I mean, places like France have already started some of the structural reforms, and they're, tackling, pension reform right now, and you're seeing some of the unrest there because of it. And so what we want to see is places like Germany actually, do some fiscal stimulus, something that they haven't been willing to do over the last 5 to 10 years because their economy was good at that point. But now that you're starting to see them slow, manufacturing has been a headwind and under a lot of pressure in Europe because of the trade war. We just want to see the boat. We want to see the tide actually turn and actually see some of this pressure be cleared away before we want to fully turn to international markets. However, we do see value in international, and we have been moving money there periodically in small pieces, and we will make a bigger allocation to that if we see get the all clear signal down the road.
All right, Kevin Nicholson is the Chief Market Strategist at Riverfront Investment Group. Thanks for joining us. Have a great new year.
Thank you. You too.
And Brian Chung, class is dismissed.
Thanks.
Are you here next week?
Monday.
Just Monday.
Yeah, I'm here all of next week.
Partying in Austin.
We're not going to see. We're not going to see you here on the final round until 2020.
What are you going to do when the minutes come out? When are they coming out?
They're coming out.
Next Friday.
Next Friday. Yeah.
Oh,
How about that?
Interesting.
Yeah.
Interesting. Yeah. Bet you weren't expecting that.
I was not. Yeah.
I wasn't expecting the DOE.
It was a boring meeting. It was a boring meeting. Nothing happened.
Jobs report next Friday.
Yeah, that's right.
Don't sleep on that, kids. All right, Brian, see you. Coming up here on the final round, we got the closing bell, 9 minutes away. But first, we are going to check the charts and get technical with friend of the program, Brian Shannon. We're back with that right after this. Welcome back to the final round here on Yahoo Finance. We've got the NASDAQ on track for its 10th consecutive record close, its 11th straight positive close. Jared, we are looking also here at the Dow, or so NASDAQ above 9,000. Yes. The Dow, though, is now surging into the close, and we are looking at a record on that. All three majors could be set for record closing highs today.
Yeah, another exciting day of record closes because there's really not a lot more to talk about in this market.
All right, we'll see you after this.
Happy Boxing Day.
That's right.
Most of Europe was closed.
We were talking outside before we came in here. It's like, why does America not have Boxing Day off?
I think we should. I'm going to lobby for it.
Hey, we're getting record closes and they're not.
Exactly.
There you go.
We can say that. Yeah, look at the Dow this year, 22.5% up. I think Boeing is really the only thing that's holding it behind the S&P 500, and then of course NASDAQ, huge outperformer here. Yeah. And it is the 1-year anniversary of last year's Boxing Day, where we had the markets up 5%, effectively kicking off all of this here, this rally.
And I think what's interesting, if you look at the year-to-date chart, of course, in the very, 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 very far left-hand corner, you can see Apple's guidance. Yeah. That's it, right? That's the only time this year that we've seen the market negative year over year. And so it's basically saying, as this was, the first trading day of the year, the second trading day of the year was terrible for the markets. With no other exceptions, we have seen investors enjoy positive performance compared to the prior year. And I think that speaks to a lot of the psychological, rally that's happened in the last 2 months. It's like, well, things never really got that tough, so we might as well just party on into the end of the year.
Yeah, and not only that, so many people were saying during the summer, let's take a look at the S&P 500 on a one-year basis. Well, it hasn't gone anywhere, but you look at really what it's done in the last quarter, having broken above. So now this is maybe 7 or 8% above the old highs here. I think this is extremely notable. And yeah, that decline last year just kind of happened to occur at the very end of the year. And so the beginning of this rally, we can take it as the entire piece of the pie here for the year, not really giving back much. The only thing I look at is the Russell 2000 maybe. That has broken up to the upside, but the transports haven't. And so we look at those still kind of stuck near these highs. And then if we look at some of the leaders, I was just telling you before the break, EEM, let's take a look at this one here. That's retail. Retail's done very well too, but EEM, and I think we'd have to go back 2 years to find, it's finally reached this point over here. And it took a long time for emerging markets to kind of break out, but here they are.
All right. Jared Blickery at the Wi-Fi Interactive Touchscreen. We'll see you at the desk coming up right after a short break. And on the other side of that, we'll have the closing bell here on Wall Street Plus. We've got the market getting bearish on beer makers. And of course, the reason why is some folks who can't legally drink beer yet. We'll have that in our call of the day coming up right after this. Welcome back to the final round here on Yahoo Finance. I'm Miles Ludland in New York. I'm joined by Yahoo Finance's Heidi Chung and Jared Blickery on this Thursday. We're looking at a record close here for the major averages. About 9 seconds to go in the trading session. We're going to see where we shake out. The NASDAQ is going to be above 9,000 for the first time. That we think we know, but we are seeing a little bit of buying here into the closing bell. The Dow looks like it's going to finish up triple digits.
It just made a record intraday high.
There you go. Live pictures from the New York Stock Exchange and the NASDAQ market site. So we've got, all right, Jared has the big computer with all the big numbers.
Oh my.
We're looking at the full screens
here.
here.
Look at a 1 minute chart here. There's a huge spurt at the very end of the day.
All right, everyone buying everything with reckless abandon into the close. These are record highs across the board, yes?
Yes, they
for
are.
all three majors. The Dow up 107 points when all was said and done. We came on the air, the Dow was up about 45. So quite a swing there on a pretty low volume day when there was really no reason to do any buying or selling. I guess people talk themselves into things all the time, but it's not like we had trade headlines or anything today.
No, we didn't have any headlines today.
Well, the stock market closed higher on trade optimism, that I know.
Yeah, well, I think we're going to be using that one a lot, especially into next Friday. You look at who's done well today, Amazon is a standout story, and consumer discretionary because it's 22% of that sector. And it's constructive on a short-term basis here, finally, because it's just been going sideways for so long, underperforming the consumer discretionary sector as well as the S&P 500. This could be a breakout day for Amazon because a lot of the other FANG names have not recovered all of their losses, but they've had rallies. Apple is probably the poster child. Even Netflix came alive a couple weeks ago, and now maybe it's Amazon's turn to once again be a market leader.
Wait, but the whole the Apple story, we have to talk about that. Remember when we came in at the beginning of this year, they gave us that really bleak warning. Yeah, exactly. And I know you guys briefly talked about that at the Telestrator or the platform.
That was last hour.
Yeah, but that being said, this run has been pretty amazing. And I know we also when we talk about individual stocks, though, we also talk about Tesla, right? And how the past 3 months have been pretty stellar for that company as well. I don't know what you think about Tesla's run. I don't know if are you a bull on Tesla?
He's with Cathie Wood.
I have no opinions. I'm just a neutral man reading the teleprompter.
But record highs for Tesla. A lot of fun individual stock stories, I think.
Yeah, definitely. And you look at some of the names, the standout names too. I haven't heard much from Lulu lately. I don't know if they've recovered yet. So they hit a record high a few weeks ago.
Anecdotally, long lines in the dressing rooms today.
Oh, yeah?
You went today?
No.
How do you know?
I heard.
These guys are up 90% on the year.
A man or a woman?
A woman.
There are lots of stocks up close to 100%.
Yeah, I guess we're going to find out, right? But the more that this has gone on just in the last handful of trading days, and it's not like there's any reason the story was going to change, right? We sort of knew we got through the Fed meeting and then everything would be fine to the end of the year. I guess I didn't expect there to be another 5% rally in this market for no reason. And we could just run through the tickers, the breathlessness with which we're calling off these performances. It just feels so 2017 into 18 to me. And maybe that's going to end up being proven wrong. And I've written a lot about all of the research out there from, Tom Lee, Jim Paulson, many others who are highlighting that we did have a long reset. We had 20 months where the market went nowhere. There is plenty of reason to think this is the beginning of a new leg higher. But the speed with which I think investors are jumping for that growth, that incremental, kind of bid is just has been pretty amazing. The charts, when you see the three majors kind of start to diverge on their paths there, really mid-November and rip higher, it's just.
It'd be interesting to see what happens when we get that first correction. Most years you
obviously right. You're going to be down 7-10%.
It's going to be scary. People are going to say the bull market's over, but I think it's going to be a buying opportunity. There's too many people who want to jump in. And the big difference between now and then is the Fed.
Yeah,
it's a tailwind, not a
headwind. That Amazon commentary is interesting because Jared, you brought up for the first time last week, which I hadn't heard of, hadn't been aware of, I guess because I just hadn't thought about it, was Amazon underperforming the market and being such a large part of consumer discretionary. So you could say, well, maybe that's saying Amazon is telling you something negative because it's not following the rest of the index higher. On the flip side, if Amazon finally decides to join the party, then you're going to have 20%, right? You're going to have 20% of the XLY ripping higher just because Amazon is finally joining some of its peers that have doubled this year. And so I think there's a lot of that kind of stuff sitting out there in the market if you want to say just on these technical sort of flows basis, what is available for the bulls? And I think the answer is quite a lot.
Yeah.
I have a question for you, Jared. When we look at the Dow, we often talk about how without Boeing, the Dow can't essentially rally. But as this fallout continues into 2020, and if they can't really get their act together, does that mean bad news for that index?
Well, not necessarily, because there will be other leaders. It's done by points. We've talked about this a lot. It's archaic, but if Boeing becomes a $200 stock, there are plenty of other stocks that are becoming $300 stocks, not the least of which is Apple and one of the Uniteds. I don't remember if it's technology or health. Goldman Sachs. There are a lot of potential leaders in there.
Yeah.
All right, for more on today's market action, let's go to Scott Gamm. He is live on the floor of the New York Stock Exchange. Scott, do you have no NASDAQ 9,000 hat? We'll wait for the Dow 30,000 to get another hat on you.
We're at the New York Stock Exchange. It's a competition. No.
That's right.
Well, we stick to the Dow here. Well, and by the way, the Dow lost its record close status just this past Tuesday. Well, today it got it back with the Dow closing at a record level. By the way, we're getting close to Dow 29,000. I was told last week those hats have been printed and should be arriving soon. Now, for today's action, you can really thank Apple. That was the best performing Dow stock, hitting a record high today, really approaching $290 a share, an incredible run for Apple. JP Morgan, Chase, Walgreens, and Visa were the other best performing stocks in the Dow today. And then some of the laggards, of course, Boeing, Merck, 3M, and Johnson & Johnson. Here's an example of the Dow being able to rise without participation from Boeing, which is such an important weight in the Dow. Now, outside of stocks, we also saw a surge in oil prices with West Texas Intermediate, that's the U.S. benchmark for crude, not just crossing $61 a barrel today, but approaching $62 a barrel. There was some data this morning from the American Petroleum Institute showing a 7.9 million barrel decline in weekly crude inventories for the week ending last week. So lower supply tends to push up prices. The XLE, that's the energy sector, was in the green for most of the trading session, but that gain kind of petered out in the final moments of today's session. And then finally, take a look at gold prices moving more firmly above $1,500 an ounce, approaching the 2019 high from August, which was $1,535 an ounce. Gold prices this year are on track for its best year since 2010. Miles.
All right, Scott Gamm, live on the floor of the New York Stock Exchange. All right, time now for our final round call of the day. Today we've got Cowen out on teenage trends, specifically looking at the habits that teens have on products they are not allowed to actually consume. This includes vaping, smoking actual cigarettes, consuming cannabis. We could just say smoking weed, right? That's fine. I guess it depends where you're from. People, have different slang for that.
I call it pop.
There you go. And of course,
I call it weed.
more of a soda guy. And then of course, drinking alcohol. So I think what's interesting in here is Cowen points to something we all know. Beer sales are down. But isn't it perhaps, and I think this is kind of talked about here in this note, a problem that teens are no longer finding it cool or just acceptable to consume alcohol because they have one, other options, or two, they just know this is bad, and so they're a little more straight edge.
Yeah, the good news is they're getting addicted to nicotine. That's the other half of the report.
Because of Juul.
Which is just incredible and irresponsible, and I think there's going to be fallout from that. But I know we're talking about the drinking thing here. It's just, some of the statistics here, I was surprised by. And they talk about these lifetime cohorts, and they're interviewing people who are in 12th grade. I don't know what lifetime means, but I guess they've been drinking for a long time if they meet that criteria. Nevertheless, these beer drinkers, most of them who had any kind of returns, peaked earlier in the year, like around August or so, and haven't been able to get off the dime recently. Mm-hmm. And the best performer historically, Bud has been a really solid stock. That's Anheuser-Busch InBev. Mm-hmm. And they're doing very well in China. And so I think they would benefit from the phase one being completed. But that stock is a little bit listless here. It's kind of going sideways for the last 5 months or so.
Is it surprising, though, that, teens or just younger people in general aren't consuming beer? That's a trend we've seen that trend for a really, really long time. Mm-hmm. But also the whole hard seltzer craze has been insane. And Boston Beer obviously benefiting from that, that along with White Claw. But earlier I thought you said pot, and so that's why I said weed, but you said pop.
Yeah, pop.
I was like, what?
It's a classic Jared non sequitur, right? You have to assume that he's completely jump shifted.
Yeah, I was like, what?
That's the joke. I think so. We're showing the chart here, just overall beverage sales. We discussed it in the last hour. Like, the only thing that seems to get beer outperforming its peers in the spirit space is a recession, because we've seen 2001, 08, and 09 are the only times in the last 2 decades where beer sales have outperformed in the overall market. Now, this summer, and we can see those two pretty big drawdowns on the right side of this. That is the White Claw sort of trend pulling at it, but I think it's just kind of the structural decline of beer. And it's surprising to see beer's underperformance in the mid-aughts because so much is made of that trend now. And maybe it's just tougher comps, so the drawdown isn't as large on an absolute basis. But with Insta, people wanting to be more health conscious, beer, not good for you. Tastes great, not good for you.
But when we see Bud Light Platinum, it's supposed to be better for you, right? Less carbs, less calories, right?
They have an excellent rewards program too.
What?
The Platinum.
This is what I mean.
Exactly. Bud Light Sapphire Reserve, that's the next one?
5% off Prime purchases.
Wait, Jared, have you tried hard seltzer?
I have.
Are you into it?
No, it's
like,
it's
nah.
a bit beyond me. So admittedly, it's after my time. And if I wanted vodka soda, I'm not going to flavor it. And it's going to be a little bit stronger than what you find in the can. So I don't think I'm going to sign on to this particular trend. But they got the frat boys in it with their stamp of approval. And I think that's how they got nationwide popularity instead of going the way of Bartles and James or Mike's Hard Lemonade.
Yeah.
Which never really took off. It was popular, but very niche.
It just has so much sugar.
Yeah. Well, they own White Claw, so it's fine.
It's keeping them alive.
All right, Jared Blickery, have a great evening. Go pour yourself a Truly or a Bonnet Viv or a Bartles and James if you so.
Pull out the
Do
flask.
they still make those Bartles and James?
What
Is
was
it a
the
wine?
What is that?
What was the
Wine cooler,
tagline?
right?
Thank you for your support. Yeah,
There you
I
go.
said that at the end.
Jared, we thank you for joining the show and supporting us here at Yahoo Finance today. Coming up here on the final round, we'll break down the latest headlines and implications of the trade war with China. Expert Roger Baker from Stratfor. But first, let's take a look at where trade-sensitive stocks settled on this record-setting day for the major indexes. Christmas Eve, President Trump said that there will be a formal signing of the Phase 1 trade deal between himself and Chinese President Xi Jinping in the new year. So should we also expect a full end of the trade war as we head towards the election? Joining us now to discuss is Stratfor's Senior Vice President of Strategic Analysis, Roger Baker. So Roger, we've heard for quite a long time in markets that the Phase 1 deal is going to happen, it's going to be signed, and I think there's some skepticism among the investor class that this really changes anything. The market has certainly priced this in, but from your vantage point, does this Phase 1 deal and any kind of signing change the kind of basic standoff here between China and the Trump administration?
We really don't see this as a fundamental change in that situation. We see this a lot more as a brief pause in the way in which the competition of the conflict has been going. There's not a lot that's actually happening in this. It's a bit of a rollback of some pre-existing tariffs, but not most of them. It's a little bit of increase in consumption by the Chinese of some of the U.S. products. But in general, the underlying competition between the two countries is by far not resolved.
All right, so I think, again, the stock market, investors, they just want to see any kind of incremental news, and they're going to do what they're going to do. But from your perspective, taking a longer-term view of how this relationship between the U.S. and China has changed under Donald Trump's leadership, where do you think we stand on that? How should people be viewing this new era of U.S.-China relations, which I think began, after that election and isn't going to be solved clearly just in the next couple months?
Well, I think in some ways it actually began before the U.S. election, and we were seeing this pattern of U.S. and Chinese competition starting to grow. Even if you go back several U.S. presidents, there was a belief that the Chinese were going to be the main emerging strategic competitor to the United States. What we see today has been a much more focused attention on, for example, the trade balance aspect of it. But we've seen within Congress and in other parts of the government a focus beyond just trade balance to looking at things like technology competition, to looking at IP, to looking at the way in which the Chinese are potentially stealing or changing the rules for the way businesses operate, and looking at that broader national security dynamic.
Hey, Roger, it's Heidi. So as you mentioned, we have a sort of ceasefire at this point with a possible phase 1 deal on the horizon. But in your opinion, what's realistic for a phase 2? Do you think we can actually get something meaningful done in a phase 2 before perhaps the 2020 election?
I really think this ends up being a very political question as to whether or not the U.S. president feels that it's in his interest as he's heading toward the election, and quite frankly, whether the Chinese feel that they need something more solid or another step to this. So there is some room for another step or another stage, maybe a rollback of additional tariffs rather than a continued escalation that we have seen up until the holidays.
And then, Roger, I guess just thinking specifically about what's happening in China and with their economy, and they're obviously going through a lot of demographic shifts that I think we forget about because of the U.S.-China trade war. What do you just see as the state of play in China right now, both economically and politically, that might be getting lost in the shuffle of the day-to-day what's up with the phase 1 or phase 2 deal?
Well, I think the one thing, as you note on demographics, that people need to be aware of and remember is that China is nearing peak population growth. So China is about to hit that curve where their population flatlines and maybe even starts to decline. This idea of a constantly growing China, a constantly bigger China isn't there. At the same time, a third of the country has risen up to become a part of this middle and upper class. They have tremendous demands from the government on the types of lifestyle that they want, on the types of economic situation that they want to see continue. And yet there's still 2/3 of the country that hasn't achieved that. And they're looking at this slowdown in the Chinese economy as the Chinese restructure their economy. And they're seeing this disparate position between themselves and those on the coast, and wondering why they're not going to get the same aspects as those on the coast. So if you're the Chinese leadership, when you look internally at the Chinese economy and the Chinese population, you're looking at a huge chunk of the interior of the country who are eyeing the coastal elite and the coastal middle class and saying, why can't we be like you? And you're seeing some potential tearing apart of the social fabric. And so we do see the Chinese government looking at their economic policies to try to appeal and appease those interior Chinese while not losing the coastal component. And that may mean many of the things that the U.S. wants them to do, they simply cannot do.
All right, Roger Baker is a Senior Vice President of Strategic Analysis at Stratfor. Thanks for joining us. Have a great new year.
Thank you.
And coming up here on the final round, we've got the Sector Watch, and we are back with that right after this. Well, let's take a look at the sector winners and losers on this Thursday. Sectors in the red: healthcare down just about 0.1%, weighed down by shares of Insight, Mylan, and Obiomed. Now, we had 9 of 11 sectors in the S&P 500 green today. That includes communication services, XLC, up about 0.7%. Viacom, CBS, Alphabet, and Facebook leading the way there. And consumer discretionary, you heard us discussing it earlier with Jared Blickery. That sector getting a boost from holiday retail sales, up over 1.2%. Amazon, the biggest component of that sector, up over 4% after the company said it just had its best holiday shopping season ever. Of course, billions of items ordered worldwide, 5 million Prime signups, so on and so forth. Coming up here on the final round, we'll have what we're watching tomorrow in the look ahead. Plus, she's doing it her way inside Lindsey Vohn's non-traditional proposal to hockey star PK Subban. We are back with that right after this. All right, now here's a look at some of the stories that'll be making headlines on Friday. So as 2019 wraps up and we look back at the year that was, I think it's also important that we don't forget the year that came before. 2018 was the market's worst year since the crisis, but I think that probably understates the reality. So sure, a bear market is defined by a 20% decline in the market, and that technically didn't happen last year, but that definition is arbitrary, and the only people not saying that we had a bear market in 2018, I think, are being deliberately dense. So if you want to argue that the 19.8% decline we saw in December of 2018 wasn't a bear market, knock yourself out. But this line of thinking will leave you failing to understand why 2019's rally also makes sense, because whether you think this all ends poorly or not, the tax cuts into rate hikes period of market history that created the 17 into 18 rally and give back is now over. We're in a new phase, a new period, a new era. We're dealing with an easier Fed, a stable tax regime, and an upturn in global growth. Now, last week, Jim Paulson was the latest analyst to highlight how 2019's market rally stacks up against post-bear surges in the last 70 years. And the answer is quite well. So we've got now Jim Paulson and Tom Lee and others arguing that we're in a new phase of this bull run. And I think that makes sense. It's just as long as you acknowledge that this run had come to a screeching halt just a year ago, and then you understand what this is all about. Now, turning to the calendar, for Friday, we've got no major events scheduled on the economic data or on the earnings front, as Heidi Chung knows.
It makes it very painfully hard to write the look ahead.
Actually, it's the opposite, though. It's the opposite.
No, I'd rather have more things
Because you
to
just
discuss.
say, here's the look ahead post for tomorrow.
Nothing is on the calendar.
Stocks closed at a record high on Thursday.
Santa Claus rally
That's it.
intact?
How hard is that?
Fine.
How
You're
hard
right,
is
you're
that?
right, you're right.
All right, Olympic skier Lindsey Vonn is engaged again, but also still. This time, though, she was the one getting down on one knee. Vonn proposed to her already fiancé, NHL star PK Subban, on the couple's 2-year anniversary. They first got engaged in August, but then Vonn wanted to give her fiancé a ring as a display of equality and says women aren't the only ones who should get engagement rings.
Sure, why not?
I kind of agree.
Yeah, why not? If that's the way you want to roll, all for it.
I will say, in the 7 months that I've been engaged, I feel kind of left out.
Uh-oh, should we have a word?
No,
with
I'm
your
just saying.
fiancé?
I'm just saying. It's like
So my
I don't have
question-
anything to show for it.
Okay, so my question is, okay, if we want
Like
true
publicly,
equality,
like-
right?
Sure.
If we think about walking down the aisle,
Yeah.
should we perhaps have a man also walk down the aisle?
Well, okay. I don't think. Maybe.
I'm
Well,
curious.
okay, the men proceed in. It's just not
Right.
like a.
But they're the one who they are receiving their bride from the father of the
Yes,
bride, right?
yeah.
So that's a very traditional way of looking at marriage, the
Yeah.
you know the establishment
It's very,
and all that.
It's very possessive and all.
Right. Like I'm not property because I know someone who actually said that and purposely did not have anyone walk her down the
Yeah,
aisle.
right.
They just stood up at the altar together at the same time.
Yeah.
So I mean, it's a valid question, right?
Right.
Yeah, equality.
Right. I think engagement rings are fine.
Sure.
Of course, the thing for men is like there's just like PK's ring looks kind of just like a
wedding band,
ring.
yeah.
Right. So like,
Are they going to double up?
Well, I mean, look, if I'm big jewelry, I think I would want there to be men's engagement rings because
Yeah.
then you could say like, oh,
That's funny.
men should have like a diamond, a diamond band or something like
That's
that.
funny because Big Diamond did try that and they failed.
They did.
They did.
What did they try to do?
They
Right,
tried to
you're-
make-
You're in the diamond business.
Yeah, so they
You know
tried
stuff.
to make male engagement rings a thing, and that obviously did not fly in the times
Right.
many, many decades ago.
Yeah.
But if they tried it now, I don't know, it might work. Especially if we have big names like this coming out and saying we should.
The problem is, I could foresee the issue here is if male engagement rings become a thing, but they are considerably less expensive than women's engagement rings. Like, again, PK's band looks very nice. Definitely was not $10,000.
There are no
right?
diamonds in there.
So, like, are you going to be undercutting the women's engagement market by saying, oh, both parties get an engagement ring, and then the combined cost for two people getting rings comes down like 70%?
I think that's a whole other debate when we talk about diamonds and the excessive amount that we pay for diamonds
Right.
and whether or not we should even pay for real diamonds like that. Obviously, I have a very biased view on that. I don't think they're worth it. I grew up around them, so to me, it doesn't hold the same value as it would to someone who didn't grow up around it. But at the end of the day, it's just to show off to your friends and say, hey, my man can get me something like this. So maybe men want to be like, hey, my woman can get me something like this. Sorry, I have really heated opinions about this.
No, it's good. This is good. I mean,
And what's wrong with lab-grown diamonds? They look the same.
all I was gonna say is I think it's weird that lab-grown diamonds are at basically the same price point as real diamonds.
Right.
Like I don't know where the lab-grown people get off thinking like their diamond. Like why is the diamond market set at X $1,000 for this cut and clarity?
Yeah, I mean the whole cut and
And why
clarity
is
thing
why is lab diamond following that trend up? Lab
But
diamond
also-
should be coming in saying we're undercutting.
What I'm also talking about though is like if we look at moissanite or cubic zirconia, at the end of the day, your naked eye cannot tell the difference between a moissanite and a real diamond. So when you're paying 1/1000th of the price of a real diamond, I just don't understand. Like if you're paying $100,000, $200,000 for a real diamond, I mean that's a lot of money.
That's why we need more small business owners on the show, folks. Heidi Chung bringing the heat on a Thursday. All right, coming up here, we'll have more in the final round. Plus, we will discuss the top food story of the year. Heidi Chung, of course, has seen it all. A few guesses here. We'll reveal that after the break. All right, welcome back to the final round here on Yahoo Finance. Miles London with you in New York. I'm joined today by Yahoo Finance's Heidi Chung, fresh off a nice, lively debate about the state of the diamond world. Speaking of expensive things, the stock market, record close here. The Dow, the NASDAQ, and the S&P all hitting record highs. We had the Dow making its first, well, you know, in this market, everything gets blown out of proportion. First record close since Tuesday. NASDAQ above 9,000 for the first time. That's your round number Twitter for the day. The Dow looks to have a date with 30,000. Probably not in 2019. Only have three trading sessions left in this year, but certainly sometime early next year. Got a lot of analysts out calling for kind of that bullish rally right in the beginning of 2020. Shades of 2017 into 18, I think, emerging here to some extent in the market, though. The Fed much more likely to be a friend to this market in the new year than they were back in 2018. Amazon doing a lot of work today. Best performer in the S&P, up 4% after their holiday numbers were released. Also pushing the XLY to a record close. A fifth of the index there, Amazon is. All right, time now for our top take. Heidi Chung is here. That means we must discuss food, and we will do, as we've done for the last couple weeks here on this program. We'll discuss the story of the year in our respective guests' wheelhouses. So we've had a lot going on in the food space this year. White Claw, we had Popeyes, we had fake meat. I was going to say, I think like as years go, a pretty momentous year in the food space.
It's one that I definitely will not forget. I had way too many Popeyes chicken sandwiches. My body probably hates me for it. But I also have to say, the whole trend of chicken sandwiches was one that really, really defined this year for me. I did not come into 2019 thinking that...
Year of chicken.
Right. I mean, one, I'm not even a huge fan of chicken. I only like chicken fried, and in very... I know this is a really controversial topic because a lot of people in our newsroom fight me on that, but I just think it's like the least exciting protein. It's bland.
Right, but having a strong anti-chicken bias is also just a strong view to have because it's not like offending anybody out there. It's just sitting there kind of plain. But it's plain. I hear what you're saying. You do have to put a lot of stuff on it usually to make it something. Okay.
And I was a huge Chick-fil-A fan. I still am. I enjoy going to Chick-fil-A, but I was really blown away by how Popeyes really came out swinging. It was a crazy, crazy concoction of just 4 ingredients. Naturally brined pickles, brioche bun that's been buttered and toasted, the filet, and the Cajun mayo. And it came together really harmoniously. I have to say, they really, really hit it out of the park with that one. But is the chicken sandwich something we're just going to leave in 2019?
Right.
Yeah.
Well, I think that's the question about all three of those. So the big trends, I guess, we've got the chicken sandwich, chicken wars, if you want to call it that, fake meat, and hard seltzer. Of those three, which one to you feels like a classic kind of fad we don't really think about when 2020 rolls around?
I genuinely feel like the plant-based meat craze is not going away anytime soon. I don't think it's
kind of agree. And so I think it feels like seltzer, right? Would be the classic boom bust here. I have my real questions about fake meat, though.
What are they?
It's not good for you.
It's not. But the sodium levels, it's not healthy.
And I think the enduring food trends that have actually changed consumer habits have, in general, skewed somewhat more healthy. I mean, I wouldn't say that as blunt, but like, okay, what's the biggest food trend of the 2010s? I'd say up there would be the rise of avocado nationwide, right? You grew up in California, you've been eating avocados. In New Jersey, avocados were novel in like the mid-2000s, right? People didn't really think about avocados. Now everyone eats avocados. That's, in general, a healthier item than things that an avocado might have replaced, like
But I feel like
mayonnaise.
The plant-based meat craze that we are in right now might be phase 1.
Okay.
So right now they want meat eaters to become flexitarians, right? And so maybe perhaps there's a phase 2 on the horizon in which they figure out a way to make it taste good but also healthier. So we can't expect them to come out with a blockbuster, perfect, healthy, but also tasty item right away, right?
Yeah.
So let's give it some time. I'm really curious to see how these companies sort of evolve, especially as more competition comes into the market. But I don't think it's going away. I genuinely don't.
All right. Chicken wins the year. The year of the fried chicken, according to Heidi Chung.
Do you like it? Do you like the Popeyes chicken sandwich? Have you tasted it? I've offered it to you like a gazillion times, and you've turned me down a gazillion times.
When you come into the newsroom at 2:15 with fried food, and I'm about to come on air for 2 hours, I can't say yes. I can't just go up there and eat a fried chicken sandwich.
You can take a bite.
Then I'm gonna be thirsty on set the whole time.
He's dramatic.
It's a lot of physical work to be out here for 2 hours. All right.
It's true, it's true.
Heidi Chung, you can go recover from your red-eye flight now. Have a great
Thank
evening.
you.
We'll see you back here tomorrow. Coming up here on the final round, a Porsche's fan's ultimate dream, taking a 911 GT3 out on the track. We have that test ride for you with Praz Subramanian coming up after the break.
Hey guys, Prost here in Mid-Atlanta at the Porsche Experience Center. We are doing the GT3 experience. We're gonna put it through the paces, see what it can do. I'm really excited, but let's hop in and check it out.
First question, what are your goals today?
I know that I want to really develop some skills. I know it's not gonna have a 90 minutes, but I'd love to make that toolbox better to sort of really, put a car to its limits,
Okay, well, you're in an excellent place for what you're trying to achieve today. And the reason I say that is because in addition to having our outer perimeter, which is what we call our handling circuit, we also have modules inside that really accelerate your learning curve as a driver very quickly. The idea is that if you can master the vehicle in these low-speed environments where it's really, really slick, there's a lack of grip, and when you get out on the outer handling circuit, things won't come to you quite as quickly. So you can go ahead and fire this baby up. First button we push is what? Boom. Excellent. So let's go on out, we put this baby in drive. And so what we're doing is we want to make sure that you don't go into corners carrying more speed than is necessary, because relatively speaking, we don't have as much weight over the front tires as we do in a front engine car. And so what we do is instead of coming in carrying a lot of speed, we focus on the excellence. We'll go on out. This time I'll start to talk to you about where to position the car, where to brake. You're going to brake back here, and then you'll head head out that direction and ease off the brake now, and then turn in by your guardrail there. Come over on my side, nice and wide here. You'll brake here. Put a little bit of weight over the nose, nice and wide by your white barriers. Ease off the throttle here. You'll feel the car rotate just a bit. Tap the brake here, turn in. Let the car take a set. Now you're going to accelerate gradually all the way up this hill, straight over the rise. Ease off the brake now, turn in by your grass. Come out nice and wide by my guardrail, accelerate here. Brake here, a little more brake. Ease off the brake now. Let's do one more lap. That was pretty nice. We'll start off talking about the outer perimeter. It's 0.9 miles in length. Within that 0.9 miles, we have 14 turns. And so what my job as a driving coach is to make that road as relaxed as possible. You know the rear end that's wanted? Yeah. That's one of your greatest assets in 911. Your job is to maintain control. We focus on your steering, your vision. We start to analyze whether the accelerator can help or whether it hurts in this scenario. We also take a look at the brake pedal. All of these things are things that you're able to practice repeatedly in an environment where it's very safe. The first thing that we'll talk about is what we call our kick plate. Now this is something that Porsche is extremely proud of. This is one of only two in all of North America. And what it does is it uses a device to kick the rear end of the car into a skid just as you drive onto a painted epoxy surface that's continuously watered down.
So what I need to do is just get the car straight again, right? That's what I'm trying to do here.
That's what you're trying to do here. Not spin around, but you're loosening up. You have to be fairly loose in order to turn. Right? If we're really tight, it's so hard to add any input. All right, let's go in here at 20 miles an hour. Those eyes up. Speed looks good. Turn left. Brake hard here. We're going a little bit fast, 24 instead of 20. Oh, we're going to go back. We'll just lower our speed and watch how much easier it is. That process is going to blow your mind. All right, you ready? Yep. Let's do it. 20 miles an hour. Perfect. See what I mean?
Yeah.
Look at how much easier that was.
Wow.
Isn't that amazing?
That 4 miles per hour is like...
changes everything. Now here, this segment of our course is not low friction in nature. So this is our dynamics area. We're going to do the slalom here this time. Now here, the focus is on being really smooth. And what will help with that is exaggerating your arcs quite a bit. All right, so not trying to go as close to the cones as you can. You ready? Yep. Let's go on in there. Another thing that's always been part of the 911 pedigree is a low center of gravity, so you really get a chance to feel that. And how much horsepower does it have?
500.
That's correct. How many liters are this engine?
4.0 liters.
That's right.
And this is a naturally aspirated.
Naturally aspirated. To add a little bit more speed. So keep that speed nice and fluid. Add some speed. More speed. Excellent. See how progressive that was? Excellent work. Great job, bro. Wow. Don't try to take my job. Now back here, this is our low friction circle, otherwise known as the skid pad. It's a ton of fun. What I really like to do using this tool is to get a feel for the car and how it behaves as it approaches and ultimately exceeds its limit of adhesion. Okay. So let's go on in there. So let's go ahead and accelerate. Keep accelerating. So as we're driving around like this, just give the car a little blip in the throttle. Let's do it again. So you notice, the rear end of the car came out. Yeah. That's what we call power on oversteer. You've induced the oversteer with your accelerator. That's something that we use to really help our drivers get a feel for regaining control of the rear end of the car. So now we're going to do an exercise, a little bit of pinch and catch. You're going to create the oversteer by looking with one. A little blip, go. Give it a little bit of blip. Try that again. This is a hard exercise. Do it now. You're just on the throttle. Now, and the last and most critical part of this is your vision. Okay. If you want to keep the car in the circle, you don't want to be looking over. I'm always looking that way. That's right, and that's where the car will ultimately go. I look that way? Yes. Go. Stay with it. Oh, wow. Excellent. Oh, yeah. Good job. Good job. There it is.
Well, dude, you know what's funny? I mean, I feel like that could save my life in the future.
Yes, and that's why we love working here. We as a team, the Porsche driving coaches that work here at the Porsche Experience Center, we feel like we're really contributing to driver safety and driver enjoyment at the same time.
That in and of itself, to me, I think is just valuable for anybody. You know what's great about this is it's all on tape, so I have all your lovely gems and wisdom.
Regardless of what you drive in your daily life, I mean, it's applicable for anything. Great job, man.
Thanks, dude. There's a lot to process, man.
All right, coming up here on the final round, market vet George Young will tell us where he's putting his money to work here with the market closing at all-time highs. We're back with that conversation right after this. The market finished at record highs today, but can the upward momentum in this market continue into 2020? Portfolio manager of the Villeray Balance Fund, George Young, joined us earlier with his market outlook for the new year.
I think that's a good way to put it, both cautious and there are better opportunities out there. The problem is we're not seeing that many things we want to buy. We have our favorites that we've held for some time, but I think as everybody knows, this has been a fantastic year. I think the best on record since 1997, and we might eclipse that on the S&P terms. So it's making us a little bit cautious. So as you say, we've got about 15% cash right now. We're always looking for other opportunities. And sure, there'll be some things that happen because this market, as we know, stocks by definition are somewhat volatile.
Yeah, Jared Blickery here. Just asking about the composition of your portfolio and how that may have changed over the year, because we saw this rise in value in cyclicals starting in about September, kind of with a different interest rate regime, at least with the 10-year yield marching steadily upwards, up about 20, 30 basis points this quarter alone. What does that dynamic look like, and how do you see that playing out into 2020?
Well, we've got a little bit more concentrated portfolio. So we've got about 20 to 25 names in each of our portfolios right now. And what that means, we've seen a little bit more of a push towards technology. That's the largest segment within the S&P 500. So that's done incredibly well in the last 3 months. And that's something that we've seen that skewed the portfolio a little bit. One thing that's important that everybody's got to remember is taxes play an important role here. So it's one thing if you've got a series of holdings in your IRA, you of course don't pay any taxes there. But here we try to hold a little bit longer, meaning 3 to 5 years, something like that. And that's why it's important, and we're enabled to be able to hold smaller cap stocks that offer more growth. So that's generally where we see the opportunity. Again, the Russell 2000's not done that well in the last couple of years. It's averaged about 6% for each of the last 2 years. So it's weak this year, relatively speaking. And also, let's not forget the fourth quarter of 2018. So you've got to be a little bit guarded right now.
Hey, George, Brian Chung here. So you're talking about small caps just now. In terms of investment strategies for 2020, is that going to continue to be the case where you're kind of favoring those blue chip stocks over those small caps? And are there certain pockets even within those subsects in technology, for example, where you like the opportunities in the next year?
No, we really stay more in the small mid-cap area. That's where we seem to find opportunities over the year. And again, that's what's undervalued as a general rule at the moment. So our better course is to hold 15% right now. There will be some opportunities. Somebody missteps. They have a temporary lack of earnings realized. They have a change of CEOs. Their product is temporarily out of favor for some reason. There's a lot of things that can happen in the stock market. So we prefer to keep a number of stocks. We've got about 10 on our radar right now. They're watching and monitoring, getting to know the management, understand the goods they provide, the services they provide, to see if it fits into what we like.
Now, George, I want to ask about one of your names here we've discussed previously. That's First Hawaiian, because if you look at the Russell 2000 in general, it's, I wouldn't say mostly, but about 20% of it is smaller regional banks. So you have First Hawaiian as a name you like. Are there other regional banks? You mentioned there's 10 names you're looking at. Is regional banking an area, as the market seems to price in maybe a little bit of a turn in the economy next year, a space that you're finding some interest in?
Yeah, we do. And again, going back to our theme of small and mid-cap stocks, we like regional banks, which by definition are smaller than the large mega banks. And again, remember, these have an opportunity to be bought out. So First Hawaiian is one that was bought out some years ago. It's a little bit of an anomaly. So it's truly independent now. It was owned by a French bank for some period of time. The other one that I like happens to be in New Jersey. So obviously the other end of the country, Kearny, K-R-N-Y is the symbol. That's one that was a savings and loan. It was demutualized, and it's one that's very small, meaning it's about $1.5 billion market cap. So it's one that we've owned for some years. Very steady growth, low delinquent loans in a good area of the country that's going to continue to grow. So yes, that's another one we'd like a lot.
All right, and coming up here, we'll have what you missed today on Yahoo Finance, and we're back right after a break. All right, now here's a look at what you missed here on Yahoo Finance on this Thursday.
You're seeing leaders like Walmart and Target and others really monetize the data that they have, use it to drive higher loyalty, higher customer value from a customer lifetime perspective, and even more importantly, drive more profitability efficiencies in their supply chain.
Historically, the 5 days that follow Christmas are historically pretty good, and we average about 1%, 1.3% gains on it. And if we hit those, then we're going to be up almost 30% for the year, and that's going to be a strong year.
Over the past 30 days or so, there'll be about $100 billion worth of returns in the United States alone. A crazy, staggering amount.
I remember growing up, we were rushing to the retail store kind of the days leading up to the holidays. I still did that with my kids just for nostalgia this year. But I'll tell you, I think people are planning farther and farther ahead, and it's not just online, it's also in retail.
The department store sector over the holiday season was down 1.8%. And even their online business was growing at about 6.9% relative to the 18.8% total growth. So department stores, and they have for some period of time, are facing headwinds.
The other side of the equation is really commercial loans. And there's always the worry in terms of credit quality or some episodic event like oil that could all of a sudden change the equation as it relates to lending. So far, there hasn't been any industry that we would view to be a risk for 2020.
I think at this point, I actually see risk to the upside, and the reason for that is because when you look at the market, look at the economy in the U.S. GDP is growing, still above 2%. It's slow growth, but we're still getting growth. You have unemployment at 3.5%, and we expect that to go lower in 2020.
All right, market making record highs on this Thursday after Christmas. That's all for now from New York. I'm Miles Loveland. This has been the final round here on Yahoo Finance. See you back here at 3 p.m. tomorrow.